Quantitative trading, a systematic approach. Quantitative trading, often shortened to quant trading, is a disciplined approach to financial market analysis and execution that relies heavily on mathematical models, statistical analysis, and computational power. Unlike discretionary trading, which often involves subjective judgment and intuition, quantitative trading seeks to identify and exploit trading opportunities through systematic, data-driven methods. A significant subset of quantitative trading is algorithmic trading. This refers to the automated execution of trading strategies using computer programs. While a quantitative strategy defines what to trade and when, algorithmic trading focuses on how those trades are placed, often at high speeds and volumes, without direct human intervention for each individual trade. These strategies can be applied across a wide array of financial instruments, including stocks, equities traded on exchanges, options, contracts giving the right, but not the obligation, to buy or sell an underlying asset, futures, agreements to buy or sell an asset at a predetermined price at a specified time in the future, forex, foreign exchange currency pairs traded globally, cryptocurrencies, digital or virtual currencies secured by cryptography, bonds, debt instruments issued by governments or corporations. The pillars of quantitative trading, data, and algorithms. At the heart of any quantitative trading system are two fundamental components. TS, robust data and well-defined algorithms. Data, the fuel for decisions. Data is the raw material that fuels quantitative trading models. These models analyze vast quantities of historical and real-time market data to identify patterns, make predictions, and generate trading signals. However, simply having data is not enough. The quality, cleanliness, and frequency of the data are paramount. Data quality refers to the accuracy and completeness of the data. Inaccurate prices, missing timestamps, or corrupted records can lead to flawed models and incorrect trading decisions. Ensuring data integrity is a critical first step. Data cleanliness involves pre-processing raw data to handle errors, outliers, and missing values. Financial data often contains noise due to market anomalies, data transmission issues, or corporate actions like stock splits or dividends. Effective data cleaning ensures that the model is trained on meaningful information. Data frequency relates to how often data points are recorded. This can range from high-frequency tick data, every price change, to minute, hourly, daily, weekly, or even monthly data. The appropriate frequency depends on the strategy's time frame. For instance, high-frequency trading requires tick-level data, while long-term investment strategy might only need daily or weekly data. Beyond standard price and volume data, open, high, low, close, volume, OHLCV, quantitative traders often incorporate fundamental data, company F, financials, earnings reports, balance sheets, economic indicators, GDP, inflation, and news sentiment. Alternative data, non-traditional data sources like satellite imagery, tracking retail traffic, social media sentiment, or credit card transaction data. The principle of garbage in, garbage out applies emphatically to quantitative trading. A sophisticated algorithm built on poor quality or insufficient data will inevitably produce unreliable results. Algorithms, the decision-making engine. In quantitative trading, an algorithm is a precise, step-by-step set of instructions designed to solve a problem or perform a computation. Crucially, these algorithms function as models that transform input data into actionable output signals. Consider a simple scenario. An algorithm might take historical price data as input, apply a mathematical rule, and then output a buy or sell signal. This process is entirely deterministic. Given the same input, the algorithm will always produce the same output. Quantitative algorithms can range from very simple rules to highly complex machine learning models. Here are some conceptual examples. Trend-following algorithms seek to profit from sustained price movements. A common example involves moving averages. If a short-term moving average crosses above a long-term moving average, it might signal an uptrend. Mean reversion algorithms, assume that prices will eventually revert to their historical average. If a price deviates significant TLY from its average, the algorithm might bet on it returning. Arbitrage algorithms exploit small price discrepancies for the same asset across different markets or instruments. To illustrate, let's consider a very basic conceptual algorithm based on a simple if-then rule. This is not a complete trading system, but demonstrates the core logic of how an algorithm processes input to generate a signal. Download the code on one patch code Substack. This first code segment defines a function code snippet that encapsulates a common trend following rule, the moving average crossover. It takes three pieces of input data: the code snippet, a shorter-term average, and the code snippet, a longer-term average. The function's purpose is to output a clear code snippet, or code snippet signal. Download the code on one patch code Substack. This second chunk demonstrates how the code snippet function would be used with different sets of input data, representing various market scenarios. The output clearly shows how the algorithm translates the raw moving average values into a concrete trading instruction. This simple example illustrates how algorithms derive, buy, or sell signals directly from model outputs based on predefined logic. Backtesting, simulating the past to inform the future. Once an algorithm is developed, it must be rigorously tested before being deployed with real capital. This crucial step is called backtesting. Backtesting involves simulating the trading strategy on historical market data to evaluate its performance as if it had been traded in the past. The process of backtesting is a form of simulation. It takes historical price data, applies the algorithm's rules to it chronologically, and records every hypothetical trade, its entry and exit points, and the resulting profit or loss. This allows quant traders to analyze key metrics such as total profit/loss, maximum drawdown, largest peak to trough decline, Sharpe ratio, risk-adjusted return, win rate, average trade duration. Conceptual illustration of backtesting simulation. Imagine you have a stock's historical daily closing prices for the last 5 years. A backtest would proceed as follows. 1. Initialize. Start on the first day of your historical data. Set your initial capital. 2. Iterate day by day. For each subsequent day in the historical data. Receive data. The algorithm receives the market data available up to that day, e.g., today's closing price, yesterday's moving averages. Generate signal. The algorithm applies its rules to this data and generates a code snippet signal. Execute. Hypothetically, if a code snippet signal is generated, the backtesting engine records a hypothetical by order at the day's closing price or next open, depending on the model. If a code snippet signal, a hypothetical sell order, is recorded. Update portfolio. The backtesting engine updates your hypothetical portfolio's cash and SD. OK holdings, accounting for the trade and any associated transaction costs. Record performance. The engine tracks profits, losses, and other metrics daily. 3. End simulation. Once the end of the historical data is reached, the backtest concludes, and a comprehensive performance report is generated. This iterative process of model development and backtesting is crucial. It's not a one-time event, but a continuous cycle. 1. Formulate hypothesis based on market observations or theoretical insights. 2. Develop algorithm. Translate the hypothesis into a precise set of trading rules. 3. Backtest. Run the algorithm on historical data. 4. Analyze results. Evaluate performance metrics. 5. Refine parameters/rules. Based on analysis, fine-tune existing parameters or modify the algorithm's rules to improve performance or reduce risk. 6. Rebacktest. Repeat the process with a refined strategy. This iterative refinement helps to optimize strategies, but it also carries significant risks if not managed carefully. Common pitfalls in algorithmic strategy development. While backtesting is essential, it's not without its dangers. 2 significant pitfalls that can lead to misleading results are overfitting and survivorship bias. Overfitting. Overfitting occurs when an algorithm is too closely tailored to the specific historical data it was tested on, including its random noise and idiosyncratic patterns. As a result, the strategy performs exceptionally well during the backtesting period, but fails to generalize and performs poorly when applied to new, unseen market data, i.e., in live trading. Think of it like a student who memorizes answers to a practice test instead of understanding the underlying concepts. They might ace the practice test but fail the actual exam if the questions are slightly different. In trading, an overfit model has essentially memorized the historical price movements rather than identifying robust, repeatable patterns. To mitigate overfitting, quantitative traders employ techniques such as out-of-sample testing, holding back a portion of the historical data, e.g., the most recent 20 to 30%, that the algorithm has never seen during development. The final strategy is only tested on this unseen data. Cross-validation, dividing the historical data into multiple subsets and testing the strategy on different combinations of these subsets. Simpler models. Often, simpler models with fewer parameters are less prone to overfitting than overly complex ones. Survivorship bias. Survivorship bias occurs when a backtest or analysis only includes data from assets, e.g., stocks, funds, that have survived up to the present day, ignoring those that have delisted, gone bankrupt, or merged. This creates an upward bias in historical performance, as the data set implicitly excludes failures. For example, if you backtest a strategy on a list of S&P 500 companies today, you're only looking at companies that have successfully remained in the index. Ignoring all the companies that were once in the S&P 500 but were removed due to poor performance or bankruptcy. This makes your strategy look better than it would have in reality, as it never encountered the periods of severe decline or complete loss associated with the failed companies. To counter survivorship bias, it's crucial to use survivor bias-free datasets that include delisted securities and account for corporate actions accurately. Other common pitfalls include look-ahead bias, using future information that would not have been available at the time of the simulated trade. Transaction costs, failing to adequately account for commissions, fees, and slippage, the difference between the expected price of a trade and the price at which the trade is actually executed. Market impact, assuming that large orders can be executed without moving the market price, which is often not true for significant trades. Practical applications of algorithmic trading. The concepts of quantitative and algorithmic trading have profound practical applications across the financial industry. Automated trading systems, executing trades without human intervention, often for speed, precision, and consistency. This can range from simple rule-based systems to complex high-frequency trading, HFT, strategies that execute thousands of trades per second. Algorithmic financial market forecasting, developing models to predict future price movements, volatility, or other market conditions. Risk management, implementing systematic strategies to manage and mitigate portfolio risk, such as dynamic hedging or rebalancing. Portfolio management, automating the rebalancing of investment portfolios to maintain target asset allocations or optimize risk-adjusted returns. Market making, providing liquidity to markets by simultaneously quoting both buy and sell prices for an asset, profiting from the bid-ask spread. As we progress through this book, we will delve deeper into the practical implementation of these concepts, primarily using the Python programming language, which is a powerful tool for quantitative analysis and algorithmic trading. Overview of quantitative trading. Quantitative trading, often referred to as algorithmic trading or quant trading, is a systematic approach to financial trading where strategies are developed and executed using mathematical models, statistical analysis, and computational tools. Unlike discretionary trading, which relies on human judgment and intuition, quantitative trading aims to remove emotional biases by automating decision-making processes based on predefined rules and data analysis. The primary purpose of quantitative trading is twofold: to generate code snippet, excess returns above a benchmark, and to manage code snippet effectively. This systematic approach leverages significant computational power and vast amounts of data to identify trading opportunities, predict market movements, and execute trades with speed and precision. The implementation of these sophisticated strategies heavily relies on programming languages like Python, which provide the necessary libraries and frameworks for data manipulation, statistical modeling, and automated execution. Key components of a quantitative trading strategy. Developing a robust quantitative trading strategy involves a structured workflow, encompassing several interconnected stages. Each stage is critical for the overall success and reliability of the trading system. 1. Data collection and pre-processing. The foundation of any quantitative trading strategy is data. Traders require access to diverse, high-quality data CES, which often include tick-by-tick price data, historical financial statements, news feeds, and alternative data. Given the vast amounts of input data involved, this stage necessitates robust data infrastructure and efficient data handling techniques. Collection. Sourcing data from various providers, exchanges, data vendors, news APIs. This often means dealing with different data formats and delivery mechanisms. Pre-processing. Raw data is often noisy, incomplete, or inconsistently formatted. Pre-processing involves cleaning, handling missing values, removing outliers, correcting errors. Normalization. Scaling data to a common range to ensure fair comparison across different assets or indicators. Synchronization. Aligning data from different sources by time or event. This initial step is computationally intensive and requires careful attention to detail. A slight error in data pre-processing can lead to significant flaws in the subsequent analysis and trading decisions. For instance, if you're working with time series data, ensuring all timestamps are correctly aligned and that holidays or market closures are handled properly is crucial. While we won't dive into complex data pipelines here, conceptually, you might think of pre-processing as taking raw, messy information and making it ready for analysis. Download the code on one patch code Substack. This conceptual snippet illustrates the kind of type conversion and missing value handling that occurs during data prep. Assessing. In a real-world scenario, libraries like CodeSnippet would automate much of this. 2. Feature engineering. Raw data, even after cleaning, may not be directly useful for predicting market movements. Feature engineering is the art and science of transforming this raw data into meaningful code snippet or code snippet that highlight underlying patterns or provide predictive power for the model. This is a critical component because the quality of your features directly impacts the performance of your trading model. Poorly engineered features can lead to models that perform no better than random chance. Examples of engineered features include moving averages, calculating the average price over a certain period to smooth out price fluctuations and identify trends. Volatility measures, quantifying price fluctuations to assess risk or potential for large movements. Sentiment scores, analyzing financial news or social media to gauge market sentiment. Technical indicators, RSI, Relative Strength Index, MACD, moving average convergence divergence, Bollinger Bands, etc. The why behind feature engineering is that models learn from patterns. Raw price data alone might not explicitly show a trend or momentum, but a moving average crossover feature explicitly signals such an event. Download the code on one patch code Substack. This snippet conceptually shows how a raw list of prices can be transformed into a new, more informative feature, the simple moving average, which then be used by a trading model. 3. Model development. This stage involves constructing the core logic that will generate trading signals. There are broadly two types of approaches. Rule-based systems. These models rely on explicit, predefined rules set by the trader. The logic is transparent and directly interpretable. They are often built on technical analysis patterns, fundamental thresholds, or macroeconomic indicators. Example: buy shares of company X if its quarterly earnings exceed analyst expectations and its stock price is below its 200-day moving average. Or, more simply, If the 50-day moving average crosses above the 200-day moving average, issue a buy signal. Download the code on OnePageCode Substack. This is a clear, interpretable rule that directly dictates a trading action based on a specific condition. Data-driven systems. These models leverage machine learning or statistical techniques to learn complex patterns directly from the data. Instead of explicit rules, the model discovers relationships that might not be obvious to human observation. Examples: regression models for price prediction, classification models for buy-sell signals, neural networks, support vector machines. Black box nature. A common implication is their black box nature. While they can achieve high predictive accuracy, it can be challenging to understand why a data-driven model makes a particular decision. This lack of interpretability can make debugging difficult in MA. Why reduce confidence, especially in high-stakes trading environments? Understanding the limitations and interpretability challenges is crucial when using these models. 4. Backtesting. Once a model is developed, it must be rigorously tested using historical data to simulate its performance. Code snippet is the process of applying the trading strategy to past market data to see how it would have performed. It is a simulation and validation process that helps assess the potential profitability and risk characteristics of a strategy before deploying it with real capital. However, backtesting is prone to overfitting and survivorship bias, among other pitfalls. Overfitting, a model that performs exceptionally well on historical data but poorly on new, unseen data, is overfit. This often happens when a model learns noise or specific historical anomalies rather than generalizable patterns. Survivorship bias, using only data from currently existing assets, e.g., stocks, can skew results as delisted or bankrupt assets, which often perform poorly, are excluded. Look-ahead bias, accidentally using future information in your backtest, e.g., using a company's annual report released in January to make a trading decision in December of the previous year. Backtesting is an iterative nature process. Initial backtests often reveal weaknesses, leading to refinements in data processing, feature engineering, or model development, and then rebacktesting. This cycle continues until the strategy meets desired performance metrics and robustness criteria. Download the code on OnePageCode Substack. This conceptual loop illustrates how a backtesting system would iterate through historical data, making simulated trades based on the strategy's signals and tracking portfolio performance. 5. Optimization. Optimization is the refinement process for models and strategies. It involves tuning the parameters of the model or rules to improve performance. This can mean adjusting the look-back period for a moving average, setting thresholds for entry/exit signals, or fine-tuning hyperparameters of a machine learning model. The goal is to maximize desired outcomes, e.g., profit, Sharpe ratio, while minimizing undesirable ones, e.g., drawdown, volatility. Care must be taken during optimization to avoid code snippet, a form of overfitting, where parameters are so finely tuned to historical data that they perform poorly in live trading. 6. Execution. The final step is code snippet, where the trading signals generated by the model are translated into actual buy or sell orders and sent to the market. This stage involves order management, determining order size, type, market, limit, and routing. Trade execution, sending orders to brokers or exchanges via APIs. Monitoring, continuously tracking open positions, market conditions, and system performance. Automated execution is a hallmark of quantitative trading, allowing for high-speed trading and the ability to capitalize on fleeting opportunities that human traders might miss. Input data for quantitative trading. Quantitative trading strategies rely on diverse types of data to inform their decisions. These can be broadly categorized into 4 groups. 1. Market states. This category includes real-time and historical data directly related to market activity. Examples: price, open, high, low, close, volume, bid/ask quotes, order book depth, tick data. Conceptual signal derivation. A sudden increase in trading volume combined with a significant price surge might indicate a breakout, leading to a code snippet signal. Conversely, a sharp drop in volume during a price decline could signal a lack of support and a potential code snippet signal. 2. Financial news. News data encompasses qualitative and quantitative information derived from news articles, social media, and other textual sources. Examples: earnings announcements, mergers and acquisitions news, geopolitical events, company-specific headlines, sentiment scores derived from news analysis. Conceptual signal derivation. If a company announces unexpectedly positive quarterly earnings that significantly exceed analyst expectations, a strategy might generate a code snippet signal, anticipating a positive market reaction. Conversely, negative news like a product recall could trigger a code snippet signal. 3. Fundamentals. Fundamental data pertains to a company's financial health, economic indicators, and industry trends. Examples: REVE, new, earnings per share, EPS, price to earnings, PE ratio, debt to equity ratio, interest rates, GDP growth, inflation. Conceptual signal derivation. A strategy might generate a code snippet signal for a stock if its PE ratio is significantly lower than its industry average, while its revenue growth consistently outperforms competitors, indicating a potentially undervalued asset. 4. Technicals. Technical data refers to indicators derived from historical price and volume data, used to identify patterns and predict future price movements. Examples: moving averages, MA, relative strength index, RSI, moving average convergence divergence, MACD, Bollinger Bands, Fibonacci retracements. Conceptual signal derivation. A common technical signal is a golden cross, where the 50-day moving average crosses above the 200-day moving average. This pattern is often interpreted as a bullish signal, leading to a code snippet decision. Conversely, a death cross, 50-day MA crossing below 200-day MA, is considered bearish and could trigger a code snippet signal. Visualizing the quantitative trading process. Figure 1. 1 provides a high-level visual summary of the quantitative trading process. It illustrates how diverse input sources, market states, financial news, fundamentals, and technicals feed into a code snippet. This central processing unit then analyzes the data and produces a code snippet as its output. This conceptual flow underlies all quantitative trading strategies, regardless of their complexity, computational resources, and infrastructure. Handling the vast amounts of input data and executing complex models often requires significant computational resources. This includes powerful servers, high-speed network connections, and specialized databases optimized for time series data. While this book will focus on the conceptual and programming aspects, it's important to recognize that a robust data infrastructure is a prerequisite for successful large-scale quantitative trading operations. Future discussions will touch upon how Python can interface with such systems. Model development workflow. The development of a quantitative trading model, particularly one employing supervised machine learning, follows a structured and iterative workflow. This process involves defining the model structure, feeding it data, evaluating its performance, and systematically refining its internal components until it achieves satisfactory predictive capabilities. Understanding this workflow is fundamental to building effective automated trading strategies. Core components of a supervised learning model. At its heart, a supervised machine learning model can be conceptualized as a mathematical function that maps input data to an output prediction. This function is defined by 2 primary elements: its architecture and its parameters. Model as a mapping function. Mathematically, we can represent a model's prediction as code snippet. Let's break down these components. Code snippet. These are the input features, also commonly called independent variables or predictors. In quantitative trading, code snippet could represent historical stock prices, trading volumes, technical indicators like moving averages or RSI, macroeconomic data, or even sentiment analysis scores. Code snippet is the data the model uses to make its prediction. Code snippet. This is the model's prediction, also called the estimated output. This is what the model believes the target value will be given the input features. For example, code snippet might be the predicted next-day price. Movement, the probability of a stock going up, or buy a sell signal. Code snippet, theta, these are the model's parameters, also called weights or coefficients. These are the internal, tunable components of the model that are learned from the data during the training process. They determine how the input features are transformed into the prediction. Unlike features, parameters are internal to the model and are adjusted during training. Code snippet. This represents the model's architecture or hypothesis function. This is the specific mathematical or algorithmic structure of the model. For instance, code snippet could define a linear regression model, a neural network with a certain number of layers and neurons, a decision tree, or support vector machine. The choice of code snippet dictates the type of relationship the model can learn between code snippet and code snippet. It is crucial to distinguish between code snippet, the input data, and code snippet, the internal, learned components of the model. Features describe the characteristics of the data point you're trying to predict, while parameters define how the model uses those characteristics to make a prediction. Training data, input features, and target labels. To enable the model to learn, we provide it with code snippet. This dataset consists of pairs of input features, code snippet, and their corresponding actual, known outcomes, called code snippet, or dependent variables, ground truth, actual values. Training data, a collection of historical examples used to teach the model. Input features, code snippet, the observable data points or characteristics for each example in the training set. Example in quant trading. For a model predicting stock price movements, code snippet might include code snippet, previous day's closing price. Code snippet, volume traded. Code snippet, 5-day moving average. Code snippet, relative strength index, RSI. Target labels, code snippet, the actual, correct outcome associated with each set of input features in the training set. This is what the model is trying to predict. Example in quant trading. For the same stock price movement prediction, code snippet could be the actual next day's closing price. A binary label, 0 or 1, indicating if the price went up, 1, or down, 0. The percentage change in price. Consider a very simple conceptual model, predicting the next day's stock price using only the current day's price. This could be modeled as a linear relationship. Code snippet. Here, code snippet is our input feature code snippet. Code snippet is our target label code snippet, and code snippet are our model parameters code snippet. The iterative training process. Model training is an iterative feedback loop designed to optimize the model's parameters, code snippet, so that its predictions, code snippet, align as closely as possible with the true target labels, code snippet, in the training data. This loop typically involves 3 key steps. 1. Making predictions. 2. Quantifying error, cost function. 3. Optimization and parameter adjustment. Step 1. Making predictions. Using the current set of parameters, the model takes the input features, code snippet, from the training data and generates a prediction, code snippet. Initially, with randomly initialized parameters, these predictions will likely be far from the actual target labels. Let's illustrate with a simple linear regression model where we predict code snippet based on a single feature code snippet using the equation code snippet. Download the code on OnePatchCode Substack. In this initial step, our simple linear model takes the code snippet and, using its current parameters, code snippet and code snippet, calculates a code snippet. For instance, if code snippet is 100, the prediction is code snippet. Step 2. Quantifying error, cost function. After making predictions, the next crucial step is to evaluate how wrong these predictions are. This is done using a code snippet, also known as a code snippet or code snippet. The cost function quantifies the discrepancy between the model's predictions, code snippet, and the actual target labels, code snippet. The goal of training is to minimize this cost. Different types of problems require different cost functions. Mean squared error, MSE, commonly used for code snippet tasks, predicting continuous values like stock prices. It calculates the average of the squared differences between predictions and actual values. Squaring the error penalizes larger errors more heavily and ensures all errors are positive. Formula: code snippet. Code snippet: number of data points. Code snippet: actual target value for data point. Code snippet. Code snippet: predicted value for data point. Code snippet. Binary cross-entropy. Log loss often used for code snippet tasks, predicting one of two categories like price goes up or price goes down. It measures the performance of a classification model whose output is a probability value between 0 and 1. Formula: for a single data point. Code snippet. Code snippet: actual label 0 or 1. Code snippet: predicted probability between 0 and 1. Let's continue with our linear model example and calculate the mean squared error. Download the code on OnePatchCode Substack. Here we compare our code snippet, e.g. code snippet, against the code snippet, e.g. code snippet. The code snippet value, in this case, would be very high, indicating that our initial parameters are poor. Step 3. Optimization and parameter adjustment, the feedback loop. This is the core of the learning process. Code snippet is the algorithmic process of iteratively adjusting the model's parameters, code snippet, to minimize the calculated cost function. This forms a continuous code snippet. 1. Prediction. Make predictions using current parameters. 2. Evaluation. Calculate the cost, error. 3. Adjustment. Update parameters based on the cost, aiming t, or reduce it. 4. Repeat. Go back to prediction with the new parameters. The most common family of optimization algorithms used in machine learning is code snippet and its variants, e.g., ATOM, RMSprop. Gradient descent, conceptual explanation. Imagine the cost function as a landscape with hills and valleys, where the lowest point is the minimum cost. Gradient descent is like a blindfolded person trying to find the lowest point in this landscape. At each step, they feel the slope gradient around them and take a small step in the steepest downhill direction. Gradient. The gradient of the cost function with respect to each parameter tells us two things. 1. The direction in which the cost increases most rapidly. 2. The magnitude of that increase. Parameter update. To minimize the cost, we move in the opposite direction of the gradient. The size of a step taken is controlled by a code snippet, a small positive number, typically between 0.001 and 0.1. A larger learning rate means bigger steps, potentially reaching the minimum faster but risking overshooting. A smaller learning rate means slower but more precise convergence. The update rule for each parameter code snippet is typically code snippet, where code snippet is the partial derivative of the cost function with respect to parameter code snippet. This derivative tells us how much the cost changes when code snippet changes. Let's show a conceptual single step of parameter adjustment for our simple linear model. Using gradient descent. For a linear model code snippet and MSE cost, the gradients are code snippet. Code snippet. Download the code on OnePatchCode Substack. After one iteration, we can observe that the code snippet is lower than the code snippet, indicating that the model has learned slightly better parameters. This process is repeated thousands or millions of times until the cost function converges to a minimum, or a predefined number of iterations is reached. Model architecture. The code snippet in our code snippet notation, defines the fundamental structure and complexity of the relationship the model can learn. It's not something that's learned from data, like parameters, but rather something chosen by the model developer. For simple models, for linear regression, the architecture is simply the linear equation itself. For polynomial regression, it's the degree of the polynomial. For complex models, in neural networks, the architecture involves choices like number of layers, depth, number of neurons in each layer, width, activation functions used by neurons, connections between layers. For other algorithms, for a decision tree, the architecture relates to how deep the tree can grow or how many leaves it can have. Choosing an appropriate architecture is a critical step, often based on the nature of the data, the complexity of the underlying problem, and empirical experimentation. An architecture that is too simple might not capture complex patterns, leading to code snippet. An architecture that is too complex can lead to code snippet. Addressing challenges, overfitting. One of the most significant challenges in model development, especially in quantitative trading, is code snippet. Overfitting occurs when a model learns the training data too well, capturing not only the underlying patterns, but also the random noise and specific idiosyncrasies present only in that particular training set. Why overfitting occurs and its implications. Memorization versus generalization. An overfit model is like a student who has memorized all the answers to a specific test, but doesn't truly understand the subject matter. When presented with new, unseen questions, data, they perform poorly. Learning noise. Training data always contains some level of random noise. An overly complex model, or one trained for too long, can start to interpret this noise as meaningful patterns. Poor out-of-sample performance. The most dangerous implication of overfitting is that the model will perform exceptionally well on the data it was trained on in sample performance, but will fail drastically when applied to new, unseen data out of sample performance. In quantitative trading, this means a strategy that looked profitable during backtesting might lose money rapidly in live trading. Mitigating overfitting, validation, and test sets. To combat overfitting and ensure that our model generalizes well to unseen data, we typically split our available data into three distinct sets. 1. Training set. The largest portion of the data, e.g., 60 to 80%, used to train the model and adjust its parameters. 2. Validation set. A smaller portion of the data, e.g., 10 to 20%, used to tune hyperparameters, settings that control the training process, like learning rate or regularization strength, and to monitor the model's performance during training. If the model's performance on the training set continues to improve, but its performance on the validation set starts to worsen, it's often a sign of overfitting and training should be stopped. 3. Test set. An independent, unseen portion of the data, e.g., 10 to 20%, used only once at the very end of the development process to provide an unbiased evaluation of the final model's performance. This set simulates real-world, unseen market conditions. The workflow then becomes train on the training set, use the validation set to guide hyperparameter tuning and early stopping, and finally, evaluate the truly optimized model on the test set. This disciplined approach ensures that the model's reported performance is a realistic indicator of its potential in live trading. Institutional algorithmic trading. Large financial institutions, such as pension funds, mutual funds, and sovereign wealth funds, operate with distinct objectives when it comes to algorithmic trading. Unlike retail traders, or even many hedge funds that primarily seek to generate direct trading profits, institutional trading desks often prioritize cost minimization and risk mitigation when executing large orders. Their primary goal is to efficiently deploy capital, rebalance portfolios, or manage cash flows with minimal disruption to the market and at the best possible average price. Institutional objectives, cost, and risk minimization. The sheer size of institutional orders means that a single large trade can significantly impact market prices if executed carelessly. This leads to several critical concerns. Execution risk. The risk that an order will not be filled at the desired price or within the desired time frame. This includes the risk of adverse price movements during the execution window. Price impact. The temporary or permanent change in a security's price caused by the execution of an order. Large orders can push prices up for buys or down for sells, leading to worse execution prices for the institution itself. Slippage. The difference between the expected price of a trade and the price at which the trade is actually executed. Slippage is a direct consequence of price impact and market volatility, often resulting in higher costs. Consider an institution need. ING to buy 1 million shares of a particular stock. If they place a single market order for this entire quantity, it would likely overwhelm the available liquidity in the order book, driving the price up significantly and resulting in a much higher average purchase price than initially expected. Algorithmic strategies are employed to mitigate these risks by carefully managing how and when large orders are introduced to the market. Managing large orders, iceberg orders. One of the fundamental techniques for managing large institutional orders is the use of iceberg orders. An iceberg order is a large single order that has been divided into smaller, more manageable visible portions, with the majority of the order remaining hidden from the market. Only a small part of the total quantity is displayed in the order book at any given time. As soon as a visible portion is filled, a new portion automatically appears until the entire quantity is executed. This strategy helps to minimize price impact. By only revealing a small part of the total order, the institution avoids signaling its full trading intent, which could otherwise cause adverse price movements. Reduce market awareness. Competitors and high-frequency traders are less likely to front-run or react to the institution's large order if they are unaware of its full size. Improve execution price. Spreading the execution over time and across different price levels can lead to a better average execution price. The decision O. F. How to split an iceberg order. How large each visible portion should be, and when to reveal the next portion, is a complex optimization problem that involves balancing the desire for quick execution against the need to minimize market impact. Let's illustrate the concept of an iceberg order with a simplified Python simulation. We'll start by showing a common conceptual pitfall in sampling, and then correct it, progressively building a more realistic simulation. Simulating iceberg order generation. Initial concept. Imagine a code snippet representing the full quantity of shares an institution wants to trade. An iceberg order exposes only a fraction of this. A common conceptual approach might be to randomly select some portions from the total. Download the code on one Pagecode Substack. In this initial step, we define a code snippet and then create a conceptual representation of it as code snippet. For demonstration, we're assuming each chunk is a small, manageable unit, e.g. 1,000 shares, that makes up the total order. Common pitfall: sampling values versus sampling indices. A frequent misunderstanding arises when trying to select a part of the total order. If we intend to select which parts of the original order, represented by their positions or indices, should be exposed, we must sample from the indices of the list, not the values within the list. Consider the following attempt to select in iceberg order using code snippet. Download the code on one Pagecode Substack. CK. As highlighted in the professor's analysis, code snippet returns code snippet unique elements, values, from code snippet. If code snippet contains code snippet might return code snippet. This is problematic because code snippet and code snippet are values from the list, not necessarily the indices code snippet and code snippet. If our intent is to get the chunks at the 0th and 4th positions, this method is unreliable and conceptually flawed. Correcting the sampling for indices. To correctly select specific chunks or portions of the order by their position, we need to sample from the code snippet of the list's length, which represents the valid indices. Download the code on one Pagecode Substack. By sampling from code snippet, we ensure that code snippet contains valid, unique positions within our code snippet list. We then use NumPy's powerful array indexing capabilities to retrieve the actual chunks corresponding to these indices. This is the correct conceptual foundation for managing order portions. Simulating iterative iceberg order execution. A more realistic iceberg order simulation involves iteratively revealing and executing portions until the total order is filled. This requires tracking the remaining quantity and dynamically exposing new parts. Download the code on one Pagecode Substack. This simulation introduces an code snippet class to encapsulate the order's attributes. It then iteratively exposes a code snippet, or less if it's the final portion, and simulates its execution. Each step represents a new slice of the iceberg order being revealed and filled. This approach demonstrates how a large order is broken down and managed over time, mimicking the core principle of iceberg orders. The code snippet also provides a hint of how prices might fluctuate during execution, leading to varying average prices. Specialized venues, dark pools. While iceberg orders help manage visibility on public exchanges, institutions also leverage dark pools, also known as dark liquidity pools or non-displayed liquidity pools. These are private forums for trading securities that are not accessible to the investing public. They allow institutional investors to trade large blocks of shares without revealing their intentions to the broader market, thus minimizing market impact and slippage. Mechanics. Orders placed in dark pools are not displayed in the public order book. Only participants who match criteria, e.g., price and size, will be notified of a potential match. Trades are executed at a price derived from the prevailing public market price, e.g., the midpoint of the best bid and offer on a lit exchange. Dark pools are typically operated by large banks or brokers. Pros: reduced market impact. The primary benefit, as large orders don't influence public prices. Lower transaction costs. Often, dark pools offer lower fees compared to public exchanges, and trading at the midpoint of the bid-ask spread can reduce effective costs. Cons: lack of transparency. The non-transparent nature can make price discovery less efficient for the broader market. Information leakage risk. While designed to be private, there's always a risk of information leakage if the pool operator or other participants misuse the data. Regulatory scrutiny. Due to their opacity, dark pools are under close scrutiny by regulators to ensure fair and orderly markets. Common institutional execution algorithms. Beyond simple iceberg orders, institutions employ sophisticated algorithms to achieve specific execution objectives. These algorithms are designed to balance various factors like speed, cost, and market impact. Volume-weighted average price, VWAP. VWAP is a trading benchmark that represents the average price a security traded at throughout the day, weighted by volume. Institutional traders use VWAP algorithms to execute large orders over a period, typically a day, with the goal of achieving an average execution price that is as close as possible to the market's VWAP for that period. This strategy aims to avoid moving the market price and ensure that the order is executed fairly in line with market activity. Calculation. VWAP is calculated by summing the dollar value of trades, price x volume, for every transaction and then dividing by the total volume over a specified period. $text VWAP equals \frac \sum \text price I \times \text volume I \sum \text volume I where $text price I is the price of each trade. $text volume I is the volume of each trade. Practical application. A VWAP algorithm will typically slice a large order into smaller pieces and release them to the market throughout the day, attempting to match the historical or predicted volume profile of the stock. For example, if a stock typically trades more volume in the morning and afternoon, the algorithm will try to execute more shares during those periods. Let's implement a simple function to calculate VWAP from a series of simulated trades. Download the code on OnePatchCode Substack. We start by setting up some simulated market data using a Pandas data frame, which is a common and efficient way to handle structured data in quantitative finance. This data includes code snippet and code snippet for different hypothetical trade intervals. Download the code on OnePatchCode Substack. The code snippet function takes lists of prices and volumes, computes the sum of price volume, and divides it by the total volume, as per the VWAP formula. This provides the benchmark price for the given period. Time-weighted average price, TWAP. TWAP is another execution algorithm that aims to distribute a large order evenly over a specified time period. Unlike VWAP, which considers volume, TWAP simply divides the total order quantity by the number of time intervals in the execution window. Calculation. $text TWAP equals \frac \sum \text price at \text number of intervals $. This is a simpler average price, but in the context of an execution algorithm, The goal is to achieve an average execution price close to the TWAP of the market during the execution period. Practical application. A TWAP algorithm will execute a fixed quantity of shares at regular intervals, e.g., 1,000 shares every 5 minutes, until the entire order is filled. This is simpler to implement than VWAP and is often used when a market's volume profile is unpredictable or less relevant, or for smaller orders where market impact is less of concern. Let's simulate a simplified TWAP execution strategy. Download the code on OnePageCode Substack. The code snippet function sets up the parameters for the simulation. Code snippet, and code snippet. It calculates how many intervals there will be in the fixed code snippet to be traded. Download the code on OnePageCode Substack. The loop iterates through the calculated number of intervals, executing a fixed quantity in each. It simulates price fluctuations and records the execution details. It also includes a basic mechanism to handle any remaining quantity from integer division to ensure the code snippet is fully executed. Finally, it calculates and prints the code snippet for the entire TWAP strategy. Other common institutional algorithms include POV, percentage of volume executes orders at a certain percentage of the total market volume for that security. Adaptive algorithms dynamically adjust their execution strategy based on real-time market conditions, e.g., volatile. ITY, liquidity. Liquidity-seeking algorithms actively probe the market for available liquidity, often across multiple venues, including dark pools. Arbitrage in an institutional context. While retail traders might associate arbitrage with exploiting tiny price differences for direct profit, institutions often use arbitrage strategies for risk management or portfolio rebalancing, rather than pure directional profit. For instance, statistical arbitrage, identifying statistically mispriced assets or pairs of assets, then taking long/short positions to profit from their convergence. Institutions might use this to hedge existing positions or to rebalance a large portfolio. Index arbitrage, exploiting discrepancies between the price of an equity index futures contract and the underlying basket of stocks. This is often used to keep large portfolios aligned with an index. Cross-exchange arbitrage, exploiting price differences for the same asset listed on different exchanges. For institutions, this might be used to rebalance inventory across different trading venues or to ensure best execution across markets. The focus shifts from simply making money on the spread to ensuring optimal portfolio construction, minimizing tracking error, or efficiently moving large blocks of assets. The programmatic identification of these opportunities requires constant monitoring of market data, sophisticated data processing, and ultra-low latency infrastructure. Let's consider a conceptual example of cross-exchange arbitrage. Download the code on OnePageCode Substack. This conceptual function simulates checking prices on two different exchanges for the same asset. If the price difference exceeds a predefined code snippet, it identifies a potential arbitrage opportunity. In a real-world scenario, the execution would need to be near simultaneous and account for transaction costs, latency, and available liquidity on both exchanges. The window for such opportunities is often measured in microseconds. Market microstructure and quantitative methods. Institutional algorithmic trading is deeply intertwined with market microstructure, which studies the detailed process of exchange and the factors affecting price formation and trading costs. Key aspects include order book dynamics, understanding how buy and sell orders are placed, matched, and canceled influences optimal order placement and execution. Algorithms constantly monitor the depth and liquidity of the order book. Latency, the speed at which market data is received and orders are sent, is paramount. Institutions invest heavily in colocation and high-speed networks to minimize latency. Tick size and spreads. The minimum price increment and the bid-ask spread directly impact trading costs and the viability of certain strategies. Quantitative methods, such as dynamic programming and optimal control theory, are often used to develop advanced order splitting strategies. These methods aim to find the optimal path for executing a large order over time, considering factors like expected market impact, volatility, and remaining time to execution. For example, an optimal control model might dynamically adjust the rate of order submission based on real-time market conditions to minimize a cost function that includes both market impact and variance of execution price. These are complex mathematical models that go beyond simple rule-based algorithms, allowing for adaptive and sophisticated execution. The role of a quantitative trader. A quantitative trader, often simply called a quant, operates at the intersection of finance, mathematics, and computer science. Unlike traditional discretionary traders who rely heavily on intuition and fundamental analysis, quants employ rigorous, data-driven methods to identify trading opportunities, develop automated strategies, and manage risk. Their primary objective is to generate profits by exploiting market inefficiencies, often through the systematic execution of complex models. The role demands a unique blend of analytical prowess, programming skill, and a deep understanding of financial markets. Quants are essentially problem solvers, continuously seeking to uncover patterns, predict market movements, and design robust systems that can execute trades at high speed and scale. Core responsibilities. The daily activities of a quant trader can vary significantly depending on the specific desk or firm, e.g., prop trading firm, hedge fund, investment bank. However, common responsibilities include strategy research and development. This is the core intellectual work. It involves hypothesis generation, data collection, statistical analysis, model building, e.g., for prediction, optimization, or pricing, and backtesting to evaluate potential profitability and robustness of trading ideas. Strategy implementation and optimization, translating successful models into executable code. This often involves working with low-latency SIST, MS, and ensuring efficient, reliable execution. Continuous optimization of existing strategies based on market conditions and performance feedback is also crucial. Risk management, developing and applying quantitative methods to monitor, measure, and manage various types of risk, market risk, credit risk, operational risk, liquidity risk. This includes setting stop-loss levels, position sizing, and portfolio rebalancing rules. Data analysis and management, sourcing, cleaning, transforming, and analyzing vast data sets, from tick data to fundamental economic indicators and alternative data sources. Performance monitoring and attribution, tracking the performance of live strategies, understanding sources of profit and loss, and identifying areas for improvement or potential issues. Market monitoring, staying abreast of global economic news, market events, and technological advancements that could impact trading strategies. Essential skills for a quantitative trader. A successful quant trader possesses a multidisciplinary skill set. These can broadly be categorized into technical and soft skills. Technical skills. These are the foundational capabilities required to perform the core functions of the role. 1. Mathematical modeling and quantitative analysis. At the heart of quantitative trading is the ability to conceptualize, formulate, and apply mathematical models to financial problems. This involves more than just understanding formulas. It's about translating real-world market dynamics into abstract, mathematical representations that can be analyzed and solved. Statistical models, essential for understanding data distributions, relationships, and making predictions. Time series analysis, techniques like autoregressive integrated moving average, ARIMA, generalized autoregressive conditional heteroscedasticity, GRCH, and state-space models are used to analyze and forecast financial data, which inherently has temporal dependencies. For example, predicting future volatility or price movements. Regression analysis, linear, logistic, and nonlinear regressions for identifying relationships between variables, e.g., how a company's earnings surprise impacts its stock price, or how macroeconomic factors influence market indices. Hypothesis testing, rigorously testing trading ideas and assumptions to ensure statistical significance and avoid spurious correlations or overfitting. Machine learning models, increasingly vital for identifying complex, nonlinear patterns in large data sets that traditional statistical methods might miss. Supervised learning, for tasks like predicting asset prices, regression, or classifying market regimes, classification. Examples include random forests, gradient boosting machines, GBMs, and neural networks. These models learn from labeled historical data to make predictions on new, unseen data. Unsupervised learning, for tasks like clustering assets into groups based on their price movements or identifying anomalies in trading behavior that might signal market manipulation or unusual events. Reinforcement learning, for developing adaptive trading agents that learn optimal strategies through interaction with a market environment, receiving rewards for profitable actions and penalties for losses. Optimization techniques, used for portfolio construction, risk management, and strategy allocation. Linear and nonlinear programming, for optimizing portfolio weight subject to various constraints, e.g., maximizing return for a given risk level, minimizing tracking error relative to a benchmark. Stochastic optimization, for problems involving uncertainty, common in financial modeling, such as optimizing investment decisions under uncertain future market conditions. Stochastic calculus and probability theory, fundamental for understanding asset price dynamics, e.g., Brownian motion, derivatives pricing, e.g., Black-Scholes model for options, and advanced risk modeling. 2. Programming and software development. Programming is the language through which quantitative ideas are translated into actionable trading strategies. Quants are not just users of software. They are developers who build the tools and systems they use. Common programming languages. Python, widely popular due to its extensive libraries for data analysis. Code snippet, code snippet. Scientific computing, code snippet. Machine learning, code snippet, code snippet, code snippet. And visualization, code snippet. Code snippet. It's often used for research, rapid prototyping, backtesting, and sometimes even live trading, especially for less latency-sensitive strategies. C++, the industry standard for high-frequency trading, HFT, and low-latency systems where every microsecond matters. Its performance, memory control, and ability to interact directly with hardware make it indispensable for execution engines, market data handlers, and core trading infrastructure. R, strong for statistical computing and graphics, particularly favored in academic research and quantitative finance for complex statistical modeling and data visualization. Java, used in some financial institutions for building large-scale, enterprise-level trading systems, risk management platforms, and middleware due to its robustness, scalability, and cross-platform compatibility. Version control. Proficiency with systems like Code Snippet is crucial for collaborative development, tracking changes, managing codebases effectively, and ensuring reproducibility of research. Database skills. Knowledge of SQL and NoSQL databases for efficient storage, retrieval, and management of vast financial datasets. Let's illustrate a very basic data analysis task using Python, which is a common first step for any quant. Download the code on OnePageCode Substack. This initial Python snippet simulates a common starting point for a quant, obtaining and loading historical price data. In a real-world scenario, this data would come from a financial data provider or an internal database. The use of a code snippet data frame is standard for handling time series data efficiently due to its powerful indexing and manipulation capabilities. Download the code on OnePageCode Substack. Building on the loaded data, this chunk demonstrates two fundamental calculations: the simple moving average, SMA, and daily returns. The SMA helps to smooth out price fluctuations and identify underlying trends, while daily returns are crucial for risk and performance analysis. This shows how a quant would begin to transform raw price data into more informative features for further analysis or model input. Notice how code snippet values are code snippet for the first code snippet entries, because there aren't enough data points to compute the average. 3. Data analysis and feature engineering. Beyond basic calculations, quants perform deep data analysis to extract meaningful insights and create features that can be fed into models. Statistical inference, drawing conclusions about a population from sample data, critical for validating trading hypotheses and assessing the significance of observed patterns. Time series analysis, understanding concepts like stationarity, autocorrelation, and co-integration, which are vital for modeling financial series accurately and avoiding misleading correlations. Feature engineering, the art and science of creating new input variables, features, for machine learning models from raw data. This could involve combining existing data, applying mathematical transformations, or deriving new indicators. For example, creating volatility measures, e.g., historical volatility, implied volatility, momentum indicators, e.g., relative strength index, RSI, or analyzing order book imbalances. Consider how a quant might identify a potential signal from the data. Download the code on OnePatchCode Substack. This segment introduces the concept of generating a trading signal. Here, a very basic moving average crossover strategy is used. By when the price is above its SMA, sell when below. The critical step of code snippet is included to prevent look-ahead bias, ensuring that the signal for a given day is based only on information available before that day's trading decision. This highlights the importance of rigorous methodology in quant research to ensure that backtest results are realistic. 4. Backtesting and simulation. Backtesting is the process of testing a trading strategy on historical data to see how it would have performed. It's a crucial step before deploying any strategy live, allowing quants to evaluate potential profitability and identify flaws. Robust backtesting frameworks. Understanding how to build or use platforms that accurately simulate market conditions, account for transaction costs, commissions, exchange fees, slippage, the difference between the expected price of a trade and the price at which the trade is actually executed, and other real-world frict. IANS. Performance metrics. Evaluating strategies using metrics beyond just total profit. Key metrics include Sharpe ratio, risk-adjusted return, Sortino ratio, downside risk-adjusted return, maximum drawdown, largest peak-to-trough decline, Kalmar ratio, and win rate. Download the code on OnePatchCode Substack. This final code chunk in the sequence simulates the returns of the hypothetical trading strategy based on the generated signals. It calculates both daily strategy returns and cumulative returns, which are essential for evaluating overall performance against a benchmark, the market itself. In a real backtest, a quant would add more sophisticated logic for order execution, transaction costs, and proper risk management, but this serves as a conceptual foundation for understanding how signals translate into hypothetical profits or losses. 5. Risk management. Risk management is paramount in quantitative trading. It's not just about making money, but about doing so in a controlled, sustainable, and repeatable manner, protecting capital during adverse market conditions. Position sizing. Determining the appropriate amount of capital to allocate to a trade based on risk tolerance, strategy characteristics, and current market volatility. This helps prevent overexposure to any single trade or asset. Stop loss and take profit levels. Predefined price points at which a trade is automatically exited to limit potential losses or secure profits. These are often integrated directly into the automated trading system. Portfolio risk metrics. Calculating and monitoring metrics like value at risk, VAR, conditional value at risk, CVR, and tracking error. These provide a quantitative measure of potential losses over a specified time horizon and confidence level. Diversification and hedging. Combining assets or strategies with low correlation to reduce overall portfolio risk. Hedging involves taking offsetting positions to mitigate specific risks, e.g., using options to hedge against a stock price drop. Soft skills and mindset. While technical skills are non-negotiable, soft skills often differentiate truly successful quants and enable them to navigate the demanding environment of financial markets. Intellectual curiosity, the drive to constantly learn, explore new ideas, question assumptions, and delve into complex problems. Markets are dynamic, and trading strategies can decay. Continuous learning and adaptation are vital. Problem-solving aptitude, the ability to break down complex, ill-defined problems into manageable parts, develop creative and efficient solutions, and iterate on them. This often involves debugging code, refining models, and troubleshooting live systems. Attention to detail. Small errors in data collection, code logic, or model assumptions can lead to significant financial losses. Meticulousness in all aspects of research and implementation is critical. Resilience and emotional discipline. Trading environments are high-Res sure and involve periods of losses and uncertainty. A quant must be able to stick to their models, avoid impulsive decisions driven by fear or greed, and manage stress effectively. Handling high pressure. This manifests in situations like market crashes or unexpected volatility spikes, where others might panic. The quant must trust their risk models and predetermined exit strategies. Sticking to a programmed stop-loss, even when it feels counterintuitive in the moment, is a prime example of emotional discipline. Avoiding cognitive biases. Quants must be aware of and actively mitigate common biases like confirmation bias, seeking only data that supports their view, anchoring bias, over-relying on initial information, or overconfidence. Their reliance on data and models helps, but constant self-reflection and adherence to a systematic process are still needed. Communication skills. While often seen as solitary, quants need to communicate complex quantitative ideas clearly and concisely to non-technical stakeholders, e.g., portfolio managers, investors, sales teams, and collaborate effectively with other quants, software developers, and traders. Practical applications and a day in the life. Quantitative traders apply their skills across various financial products and market conditions, often developing specialized strategies. Examples of applications. Statistical arbitrage, identifying temporary mispricings between highly correlated assets, e.g., pairs trading where two stocks historically move together, but one temporarily deviates. The quant would buy the underperforming asset and sell the outperforming one, expecting them to converge. Market making, providing liquidity to the market by simultaneously quoting bid, buy, and ask, sell prices for a security, profiting from the bid-ask spread. This often involves complex inventory management, risk control, and extremely low latency systems to react to market changes faster than competitors. Algorithmic execution, breaking large institutional orders into smaller pieces to minimize market impact, the effect of a large trade on the asset's price, and achieve optimal execution prices. Algorithms like volume-weighted average price, VWAP, or time-weighted average price, TWAP, are common. Derivatives pricing and hedging, developing sophisticated models to price complex options, futures, and other derivatives, and designing dynamic strategies to hedge their associated risks, e.g., delta hedging, gamma hedging. Macro trading, building models that analyze macroeconomic data, e.g., GDP, inflation, interest rates, employment figures, to predict broader market movements, currency fluctuations, or commodity price trends. A glimpse into a quant trader's day. While highly variable, depending on the firm and role, a typical day for a quant trader might involve morning, pre-market reviewing overnight market movements, checking the performance of live strategies from the previous day, analyzing New York's significant news events or economic data releases, and performing system health checks to ensure all trading infrastructure is operational. Trading hours, monitoring live strategies for unexpected behavior, market anomalies, or technical issues. This isn't usually manual trading. It's supervising automated systems and intervening only if predefined thresholds are breached or critical errors occur. They might also be actively researching new strategy ideas or refining existing ones based on real-time data and market observations. Afternoon/evening, post-market deep dive into performance attribution, debugging any issues that arose during the day, backtesting new hypotheses, optimizing parameters of existing models, and preparing research reports. This is often the prime time for focused development and research, away from the immediate noise and demands of live markets. Ongoing, continuous learning through reading academic papers, attending industry conferences, collaborating with colleagues on complex problems, and contributing to the firm's overall quantitative research efforts. Acting swiftly with self-developed programs. The phrase "act swiftly using self-developed programs" refers to the crucial role of automated trading systems and low-latency infrastructure, particularly in competitive markets where speed is a significant advantage. Low-latency systems. For many quantitative strategies, especially in high-frequency trading, speed is paramount. This involves co-location, physically placing trading servers within the same data centers as exchange matching engines to minimize network latency, the time it takes for data to travel. Direct market access, DMA, connecting directly to exchanges rather than through intermediaries, reducing order routing delays and giving quants more control over their orders. Optimized code and hardware, using highly efficient programming languages like C++, optimized algorithms, and specialized hardware, e.g., field programmable gate arrays, FPGAs, to process market data and execute trades in microseconds or even nanoseconds. Automated execution. Once a model identifies an opportunity, the self-developed program automatically generates and sends orders to the market without human intervention. This ensures consistent, emotionless execution at speeds impossible for humans. For instance, if a statistical arbitrage model detects a mispricing, the program instantly sends buy and sell orders to capitalize on it before the inefficiency disappears. This automation minimizes human error and allows for simultaneous management of numerous strategies. Career path and progression. The career path for a quant trader often begins after obtaining advanced degrees in quantitative fields such as mathematics, physics, computer science, engineering, or quantitative finance. Junior quant trader/analyst. Entry-level roles involve assisting senior quants with data cleaning, backtesting, implementing parts of strat, EGs, and performing routine analysis. This stage focuses on building foundational knowledge and practical skills within a specific trading desk. Quant trader/researcher. With experience and a proven track record, quants take on more responsibility for developing and managing their own strategies. They conduct independent research, build complex models from scratch, and contribute significantly to the firm's profitability. Senior quant trader/portfolio manager. Highly experienced quants may manage their own books of strategies with significant capital allocations, lead teams of junior quants, or transition into quantitative portfolio management roles where they oversee a broader range of quantitative investments. Head of Quant Research/Chief Investment Officer, CIO, at the pinnacle, quants might lead entire quantitative research departments, set the strategic direction for quantitative trading within a firm, or become chief investment officers, CIOs, responsible for the firm's overall investment strategy and performance. The journey requires continuous skill development, adaptability to changing market conditions, and a strong track record of generating profitable strategies while managing risk effectively. Major asset classes and derivatives. Understanding the fundamental building blocks of financial markets, the various asset classes and derivatives, is paramount for any aspiring quantitative trader. Before developing sophisticated models or executing algorithmic strategies, one must possess a clear and precise understanding of what is being traded, how these instruments behave, and their inherent characteristics. This section provides a foundational overview, defining the major categories of financial instruments and highlighting their relevance from a quantitative trading perspective. Categorization of financial instruments. Financial instruments can be broadly categorized based on their underlying economic function and characteristics. While many classifications exist for the purpose of quantitative trading, we often group them as follows. Equities represent ownership in a company. Fixed income represent debt instruments. Commodities represent raw materials. Currencies, Forex, represent exchange rates between national currencies. Real estate, often accessed indirectly through specialized investment vehicles. Pooled investment vehicles, funds that combine capital from multiple investors. Derivatives, financial contracts whose value is derived from an underlying asset. These categories offer distinct risk-reward profiles, liquidity characteristics, and sensitivities to various economic factors, all of which are critical considerations for quantitative strategy development. Equities, stocks. Equities, commonly known as stocks or shares, represent an ownership stake in a company. When you buy a share of stock, you become a part owner of that company, entitling you to a claim on its assets and earnings. Characteristics and markets. Stocks are known for their potential for capital appreciation and, in some cases, dividend income. Their prices are influenced by company performance, industry trends, economic conditions, and market sentiment. Volatility. Stock prices can fluctuate significantly, offering opportunities for profit, but also posing considerable risk. Larger, established companies typically exhibit lower volatility than smaller, growth-oriented firms. Liquidity. The ease with which a stock can be bought or sold without significantly affecting its price varies widely. Major company stocks, e.g., Apple, Microsoft, are highly liquid, while smaller, less-known companies might have very low liquidity. Markets. Stocks are primarily traded on organized stock exchanges such as the New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, LSE, and Tokyo Stock Exchange, TC. These exchanges provide a centralized marketplace, facilitating price discovery and trade execution. Long and short positions. A core concept in trading any asset is understanding long and short positions, which dictate how a trader profits or loses from price movements. Long position. This is the most common approach, where a trader buys a stock with the expectation that its price will increase. They aim to sell it later at a higher price. Profit. Selling price, buying price, number of shares. Loss. Buying price, selling price, number of shares, if selling price is lower. Let's illustrate a long position with a simple Python function to calculate profit or loss. Download the code on OnePageCode Substack. This initial code snippet sets up a basic representation of a stock using a Python dictionary. It then defines a function, code snippet, which takes the entry and exit prices, along with the quantity of shares, to compute the profit or loss from a long position. Download the code on OnePageCode Substack. Here, we apply the code snippet function to a concrete example, demonstrating both a profitable and a losing scenario for buying and then selling Apple shares. Short position involves selling a stock that you do not own, typically borrowed from a broker, with the expectation that its price will decrease. The goal is to buy it back later at a lower price and return the borrowed shares, pocketing the difference. This is often referred to as short selling. Profit. Selling price, buying price to cover. Number of shares, if buying price to cover is lower. Loss. Buying price to cover, selling price. Number of shares, if buying price to cover is higher. Short selling carries theoretically unlimited risk, as a stock's price can rise indefinitely. Download the code on OnePageCode Substack. This function, code snippet, is designed to compute the profit or loss from a short position. Notice the reversal in the calculation. Profit occurs when the entry price, the price at which you shorted, is higher than the exit price, the price at which you bought back to cover. Download the code on OnePageCode Substack. These examples demonstrate how a short position profits when the stock price falls and incurs a loss when the stock price rises, reinforcing the inverse relationship compared to a long position. Quant trader interest in equities. Quantitative traders are highly interested in equities due to their dynamic behavior and the vast amount of available data. Trend following and mean reversion. Strategies that aim to capture persistent price movements or exploit temporary deviations from historical average. Statistical arbitrage. Identifying mispricings between highly correlated stocks or baskets of stocks. High-frequency trading. HFD exploiting tiny, fleeting price discrepancies or providing liquidity to the market. Factor investing. Building portfolios based on specific characteristics, factors like value, growth, momentum, or low volatility. Fixed income bonds. Fixed income instruments, primarily bonds, represent a loan made by an investor to a borrower, typically a corporation or government. In return for the loan, the borrower promises to pay regular interest payments, coupons, over a specified period and repay the principal face value, at maturity. Characteristic. CS markets. Bonds are generally considered less volatile than stocks, but their value is sensitive to interest rate changes and the creditworthiness of the issuer. Interest rate sensitivity. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive, thus pushing their prices down. Conversely, falling interest rates increase existing bond prices. This inverse relationship is fundamental. Credit risk. The risk that the bond issuer may default on its payments. This risk is reflected in the bond's yield. Higher risk typically means higher yield. Liquidity varies significantly. Highly liquid government bonds, e.g., U.S. Treasuries, are actively traded, while many corporate or municipal bonds might trade less frequently. Markets, primarily traded in over-the-counter, OTC, markets, meaning transactions occur directly between financial institutions rather than on centralized exchanges. Some government bonds and corporate bonds may also be listed on exchanges. Types of bonds. Government bonds, issued by national governments, e.g., U.S. Treasury bonds, UK gilts. Generally considered low credit risk, especially from stable governments. Corporate bonds, issued by companies to raise capital. Their risk depends on the company's financial health. Municipal bonds, issued by state and local governments, often offer tax advantages. Long and short positions in bonds. Long position, buying a bond with the expectation of receiving coupon payments and or selling it at a higher price if interest rates fall and bond prices rise. Profit, selling price, buying price, plus accumulated coupon payments. Loss, buying price, selling price, accumulated coupon payments. Short position, selling a borrowed bond with the expectation that its price will fall if interest rates rise, allowing it to be bought back at a lower price to cover the position. This is less common for retail investors, but can be done by institutions. Profit, selling price, buying back price, cost of borrowing. Loss, buying back price, selling price, plus cost of borrowing. Let's model a basic bond and calculate its yield to maturity, YTM, for conceptual understanding. YTM is the total return an investor can expect if they hold the bond until maturity. Download the code on OnePageCode Substack. This code block defines a dictionary to represent a U.S. Treasury bond with its key attributes. It then introduces code snippet, a function that provides a simplified calculation of a bond's yield to maturity, which is a crucial metric for bond investors. Download the code on OnePageCode Substack. By applying the code snippet function to our code snippet example, we can see how the bond's current price relative to its face value, alongside its coupon and maturity, influences its yield. A bond trading below its face value, like this example, will have a YTM higher than its coupon rate. Quant trader interest in fixed income. Quant. Traders use fixed income for various strategies. Interest rate strategies, betting on future movements of interest rates by taking positions in bonds of different maturities. Credit spread trading, profiting from changes in the difference in yields between bonds of different credit qualities, e.g., corporate versus government bonds. Arbitrage, exploiting mispricings between similar bonds or between bonds and their related derivatives. Relative value trading, identifying bonds that are mispriced relative to others in their sector or curve. Commodities. Commodities are basic goods used in commerce that are interchangeable with other goods of the same type. They are raw materials or primary agricultural products that can be bought and sold, such as crude oil, gold, wheat, and natural gas. Characteristics and markets. Commodity prices are highly sensitive to supply and demand dynamics, geopolitical events, weather patterns, and economic growth forecasts. Volatility can be extremely volatile due to unpredictable supply disruptions, changing demand, and speculative trading. Liquidity varies by commodity. Major commodities like crude oil, WTI, Brent, and gold are highly liquid, primarily traded via futures contracts. Markets. Commodities are mainly traded on specialized commodity exchanges, such as the New York Mercantile Exchange, NYMEX, Chicago Mercantile Exchange, CME, and Intercontinental Exchange, AC. Physical commodities are also traded OTC. Types of commodities. Hard commodities, mined or extracted, such as gold, silver, copper, crude oil, natural gas. Soft commodities, agricultural products or livestock, such as wheat, corn, coffee, sugar, live cattle. Long and short positions in commodities. Positions are typically taken through derivatives like futures contracts, discussed later, which function similarly to long/short stock positions, but with specific contract sizes and expiry dates. Long, bet on increasing commodity prices. Short, bet on decreasing commodity prices. Download the code on OnePageCode Substack. This code simply defines two commodity examples using dictionaries, illustrating their names, tickers, units of trade, and current prices. This basic representation is sufficient for understanding their attributes in a definitional context. Quant trader interest in commodities. Quantitative traders leverage commodities for macro strategies, trading based on global economic outlooks, inflation expectations, and geopolitical events. Inflation hedging, using commodities as a hedge against rising inflation. Supply/demand models, developing models to forecast commodity prices based on production, inventory, and consumption data. Spreading, trading the price difference between different delivery months of the same commodity, calendar spreads, or between related commodities, intercommodity spreads. Currencies. Forex, currency trading, also known as foreign exchange or forex, involves speculating on the exchange rate between two currencies. Currencies are always traded in pairs, e.g., euro to US dollar, Japanese yen to pound sterling, where the value of one currency is quoted against another. Characteristics and markets. The forex market is the largest and most liquid financial market globally, operating 24 hours a day, 5 days a week. Liquidity. Extremely high liquidity, especially for major currency pairs, e.g., euro to US dollar to Japanese yen, pound sterling to US dollar. This allows for large trades with minimal price impact. Volatility, influenced by interest rate differentials, economic data releases, inflation, GDP, employment, political stability, and central bank policies. Markets, primarily an over-the-counter, OTC, market dominated by large banks and financial institutions. Retail traders access this market through brokers. Long and short positions in currencies. When you trade a currency pair, you are simultaneously buying one currency and selling another. Long euro to US dollar. You are buying euros and selling US dollars. You profit if the euro strengthens against the US dollar, i.e., euro to US dollar exchange rate increases. Short euro to US dollar. You're selling euros and buying US dollars. You profit if the euro weakens against the US dollar, i.e., euro to US dollar exchange rate decreases. Download the code on OnePageCode Substack. This code defines a currency pair and then provides a versatile function, code snippet, which can compute profit or loss for both long and short positions in a currency pair based on the entry and exit exchange rates and the quantity of the base currency. Download the code on OnePageCode Substack. These examples apply the code snippet function to illustrate how a long position profits from an increase in the exchange rate, base currency strengthening, and a short position profits from a decrease, base currency weakening. Quant trader interest in currencies. Carry trade, borrowing in a low interest rate currency and investing in a high interest rate currency. Macroeconomic strategies, trading based on expectations of economic data releases and central bank policy. High-frequency arbitrage, exploiting tiny, transient discrepancies in exchange rates across different venues. Algorithmic execution, implementing sophisticated algorithms for large currency trades to minimize market impact. Real estate via REITs. While direct investment in physical real estate is generally illiquid and outside the scope of typical quantitative trading, real estate investment trusts, REITs, offer a liquid, publicly traded way to invest in real estate. Characteristics and markets. Definition: REITs are companies that own, operate, or finance income-producing real estate across a range of property sectors. They are legally required to distribute most of their taxable income to shareholders annually, making them attractive for income-focused investors. Liquidity. Unlike direct real estate, REIT shares are traded on major stock exchanges, offering high liquidity. Volatility. Influenced by interest rates, economy. See growth and the specific real estate sectors they operate in, e.g., residential, commercial, industrial. Markets. Traded on stock exchanges, e.g., NYSE, NASDAQ, similar to regular stocks. Long and short positions in REITs. Trading REITs is identical to trading common stocks. Long. Buy shares expecting price appreciation and dividend income. Short. Short sell shares expecting price depreciation. Download the code on one-page code Substack. This code block defines a simple REIT structure, illustrating its key attributes. While not requiring complex calculations for this definitional section, it provides a concrete example of how a REIT's data might be represented. Quant trader interest in REITs. Income strategies, focusing on REITs with stable dividend yields. Sector-specific plays, trading based on the performance and outlook of specific real estate sectors, e.g., industrial, residential, retail. Interest rate sensitivity, developing strategies around how REITs react to changes in interest rates. Pooled investment vehicles. Pooled investment vehicles gather money from many investors and invest it in a diversified portfolio of assets. They offer diversification, professional management, and economies of scale. Exchange-traded funds, ETFs. Definition. ETFs are investment funds that hold assets such as stocks, bonds, or commodities and are traded on stock exchanges throughout the day, much like ordinary stocks. They typically track an underlying index, e.g., S&P 500, NASDAQ 100. Characteristics. High liquidity. Because they trade on exchanges, ETFs generally offer high liquidity. Transparency. Their holdings are usually disclosed daily. Low fees. Most ETFs are passively managed and have lower expense ratios than actively managed mutual funds. Markets. Traded on major stock exchanges. Long/short. ETFs can be bought, long, or sold short, just like individual stocks. There are also inverse and leveraged ETFs that allow for more complex directional bets. Download the code on one-page code Substack. This simple dictionary structure represents an ETF, highlighting its key attributes like the index it tracks and its expense ratio. This provides a clear, concise data model for an ETF. Quant trader interest in ETFs. Broad market exposure. Gaining exposure to entire sectors, industries, or countries with a single trade. Sector rotation. Shifting investments between different industry sector ETFs based on quantitative signals. Arbitrage. Exploiting small price differences between an ETF and its underlying basket of securities, though this is mostly done by authorized participants. Thematic investing. Investing in specific themes, e.g., clean energy, artificial intelligence, through specialized ETFs. Mutual funds. Definition. Mutual funds are professionally managed investment funds that pool money from many investors to purchase securities. Unlike ETFs, they are typically priced once a day at the end of the trading day based on the IR net asset value, NAV. Characteristics. Less liquid than ETFs as they are bought and sold directly from the fund company, not on an exchange. Can be actively or passively managed. Markets. Purchased directly from the fund company or through brokers. Quant interest. Less relevant for active, high-frequency quantitative trading due to their daily pricing and redemption process. More suited for long-term portfolio allocation. Hedge funds. Definition. Private investment funds that employ diverse and often complex strategies, including leveraging and short selling, to generate high returns. They are typically open only to accredited investors and have less regulatory oversight than mutual funds. Characteristics. High minimum investments, high fees, e.g., 2 and 20, 2% management fee, 20% performance fee, and a wide range of strategies. Markets. Private funds, though their underlying trades occur in public markets. Quant interest. While not directly tradable by the general public, Many hedge funds employ sophisticated quantitative strategies and are major players in the quant trading world. Understanding their strategies is crucial for market participants. Derivatives. Derivatives are financial contracts whose value is derived from an underlying asset, group of assets, or benchmark. They are powerful tools for managing risk, hedging, or speculating on future price movements. Key concepts in derivative valuation. The value of a derivative is intrinsically linked to IT's underlying asset. However, other factors significantly influence its price. Underlying asset price, the most direct driver. Time to expiry. As a derivative approaches its expiration date, its value can change significantly, especially for options due to time decay. Volatility. Higher expected volatility in the underlying asset generally increases the value of options and futures. Interest rates affect the cost of carrying the underlying asset or the present value of future payoffs. Download the code on one patch code Substack. This code snippet provides a highly simplified, conceptual function to demonstrate that the value of a derivative is derived from its underlying asset. It's crucial to understand that real-world derivative pricing models are far more complex. Futures contracts. Definition. A futures contract is a standardized legal agreement to buy or sell a specific commodity, currency, or financial instrument at a predetermined price on a specified future date. Both parties are obligated to fulfill the contract. Characteristics. Standardized. Contracts have fixed sizes, quality, and delivery dates, making them highly liquid and tradable. Exchange traded. Traded on organized futures exchanges, e.g., CME, ICE. Mark-to-market. Profits and losses are settled daily, meaning gains are credited to your account and losses are debited. This minimizes counterparty risk. Markets. Futures exchanges. Long/short. Long futures. Obligation to buy. Profits if the underlying price rises. Short futures. Obligation to sell. Profits if the underlying price falls. Example. A crude oil futures contract for delivery in 3 months. Download the code on one patch code Substack. This code defines a futures contract with its typical attributes and then presents code snippet, a versatile function for computing profit or loss for both long and short futures positions, considering the contract size and number of contracts. Download the code on one patch code Substack. These examples illustrate how profits are generated for long futures positions when the price rises and for short positions when the price falls, scale by the contract size. Forwards contracts. Definition. Similar to futures, a forwards contract is an agreement to buy or sell an asset at a predetermined price on a future date. However, forwards are customized, OTC, over-the-counter, agreements between two parties. Characteristics. Non-standardized, illiquid, difficult to exit before maturity, and carry counterparty risk that the other party defaults. Markets. OTC market. Quant interest, less suitable for active trading due to lack of standardization and liquidity. More common in corporate hedging for specific, customized needs. Options contracts. Definition. An options contract gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price, the strike price, on or before a specific date, the expiration date. The seller of the option is obligated to fulfill the contract if the buyer chooses to exercise their right. Key terms. Premium. The price paid by the buyer to the seller for the option. Strike price. The price at which the underlying asset can be bought or sold if the option is exercised. Expiration date. The last day the option can be exercised. Underlying asset. The security, stock, ETF, commodity, etc., on which the option is based. Types. Call option. Give the holder the right to buy the underlying asset at the strike price. Buyers of calls expect the underlying price to rise. Put option. Gives the holder the right to sell the underlying asset at the strike price. Buyers of puts expect the underlying price to fall. European versus American options. The primary distinction lies in when the option can be exercised. European options can only be exercised on the expiration date. American options can be exercised at any time up to and including the expiration date. Many theoretical option pricing models, like Black-Scholes, are designed for European options due to their simpler exercise constraint. While American options offer more flexibility, this flexibility has a value that must be accounted for. For simplicity in introductory concepts, we often focus on the European options payoff structure by default. Long and short positions in options. Long call by call. Action. Pay premium to buy a call option. Expectation. Underlying price will rise significantly above the strike. Price. Profit. Unlimited potential. Underlying price. Strike price. Premium. Loss. Limited to the premium paid. Download the code on one patch code Substack. This code block defines a code snippet option with its key parameters. It then provides code snippet, a function that computes the profit or loss for a long call option at its expiration, illustrating that the option is only exercised if it's in the money. Underlying price, strike price. Download the code on one patch code Substack. These examples demonstrate the asymmetric payoff of a long call. Unlimited profit potential if the underlying rises significantly, but a limited loss, the premium, if it doesn't. Short call, sell call. Action. Receive premium to sell a call option. Expectation. Underlying price will stay below the strike price. Profit. Limited to the premium received. Loss. Unlimited potential if the underlying price rises significantly above the strike. This is a very risky position. Long put by put. Action. Pay premium to buy a put option. Expectation. Underlying price will fall significantly below the strike price. Profit. Significant potential. Strike price. Underlying price. Premium. Loss. Limited to the premium paid. Download the code on one patch code Substack. Similar to the call option, this code defines a code snippet option and a function to calculate its payoff for a long position at expiry. The key difference is that a put option becomes valuable when the underlying price FA. LLS below the strike price. Download the code on one patch code Substack. These examples demonstrate how a long put option provides a hedge against falling prices or a speculative bet on a downturn, with limited downside risk. Short put, sell put. Action. Receive premium to sell a put option. Expectation. Underlying price will stay above the strike price. Profit. Limited to the premium received. Loss. Significant potential if the underlying price falls significantly below the strike. Quant trader interest in options. Options are highly versatile and are central to many quantitative strategies. Volatility trading. Strategies that profit from changes in the implied volatility of the underlying asset, rather than just its direction. Income generation. Selling options, e.g., covered calls, cash-secured puts, to collect premiums. Hedging. Using options to protect existing portfolios from adverse price movements. Complex spreads. Combining multiple options, and sometimes the underlying asset, to create specific risk-reward profiles, e.g., iron condors, butterflies, straddles, strangles. Arbitrage. Exploiting mispricings between options and their underlying or between different options on the same underlying. Interplay of instruments and quant trading perspectives. The various asset classes and derivatives are not isolated. Quantitative traders frequently combine them to construct sophisticated strategies for various purposes. Hedging. Using derivatives, e.g., future, or options, to offset the risk of an existing position in an underlying asset. For example, a portfolio manager holding a large stock portfolio might buy put options or sell futures to protect against a market downturn. Arbitrage. Identifying and exploiting temporary price discrepancies between highly correlated assets or different forms of the same asset. This often involves simultaneous buying and selling to lock in a risk-free profit. Speculation. Taking directional bets on the future price movements of assets or their volatility, often using leverage provided by derivatives to amplify potential returns. Portfolio construction. Building diversified portfolios that balance risk and return across different asset classes, using quantitative models to optimize allocations. A deep understanding of each instrument's characteristics, liquidity, volatility, and typical market behavior is indispensable for developing and implementing robust quantitative trading strategies. The data generated by these instruments, from tick-by-tick price movements to volume and order book information, forms the raw material for all quantitative analysis and model development. Grouping tradable assets. Understanding how financial instruments are categorized is fundamental for any quantitative trader. These groupings are not merely academic classifications. They directly inform model selection, risk management strategies, and portfolio construction. Different asset characteristics necessitate different quantitative approaches. The fundamental groupings. Major asset classes. Financial assets are broadly categorized into four major classes based on their fundamental economic characteristics and risk-return profiles. Equities. Equities represent ownership stakes in a company. When you buy a stock, you purchase a share of that company's future earnings and assets. Characteristics. Ownership. Shareholders are residual claimants, meaning they have a claim on the company's assets and earnings after all other obligations are paid. Dividends. Companies may distribute a portion of their profits to shareholders as dividends, though this is not guaranteed. Capital gains. The primary return for equity investors often comes from the appreciation in the stock's price. Voting rights. Common stockholders typically have voting rights on corporate matters. Infinite life. Unlike bonds, stocks do not have a maturity date. Examples. Common stocks represent direct ownership and voting rights. Preferred stocks typically offer fixed dividend payments and have priority over common stockholders in receiving dividends and assets in liquidation, but usually no VOT. ING rights. Exchange-traded funds, ETFs, investment funds traded on stock exchanges, holding a basket of assets, e.g., stocks, bonds, commodities that track an index. Investing in an equity ETF provides diversified exposure to a specific market segment or theme. Quant relevance. Equities are central to many quantitative strategies, including alpha generation, developing models to predict future stock price movements. Statistical arbitrage, identifying temporary mispricings between highly correlated stocks or portfolios. Factor investing, constructing portfolios based on quantifiable characteristics, factors like value, momentum, or quality. Fixed income instruments. Fixed income instruments are debt securities where the issuer promises to pay the holder a fixed stream of payments, interest, over a specific period and repay the principal amount at maturity. Characteristics. Debt. Holders are creditors, not owners of the issuer. Fixed payments typically offer predictable income streams, coupons. Maturity date. A defined date when the principal is repaid. Credit risk. The risk that the issuer will default on its payments. Interest rate sensitivity. The value of fixed income instruments is inversely related to interest rates. Examples. Treasury bonds and notes, bills, issued by national governments, generally considered low credit risk. Corporate bonds, issued by corporations, with credit risk varying by company. Municipal bonds, issued by state and local government. Mints, often tax-exempt. Money market instruments, short-term debt instruments like commercial paper, certificates of deposit, CDs, and repurchase agreements, repos. Securitized products, debt instruments backed by a pool of assets, such as mortgage-backed securities, MBS, or asset-backed securities, ABS. Call d'avance. Yield curve strategies, trading based on expectations of how the yield curve will shift. Relative value, identifying mispricings between similar fixed income instruments. Duration hedging, managing interest rate risk by matching the duration of assets and liabilities. Credit spread trading, profiting from changes in the spread between corporate bond yields and government bond yields. Cash and equivalents. Cash and cash equivalents are highly liquid assets that can be readily converted into cash. They are typically short-term, low-risk investments. Characteristics: high liquidity, easily converted to cash without significant loss of value. Low risk, generally considered very safe investments, often serving as a proxy for the risk-free rate. Short-term, maturities are typically very short, e.g., less than 90 days. Examples: physical currency, bank notes and coins. Bank accounts, checking and savings accounts. Treasury bills, T-bills, short-term government debt. Commercial paper, short-term unsecured promissory notes issued by corporations. Money market funds, mutual funds that invest in short-term, highly liquid debt instruments. Entrelevanza, liquidity management, essential for ensuring a trading firm has sufficient funds to meet obligations. Short-term funding, used for overnight lending and borrowing. Risk-free rate proxy, often used as the benchmark for calculating risk-adjusted returns or for discount rates in valuation models. Alternative investments. Alternative investments encompass a broad category of assets that do not fall neatly into traditional classes like stocks, bonds, or cash. They often exhibit different risk-return characteristics and may offer diversification benefits. Characteristics: lower liquidity. Many alternative investments are illiquid, meaning they cannot be easily bought or sold. Complex structures often involve intricate legal and financial structures. Higher fees can involve higher management and performance fees. Diversification may have low correlation with traditional assets, offering portfolio diversification. Examples: hedge funds. While often referred to as an asset class, hedge funds are more accurately described as investment strategies that can employ a wide range of sophisticated techniques across various traditional and non-traditional asset classes. Examples include long/short equity, simultaneously buying undervalued stocks and short-selling overvalued ones. Global macro, making bets on macroeconomic trends, e.g., interest rates, currency movements. Event-driven, profiting from corporate events like mergers, bankruptcies, or spin-offs. Relative value, exploiting price discrepancies between related securities. Private equity, investments in companies not listed on a public exchange. This includes venture capital, funding for startup companies. Leveraged buyouts, LBOs acquiring mature companies using a significant amount of borrowed money. Real estate, direct investments investing directly in physical properties, e.g., commercial buildings, residential properties, rather than through publicly traded real estate investment trusts, REITs. Commodities, raw materials or primary agricultural products, such as precious metals, gold, silver, platinum. Energy, crude oil, natural gas. Agriculture, corn, wheat, soybeans. Structured products, complex financial instruments whose value is derived from an underlying asset, index, or basket of assets, often with embedded derivatives. Examples include collateralized debt obligations, CDOs, and collateralized loan obligations, CLOs. Algorithmic diversification. Adding alternative investments can help reduce overall portfolio volatility due to their low correlation with traditional assets. Non-traditional return sources can provide unique return streams not easily accessible through traditional markets. Complex modeling. Many alternative investments, especially structured products or complex hedge fund strategies, require sophisticated quantitative models for valuation, risk management, and performance attribution. Grouping by maturity character. Statistics. Another crucial way to group assets is by their maturity, which refers to the length of time until a debt instrument's principal is repaid or, for equities, how long capital is expected to be tied up. Short-term instruments generally have maturities of less than 1 year. These are often used for liquidity management and short-term financing. Examples: treasury bills, commercial paper, short-dated corporate bonds, money market funds. Long-term instruments have maturities greater than 1 year or, in the case of equities, an indefinite life. These are typically associated with longer-term investment horizons and higher interest rate sensitivity for fixed income. Examples: long-dated corporate bonds, government bonds, e.g., 10-year treasury bonds, equities, real estate. Algorithmic. Interest rate risk management. Maturity is a key determinant of a bond's sensitivity to interest rate changes, duration. Quants use this to manage interest rate risk in fixed income portfolios. Liquidity management. Short-term instruments are vital for managing a firm's cash flows and meeting immediate obligations. Term structure trading, strategies that exploit expected changes in the yield curve, which plots interest rates against maturities. Grouping by payoff linearity, a quant's core distinction. For a quantitative trader, the linearity of an asset's payoff function is one of the most critical distinctions. It directly dictates the complexity of the valuation model, the type of risk metrics needed, and the design of trading strategies. Linear payoffs. Definition. An instrument has a linear payoff if its profit or loss is directly proportional to the change in the underlying asset's price. For every dollar the underlying asset moves, the instrument's value moves by a fixed multiple. Examples: spot instruments, stocks, bonds, in a simplified view where only price changes matter, currencies, futures, and forwards, contracts to buy or sell an asset at a predetermined price on a future date. The profit/loss is simply the difference between the contract price and the underlying price at expiry. Implications for quants. Model-independent pricing, no arbitrage argument for many linear instruments. Their price can be determined using the no arbitrage principle. This means that if two financial instruments offer identical future cash flows or risk profiles, they must trade at the same price. If they didn't, an arbitrageur could exploit the difference for a risk-free profit, and market forces would quickly correct the mispricing. This allows for pricing without relying on complex assumptions about future volatility or distributions. Simpler valuation. Valuation often relies on cost of carry models, which consider the spot price, interest rates, and any income, e.g., dividends or storage costs. Strategy example. Simple arbitrage, futures. Consider a cash and carry arbitrage strategy for futures. If the theoretical no arbitrage P, price of a futures contract, derived from the spot price, risk-free rate, and time to maturity, differs significantly from its actual market price, an arbitrage opportunity may exist. Let's outline the core components for calculating a theoretical futures price. Download the code on one patch code Substack. This function calculates the theoretical futures price using a simplified, continuous compounding model. Code snippet is the current market price of the underlying asset. Code snippet is the annualized risk-free interest rate. And code snippet is the time remaining until the futures contract expires, expressed in years. The code snippet function handles the continuous compounding. Now, let's use this to identify a potential arbitrage. Download the code on one patch code Substack. In this segment, we set up a hypothetical scenario with a spot price, risk-free rate, and time to maturity. We then call our code snippet function to get the no arbitrage price and compare it to an assumed code snippet observed in the market. Finally, we determine if an arbitrage opportunity exists and what action to take. Download the code on one patch code Substack. This final block calculates the difference and outlines the specific actions for a cash and carry or reverse cash and carry arbitrage. If the actual futures price is higher than the theoretical price, you sell the overpriced futures and buy the spot asset, funding it by borrowing. If the actual futures price is lower, you buy the underpriced futures and short sell the spot asset, investing the proceeds. This demonstrates how quantitative analysis of linear payoffs can lead to concrete trading strategies. Non-linear payoffs. Definition. An instrument has a nonlinear payoff if its profit or loss is not directly proportional to the change in the underlying asset's price. The relationship is curved, often exhibiting convexity. Payoff accelerates with price movement, or concavity. Payoff decelerates. Examples. Options, calls, and puts. The classic example. A call option gives the holder the right, but not the obligation, to buy an underlying asset at a specified price, strike price, on or before a certain date. A put option gives the right to sell. Their payoffs are highly dependent on the underlying price relative to the strike price at expiry. Structured products with embedded options. Many complex financial products derive their nonlinear behavior from embedded options. Implications for quants. Complex modeling. Due to their nonlinear nature and sensitivity to factors like volatility and time decay, Options require more sophisticated valuation models. Models like the Black-Scholes-Merton model, binomial trees, or Monte Carlo simulations are commonly used. These models rely on assumptions about the underlying assets, price distribution, and volatility. Advanced risk management. The Greeks, traditional risk measures like beta or duration are insufficient. Quants rely on Greeks to understand and manage option risk. Code snippet. Sensitivity of the option price to a change in the underlying asset's price. Code snippet. Sensitivity of delta to a change in the underlying asset's price measures convexity. Code snippet. Sensitivity of the option price to a change in the underlying asset's volatility. Code snippet. Sensitivity of the option price to the passage of time decay. Code snippet. Sensitivity of the option price to a change in the risk-free interest rate. Strategy example. Options payoff diagram. Understanding nonlinear payoffs often begins with visualizing them. Let's plot the payoff of a simple long call option. Download the code on OnePageCode Substack. We start by defining the strike price and the premium paid for the call option. Then, we create an array code snippet representing a range of possible underlying asset prices at the option's expiration. This range will allow us to visualize the payoff across different scenarios. Download the code on OnePageCode Substack. Here, code snippet calculates the intrinsic value of the call option at expiry. If the underlying price code snippet is below the code snippet, the option expires worthless. Payoff is 0. If code snippet is above the code snippet, the payoff is code snippet. The code snippet then subtracts the initial code snippet to show the true profit or loss for the option holder. Download the code on OnePageCode Substack. This segment uses code snippet to plot the code SNI. Head against the various code snippet values. We add horizontal and vertical lines to indicate the zero profit line, the strike price, and the break-even point where the underlying price at expiry equals the strike price plus the premium paid. The resulting graph visually demonstrates the nonlinear, hockey stick-shaped payoff of a long call option. Limited downside, premium paid, and unlimited upside potential. This nonlinearity is what makes option pricing and risk management significantly more complex than for linear instruments. Grouping by market type. Assets can also be grouped by the type of market in which they are primarily traded, impacting their settlement processes and trading venues. Cash market, spot market. Definition. Transactions involve the immediate or very short-term delivery and settlement of the underlying asset. The price agreed upon is for current delivery. Characteristics. Immediate delivery. Settlement typically occurs within a few business days, e.g., T+2 for stocks. Direct ownership. Buyers take physical or beneficial ownership of the asset. Primary trading venues. Stock exchanges, bond markets, foreign exchange, FX, spot markets. Examples. Buying shares of Apple stock. Purchasing a U.S. Treasury bond, exchanging USD for Euro at the current spot rate. Quant de vente. Liquidity and market impact. Understanding the depth and liquidity of cash markets is crucial for executing large orders without significant price impact. Direct exposure. Provides direct exposure to the underlying asset's price movements. Derivative market. Definition. Transactions involve contracts whose value is derived from an underlying asset, index, or rate. Delivery and settlement occur at a future date, or the contract may be cash settled. Characteristics. Value derived. The derivative itself does not have intrinsic value. Its price is contingent on the underlying. Future delivery/settlement. Contracts mature at a future date. Leverage. Derivatives often allow for significant leverage, amplifying returns and losses for a relatively small initial outlay. Risk management. Widely used for hedging existing exposures or speculating on future price movements. Examples. Futures contracts, options contracts, swap agreements, e.g., interest rate swaps, credit default swaps. Quant de vente. Hedging. Derivatives are powerful tools for managing risk exposures, e.g., hedging currency risk with currency forwards, interest rate risk with interest rate swaps. Speculation. Quants can design strategies to profit from anticipated price movements using derivatives. Synthetic positions. Derivatives allow for the creation of synthetic positions that mimic the payoff of other assets or strategies, e.g., a synthetic long stock position using a long call and a short put. Complex pricing models. As discussed, nonlinear derivatives often require sophisticated models. Other important grouping criteria. While the above categories are fundamental, quantitative traders also consider other criteria to refine their analysis and strategy development. Liquidity. Definition. The ease with which an asset can be converted into cash without significantly affecting its market price. Highly liquid assets can be bought and sold quickly in large quantities. Coût de vente. Execution costs. Low liquidity can lead to higher bid-ask spreads and greater market impact costs when executing trades. Strategy design. High-frequency trading strategies are only viable in highly liquid markets. Illiquid assets might be suitable for long-term, value-oriented strategies. Risk management. Illiquidity risk, the inability to exit a position without a substantial loss, is a key concern. Geographic region. Definition. Grouping assets based on the country or region where the issuer is based, the asset is traded, or the primary economic influence lies. Coût de vente. Diversification. Diversifying across different regions can reduce country-specific risks. Macroeconomic analysis. Strategies can be built around regional economic forecasts or policy changes. Regulatory considerations. Different regions have different regulatory environments impacting trading. Sector/industry. Definition. Categorizing companies or assets based on their primary business activity, e.g., technology, healthcare, financials, energy. Coût de vente. Sector-specific strategies. Developing strategies that exploit trends or mispricings within a particular industry. Risk management. Assessing and managing concentration risk within a portfolio. Factor investing. Sector-specific factors or themes can be incorporated into models. Impact on quantitative portfolio management. The meticulous grouping of tradable assets directly influences how quantitative portfolios are constructed, managed, and rebalanced. Portfolio diversification. By combining assets from different classes, equities, fixed income, alternatives, or with varying characteristics, linear versus nonlinear, liquid versus illiquid. Quants can build diversified portfolios that aim to reduce overall risk for a given level of return. Understanding the correlation between different asset groups is key. Model selection. The characteristics of an asset class dictate the appropriate quantitative models. For instance, a linear regression model might be suitable for predicting stock returns based on factors, while a GRCH model might be used for forecasting volatility and Monte Carlo simulations for complex derivatives. Risk budgeting. Quant traders allocate risk across different asset classes or strategies based on their risk appetite and objectives. For example, a portfolio might allocate a certain percentage of its total risk budget to equities, another to fixed income, and a smaller portion to alternative investments, each with its own specific risk measures tailored to the asset type. Portfolio rebalancing. Asset groupings define the target allocations within a portfolio. When market movements cause these allocations to drift, quantitative systems trigger rebalancing actions to bring the portfolio back to its desired structure. This often involves selling overweight asset classes and buying underweight ones. To illustrate how a quant might conceptually group and store asset information, consider a simple Python class representing an asset with key characteristics. Download the code on OnePageCode Substack. We start by defining code snippet classes for code snippet, and code snippet. Using enumerations makes the code more readable, prevents typos, and ensures consistency when categorizing assets. Download the code on OnePageCode Substack. The code snippet class is designed to encapsulate the various characteristics discussed. It takes arguments for code snippet, and the previously defined code snippet types for code snippet, and code snippet. Optional parameters like code snippet, and code snippet are included to demonstrate how other grouping criteria can be incorporated. The code snippet method provides a structured way to output the asset's details. Download the code on one patch code Substack. In this final chunk, we create instances of code snippet for different financial instruments: an equity, a fixed income bond, a linear derivative, futures, and a nonlinear derivative, option. We then call the code snippet method for each, demonstrating how a quantitative system might and categorize assets based on these crucial characteristics. This structured approach is fundamental for building robust quantitative trading and portfolio management systems, allowing quants to filter, analyze, and apply appropriate models and strategies based on an asset's inherent nature. Common trading avenues and steps. Trading strategies. Market timing versus buy and hold. Understanding different investment philosophies is fundamental before diving into the mechanics of trading. Two primary strategies often contrasted are market timing and buy and hold. Market timing. Market timing is an investment strategy that attempts to predict future market movements, specifically the direction of prices of financial assets, and act on those predictions. The goal is to buy assets when prices are low and sell them when prices are high, thereby maximizing returns by avoiding downturns and capturing upturns. This strategy often involves technical analysis, studying historical price charts and trading volumes to identify patterns and predict future price movements. Fundamental analysis, analyzing economic indicators, company financials, and news events to determine the intrinsic value of an asset and predict its future performance. Quantitative models, using statistical and machine learning models to identify short-term anomalies or predict price changes. Challenges and risks of market timing. Despite its intuitive appeal, market timing presents significant challenges and risks. 1. High transaction costs. Frequent buying and selling incurs higher brokerage fees, commissions, and bid-ask spreads, which can significantly erode profits, especially for active traders. 2. Difficulty of consistent prediction. Financial markets are complex, influenced by innumerable factors, and often exhibit random walk characteristics. Consistently and accurately predicting short-term movements is exceedingly difficult, even for sophisticated quantitative models. Many studies have shown that very few professional money managers consistently outperform a simple buy-and-hold strategy after accounting for fees. 3. Behavioral biases. Human emotions often interfere with rational decision-making. Traders might be influenced by fear of missing out, FOMO, during market rallies, leading to buying at peaks or panic selling during downturns, locking in losses. 4. Tax inefficiency. Short-term capital gains are often taxed at higher rates than long-term capital gains in many jurisdictions, further reducing net returns from frequent trading. 5. Risk of missing rallies. Even brief periods of significant market gains can disproportionately contribute to overall returns. A market timer who is out of the market during these crucial periods can dramatically underperform. Buy and hold. The buy and hold strategy involves purchasing assets and holding them for a long period, regardless of short-term fluctuations. The premise is that over the long term, financial markets tend to appreciate, and short-term volatility is less relevant. This strategy relies on the power of compounding returns and avoids the costs and stresses associated with active trading. Advantages of buy and hold. Lower transaction costs. Infrequent trading means fewer fees and commissions. Tax efficiency. Assets held for longer periods often qualify for lower long-term capital gains tax rates. Simplicity. Requires less active monitoring and decision-making, reducing stress and time commitment. Compounding allows returns to compound over time, potentially leading to substantial wealth accumulation. Seasonality in trading. While consistent market timing is challenging, some market participants look for seasonality, which refers to predictable patterns in financial asset prices or trading volumes that recur at specific times of the year, month, or even day. These patterns are often attributed to institutional flows, large funds rebalancing portfolios at year-end or quarter-end, tax considerations, tax loss harvesting at year-end, or tax-related buying/selling around specific dates. Human psychology. holiday cheer leading to increased consumer spending, or a January effect, where small-cap stocks tend to outperform at the beginning of the year due to renewed investor interest and year-end tax selling reversals. Market microstructure, for example, a lunchtime lull, where trading activity slows down during midday hours as participants take breaks, potentially leading to lower liquidity and less price movement. While seasonality can provide interesting insights, relying solely on it for trading strategies can be risky as these patterns are not guaranteed and can change over time. Illustrative scenario: market timing versus buy and hold simulation. Let's use a simple Python simulation to illustrate the potential outcomes of a very basic market timing approach versus a buy and hold strategy. We'll generate hypothetical daily returns and apply a simple moving average crossover rule for market timing. First, we'll set up our environment and generate some simulated price data. We'll use code snippet for numerical operations and code snippet for data handling. Download the code on one Pagecode Substack. This initial code snippet sets up a simulated stock price series. We define in code snippet and then generate code snippet from a normal distribution. We then apply these returns cumulatively to the code snippet to create a code snippet, which is then converted into a code snippet with a date index for better organization. This simulates a plausible, albeit simplified, stock price movement over approximately 1 year. Next, we'll implement the buy and hold strategy. This is the simplest strategy. Invest at the beginning and hold until the end. Download the code on one Pagecode Substack. Here, the code snippet function takes our code snippet and simply computes the percentage change from the first price to the last price. This represents the total return an investor would achieve by buying the asset on day 1 and selling it on the last day of our simulation. Now, let's implement a very basic market timing strategy using a simple moving average, SMA, crossover. By signal, when the short-term SMA crosses above the long-term SMA. Sell signal, when the short-term SMA crosses below the long-term SMA. Download the code on one Pagecode Substack. This more complex function calculates two simple moving averages, SMAs, over different windows, code snippet and code snippet. It then generates a trading code snippet. 1 when the short SMA crosses above the long SMA, a bullish signal to buy or stay invested, and 0 when it crosses below, a bearish signal to sell or stay in cash. The code snippet column identifies the exact points where a trade, buy or sell, would occur. The code snippet simulation attempts to track the value, either by holding the asset or converting to cash, demonstrating how the market timing strategy would theoretically perform. Note, this is a simplified simulation and does not account for transaction costs, slippage, or reinvestment of dividends, which are critical in real-world trading. Finally, let's compare the results and visualize them. Download the code on one Pagecode Substack. This final segment prints a summary of the returns from both strategies and then visualizes the original price series alongside the simulated portfolio values for both the buy and hold and market timing strategies. The linear buy and hold path is a conceptual line from start to end, while the market timing portfolio value shows how the portfolio value would fluctuate based on the buy-sell signals. This visualization helps in understanding how different strategies navigate market fluctuations and their potential impact on portfolio value. As seen, even with a simple simulated example, market timing does not guarantee outperformance and can sometimes lead to lower returns due to missed opportunities or suboptimal entry/exit points. Common trading avenues. Financial markets are not monolithic. Trades occur across various venues, each with distinct characteristics regarding transparency, liquidity, and participant types. Understanding these avenues is crucial for a quantitative trader, as the choice of venue can significantly impact execution quality and strategy performance. Regulated exchanges. Regulated exchanges are centralized marketplaces where financial instruments are traded. They operate under strict regulatory oversight, e.g., SEC in the U.S., FCA in the U.K., to ensure fairness, transparency, and investor protection. Characteristics. Transparency. Orders, bids, and offers are publicly displayed in an order book providing real-time price discovery. Trade executions are also reported promptly. Liquidity typically offer high liquidity for actively traded instruments due to the concentration of trading interest. Standardization. Instruments traded are standardized, e.g., specific share classes, contract sizes for derivatives. Examples: New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, LSE, CME Group, for futures and options. Typical instruments: equities, exchange-traded funds, ETFs, options, futures, some bonds. Primary users: retail investors, institutional investors, hedge funds, high-frequency trading firms. Pros: high transparency, robust price discovery, strong regulatory oversight, generally good liquidity. Cons: potential for market impact for very large orders, as they are publicly visible, higher transaction costs for some types of orders compared to less regulated venues. Dark pools. Dark pools are privately operated electronic trading venues where participants can trade large blocks of securities anonymously without displaying their orders to the wider public. They're a type of alternative trading system, ATS. Reasons for existence: minimize market impact. Large institutional orders, e.g., buying millions of shares, if placed on a public exchange, could immediately move the market against the trader. Dark pools allow these orders to be executed without revealing the trading interest, thus minimizing price impact. Avoid front-running. By keeping orders anonymous, dark pools help prevent other traders from front-running large orders, i.e., trading ahead of a known large order to profit from the anticipated price movement. Price improvement. Some dark pools may offer opportunities for price improvement by matching orders at the midpoint of the national best bid and offer and BBO. Controversies. Lack of transparency. Their opacity makes it difficult for the public to gauge true supply and demand, potentially hindering efficient price discovery on public exchanges. Fairness concerns. Critics argue that they give an unfair advantage to large institutional investors over retail traders who only have access to public exchanges. Potential for predatory strategies. While designed to prevent front-running, some high-frequency trading firms might employ strategies to detect the presence of large orders in dark pools and trade around them. Typical instruments: equities, some derivatives. Primary users: large institutional investors, e.g., pension funds, mutual funds, hedge funds, looking to execute block trades. Pros: reduced market impact for large orders, anonymity, potential for price improvement. Cons: lack of transparency, potential for fragmented liquidity, regulatory scrutiny. Broker markets. In broker markets, trades are facilitated by a broker who acts as an intermediary between two parties looking to buy and sell. Unlike exchanges where orders are matched automatically, brokered trades often involve direct negotiation and discovery of counterparties by the broker. Characteristics. Intermediation. The broker actively seeks out a counterparty for a client's order, often leveraging their network of contacts. Negotiation. Prices and terms are often negotiated directly between the parties, with the broker facilitating the discussion. Less transparent. Orders are not publicly displayed, and trade details may not be immediately disseminated. Types of instruments/scenarios were predominantly used. Illiquid securities. Securities that trade infrequently or have small float, e.g., some municipal bonds, certain corporate bonds, private equity interests. Complex derivatives. Highly customized or bespoke derivatives contracts, e.g., exotic options, specific types of swaps that are not standardized for exchange trading. Large block trades. For extremely large orders in less liquid equities where even dark pools might not provide sufficient anonymity or liquidity. Private placements. Issuance of securities directly to a small number of investors without a public offering. Primary users. Institutional investors, corporations, high net worth individuals trading specialized or illiquid assets. Pros: access to specialized markets, ability to negotiate terms, suitable for illiquid or customized instruments. Cons: less transparency, higher transaction costs, broker commissions, potential for slower execution, Reliance on brokers' network. OTC markets, over-the-counter. The over-the-counter, OTC, market is a decentralized market where financial instruments are traded directly between two parties, without the supervision of an exchange. Trades are conducted between dealers who act as market makers, quoting prices at which they are willing to buy, bid, and sell. Ask. Characteristics. Decentralized, no central exchange. Trades occur via phone, email, or proprietary electronic networks. Dealer-centric. Dealers provide liquidity by quoting prices and holding inventories of securities. Less regulation. Can have less stringent regulatory oversight compared to exchanges, though major dealers are still regulated entities. Typical instruments. Currencies. Forex, the largest OTC market globally. Bonds. Most corporate and government bonds, other than a small fraction listed on exchanges, trade OTC. Derivatives. Many types of swaps and customized options. Unlisted stocks. Stocks of companies not listed on major exchanges, e.g., penny stocks, some small-cap companies. Advantages compared to exchange-traded markets. Customization. Ability to tailor contract terms, e.g., size, maturity, payment structure, to specific needs. Flexibility. Fewer rigid rules compared to exchanges. Access to niche markets. Allows trading in instruments not available on exchanges. Disadvantages compared to exchange-traded markets. Counterparty risk. The risk that the other party to the trade will default on their obligations. This is a significant concern and is often mitigated by collateral agreements or central clearing for some OTC derivatives. Less transparency. Prices are not publicly displayed, and it can be challenging to determine the best available price. Lower liquidity. For many instruments, liquidity can be lower than on exchanges, leading to wider bid-ask spreads. Higher spreads. Due to lower liquidity and less transparency, bid-ask spreads can be wider, increasing transaction costs. Comparative summary of trading avenues. Feature regulated exchanges, dark pools, broker markets, OTC markets. Transparency high, public order book, low, anonymous orders, low, negotiated, low, dealer quotes. Liquidity high for active assets, variable, depends on pool, low for specific assets, variable, FX high, others low. Typical instruments: equities, ETFs, futures, options, large blocks of equities, illiquid bonds, complex derivatives, private placement currencies, corporate bonds, swaps, unlisted stocks. Primary users retail, institution, HFTS large institution, HNWIs institution, corporation. Pros: price discovery, regulation, speed, minimize market impact, anonymity, tailored deals, access, illiquid assets, customization, flexibility, niche access. Cons: market impact for large orders, opacity, fairness concerns, slower, higher fees, less transparent, counterparty risk, less transparency, lower liquidity. Steps involved in performing a trade. Regardless of the trading venue or strategy, the execution of a trade typically follows a sequential life cycle. For quantitative traders, understanding these steps is crucial for designing robust and efficient automated trading systems. Each step, traditionally manual, is increasingly automated and optimized by technology. Step 1. Acquisition of information and quotes. This is the initial phase where a trader or an automated system gathers the necessary data to make a trading decision and understand current market conditions. Explanation. Information. This includes fundamental data, company earnings reports, economic indicators like GDP or inflation, interest rate announcements, news events, geopolitical developments, corporate announcements, analyst ratings, and alternative data, social media sentiment, satellite imagery, supply chain data. Quotes. Real-time market data, including bid, highest price a buyer is willing to pay, and ask, lowest price a seller is willing to accept, prices, volumes, and depth of the order book. Quant trading link, automation. Data collection. Automated systems use APIs, application programming interfaces, to subscribe to real-time market data feeds, e.g. from exchanges, data vendors like Bloomberg, Refinitiv, news feeds, and economic calendars. Feature engineering. Raw data is processed and transformed into actionable signals or features for trading models. This might involve natural language processing, NLP, for sentiment analysis of news, statistical analysis to identify trends, or machine learning models to predict price movements. Example: a quant system might constantly monitor a stock's order book depth, calculate its volatility, and simultaneously parse news headlines for keywords related to the company, all in real time. Price discovery. The continuous interaction of bids and offers from buyers and sellers, informed by new information, is how price discovery occurs. In an order-driven market, like most stock exchanges, prices are discovered through the matching of discrete buy and sell orders. In a quote-driven market, like OTC Forex, prices are discovered through the continuous quotes provided by market makers. The flow of information directly impacts these quotes and orders, leading to price adjustments. Let's illustrate a conceptual code snippet function for a quant system. Download the code on OnePageCode Substack. This code provides two conceptual functions, code snippet and code snippet. Code snippet simulates fetching real-time bid, ask, and volume data, which are crucial for understanding current liquidity and price levels. Code snippet conceptually represents the process of getting news and analyzing its sentiment, which can heavily influence trading decisions. In a real-world quant system, these would be sophisticated modules connecting to various data providers and employing advanced analytical techniques. Step 2. Routing of order. Once a trading decision is made, the next step is to send the order to the appropriate market venue for execution. Explanation. A trader submits an order to their broker, e.g., a buy order for 100 shares of XYZ. The broker then takes this order and routes it to an exchange, a dark pool, or another market maker for execution. The choice of venue depends on the order type, size, desired speed, and the broker's routing algorithms. Types of brokers. Discount brokers, primarily for retail investors offering basic trading platforms and low commissions, e.g., Robinhood, Charles Schwab. They typically route orders to venues that offer payment for order flow, PFOF, or their own internalizers. Full-service brokers offer research, financial advice, and personalized service in addition to trading, e.g., Merrill Lynch, Morgan Stanley. Institutional brokers cater to large funds and corporations, providing advanced trading tools, direct market access, and sophisticated routing capabilities, e.g., Goldman Sachs, J.P. Morgan. Smart Order Routing, SOR. For quantitative and algorithmic trading, smart order routing, SOR, systems are critical. An SOR is an automated system used by brokers and trading firms to determine the optimal venue for executing an order. Its goal is to achieve the best possible execution price and speed, while minimizing market impact and transaction costs. SOR systems consider various factors: current bid/ask prices across all venues, available liquidity at different price levels, venue fees, speed of execution, and the likelihood of execution at a specific venue. They can split large orders across multiple venues to find the best prices or hide the overall order size. Here's a conceptual representation of order routing. Download the code on OnePageCode Substack. This code snippet function demonstrates a simplified smart order router. It takes in code snippet object and code snippet as input. Based on the order's characteristics, e.g., code snippet, it makes a conceptual decision about where to send the order. For instance, large market orders might be preferentially routed to dark pools to minimize market impact, while smaller or limit orders might go to regulated exchanges for transparency and broader liquidity. Step 3. Execution of order. This is the point where the order is actually matched with the counterparty's order and the trade occurs. Explanation. Once an order reaches a market venue, it waits to be matched. For a market order, it will be executed immediately at the best available prices. For a limit order, it will only execute if the market price reaches or crosses the specified limit price. Market impact. For large orders, even when routed strategically, execution can still have a market impact, meaning the act of buying or selling moves the price against the trader. For example, a large buy order might consume all available sell orders at current prices and then walk up the order book, executing at progressively higher prices. This is known as slippage. Algorithmic trading's role. High-frequency execution engines. Quant firms often employ highly optimized, low-latency execution engines that can send and cancel orders in microseconds. Order slicing execution algorithms to mitigate market impact and slippage. Large orders are rarely sent as a single block. Instead, they are sliced into smaller, manageable chunks and executed over time using sophisticated algorithm. VWAP, volume-weighted average price, algorithms aim to execute an order over a period of time such that the average execution price is close to the volume-weighted average price of a market during that period. TWAP, time-weighted average price, algorithms distribute the order evenly over a specified time period. Iceberg orders, a type of limit order where only a small portion of the total order quantity is displayed publicly at time. As one visible portion is filled, another portion appears, like the tip of an iceberg. This minimizes revealing the full order size. Liquidity seeking. Algorithms constantly monitor liquidity across different venues and dynamically adjust order placement to capture the best prices and minimize impact. Let's simulate a simplified order execution process. Download the code on OnePageCode Substack. The code snippet function simulates the actual trade. For a market order, it assumes immediate execution at or very near the current ask price for a buy or bid price for a sell, including a small amount of slippage, the difference between the expected price and the actual execution price. For a limit order, it checks if the current market conditions meet the specified limit price for execution. This function highlights the immediate outcome of the order routing decision. Step 4. Confirmation, clearance, and settlement. After an order is executed, a series of post-trade processes ensure that the ownership of the asset and the corresponding cash are correctly transferred. Explanation. Confirmation. Immediately after execution, both the buyer and seller, or their brokers, receive confirmation of the trade details, including the asset, quantity, price, and time of execution. Clearance. This process involves verifying the trade details, calculating the obligations of both parties, e.g., how much money is owed, how many shares are to be delivered, and updating their respective accounts. Settlement. This is the final step where the actual transfer of ownership of the securities from the seller's account to the buyer's account occurs, and the corresponding cash payment moves from the buyer's account to the seller's account. This is often referred to as delivery versus payment, DVP. Typical settlement periods. T+2, trade date plus 2 business days, common for equities and corporate bonds in many markets, e.g., U.S., Europe. This means if you buy a stock on Monday, you officially own it and the cash is transferred by Wednesday. T+1, trade date plus 1 business day, common for government bonds and some money market instruments. T+0, trade date plus 0 business days / same day instantaneous settlement. Typical for spot foreign exchange, FX, transactions. Role of clearinghouses. Central counterparties, CCPs. Clearinghouses act as central counterparties, CCPs, in many markets. Once a trade is executed, the clearinghouse steps in and effectively becomes the buyer to every seller and the sell, or to every buyer, mitigating counterparty risk. By interposing themselves between the buyer and seller, clearinghouses guarantee the completion of the trade, even if one of the original parties defaults. This significantly reduces counterparty risk in the financial system. They achieve this through robust risk management practices, including requiring participants to post collateral, margins. Quant Trading Link automation. For automated trading systems, confirmation and settlement processes are often integrated. Systems automatically generate trade blotters, reconcile executed trades against expected fills, and prepare data for reporting to back-office systems that handle clearance and settlement. Automated reporting ensures compliance with regulatory requirements and accurate record-keeping for accounting and risk management. A conceptual function for the final settlement steps. Download the code on OnePageCode Substack. This code snippet function illustrates the final stages of a trade's lifecycle. It conceptually confirms the trade, simulates the clearance process, where obligations are calculated, and then initiates the settlement, mentioning the typical code snippet settlement periods. It also highlights the importance of automated reporting for back-office integration in a real quantitative trading setup. This entire sequence, from information acquisition to final settlement, forms the operational backbone that quantitative strategies rely upon to turn the ore, to call models into real-world market actions. Market structures. Defining market structure. The term market structure in finance refers to the set of rules, conventions, and operational procedures that govern how trading is conducted for a particular asset or within a specific venue. It encompasses everything from how buyers and sellers interact, how prices are determined, how orders are placed and matched, to the roles of intermediaries like brokers and market makers. For quantitative traders, understanding market structure is not merely academic. It is fundamental. The design, effectiveness, and profitability of any algorithmic trading strategy are directly tied to the specific market structure in which it operates. A strategy optimized for one market structure might perform poorly or even fail in another. Consider, for instance, an algorithm designed to provide liquidity by placing limit orders. Its success depends entirely on the presence of an order book where such orders can rest and be filled. Conversely, an algorithm designed for a market where only dealers quote prices would need a completely different approach to execution. This foundational knowledge allows quantitative traders to design execution algorithms that account for specific market rules, understand liquidity dynamics, optimize trade execution to minimize costs, and even develop high-frequency trading strategies. Call markets versus continuous markets. Financial markets can be broadly categorized based on when and how frequently trading occurs and prices are determined. Call markets. In a call market, trade for a particular asset are executed only at specific, predetermined times. All accumulated orders, both buy and sell, are brought together at these scheduled intervals, and a single price is determined that maximizes the number of trades or minimizes order imbalances. This price is then used to execute all matching orders. Characteristics. Periodic execution. Trading sessions are discrete and occur at fixed times, e.g., once a day, or at market open/close. Single clearing price. All transactions during a call auction occur at the same price. Order aggregation. Orders are collected over a period before being matched. High liquidity at specific times. All available liquidity is concentrated at the auction time, potentially leading to very tight spreads and significant trading volume at that single price. Examples. Stock exchange opening/closing auctions. Many major stock exchanges, like the NYSE and NASDAQ, use call auctions to determine opening and closing prices. This process helps to absorb large order imbalances that may accumulate overnight or during the day, ensuring a fair and orderly price discovery at these critical junctures. Initial public offerings, IPOs. The initial pricing and allocation of shares in an IPO often resembles a call market, where demand and supply are aggregated to determine the offering price. Less liquid securities. Historically, and sometimes for very illiquid securities, call markets were used to ensure sufficient orders existed before any trades were executed. Pros and cons. Pros. Can provide deep liquidity and a stable, transparent price at the auction point, reducing volatility around news events. Reduces the chance of flash crashes or extreme price movements due to thin liquidity. Cons. Lack of continuous trading means investors cannot react immediately to new information, and there are long periods of illiquidity between auctions. Continuous markets. In contrast, continuous markets allow trading to occur at any time during the market's operational hours, as long as there are matching buy and sell orders. Prices are determined dynamically and continuously, reflecting the immediate supply and demand conditions. Characteristics: ongoing execution. Trades can happen at any moment during trading hours. Dynamic pricing. Prices fluctuate constantly based on incoming orders and real-time supply and demand. Immediate matching. Orders are matched and executed as soon as a counterparty is found. Examples: most major stock exchanges, during their regular trading hours, e.g., 9:30 a.m. to 4 p.m. Eastern Time for U.S. equities. These operate as continuous markets. Foreign exchange (FX) markets. The interbank FX market operates almost 24 hours a day, 5 days a week, as a continuous market. Futures and options exchanges. These typically offer continuous trading sessions. Pros and cons. Pros: provides immediate liquidity and allows investors to react quickly to new information. Offers continuous price discovery and flexibility for traders. Cons: can be susceptible to sudden price swings if liquidity temporarily dries up or large orders hit the market. Price discovery can be more volatile due to rapid shifts in sentiment. Quote-driven versus order-driven markets. Beyond the timing of trades, markets also differ in how prices are quoted and how trades are initiated. Quote-driven, dealer/price-driven markets. In a quote-driven market, trading occurs through a network of professional market makers or dealers who stand ready to buy and sell securities from their own inventory. These dealers continuously quote both a bid price, the price at which they are willing to buy, and an ask or offer price, the price at which they are willing to sell. Investors trade directly with these dealers rather than with other investors. Role of market makers/dealers. Liquidity provision. Dealers provide liquidity by always being willing to buy or sell, even if there are no immediate counterparty orders from other investors. This reduces the risk for investors of not being able to execute a trade. Inventory management. Dealers manage an inventory of securities, taking on the risk that the value of their inventory might change. Price discovery. While they quote prices, their quotes are influenced by their own inventory, market sentiment, and competitor quotes. Bid-ask spreads. The bid price is the highest price a dealer is willing to pay to buy a security from an investor. The ask or offer price is the lowest price a dealer is willing to accept to sell a security to an investor. The bid-ask spread is the difference between the ask price and the bid price. This spread represents the dealer's profit margin for facilitating trades and compensating them for the risk of holding inventory. Significance. A wider spread indicates lower liquidity, higher risk for the dealer, or less competition among dealers. A narrower spread indicates higher liquidity, lower risk, and more competition. Factors influencing spread width. Liquidity. Highly liquid assets, e.g., major currencies, tend to have very narrow spreads. Illiquid assets, e.g., obscure corporate bonds, have wider spreads. Volatility. Higher volatility increases the risk of holding inventory, leading to wider spreads. Competition. More dealers quoting prices for the same asset typically leads to narrower spreads as they compete for order flow. Trade size. Large block trades might involve wider spreads or negotiation, as they can significantly impact a dealer's inventory. Market conditions. During periods of uncertainty or stress, spreads often widen across the board. Examples of assets. Over-the-counter, OTC, markets. Many corporate bonds and derivatives trade OTC. Foreign exchange, FX, markets. The interbank FX market is predominantly quote-driven. Certain equity markets. Historically, NASDAQ was a pure quote-driven market, though it has evolved. Pros and cons. Pros. Guaranteed liquidity. A dealer is always there to trade with. Useful for less liquid securities. Cons. Less transparent pricing. Investors only see the dealer's quotes, not the full depth of demand/supply. Potentially wider spreads, higher transaction costs, compared to order-driven markets. Order-driven markets. In an order-driven market, all buy and sell orders are collected and displayed in a centralized electronic system called an order book. Buyers and sellers interact directly with each other's orders. rather than through an intermediary dealer. The market itself matches compatible orders. The order book, depth of market DOM. The order book is a real-time list of outstanding buy, bid, and sell, ask, orders for security, organized by price level. Bids are orders to buy, listed with the highest price at the top. The highest bid is the most aggressive by order, representing the maximum price a buyer is currently willing to pay. Asks, offers, are orders to sell, listed with the lowest price at the top. The lowest ask is the most aggressive sell order, representing the minimum price a seller is currently willing to accept. The difference between the highest bid and the lowest ask is the bid-ask spread in an order-driven market. This spread reflects the current market's perception of value and the immediate supply/demand imbalance. Depth of market, DOM, refers to the total number of shares/contracts available at each price level on both the bid and ask sides. A deep order book has many orders at various price levels, indicating significant liquidity. A shallow book indicates low liquidity. Consider a simplified view of an order book. Price, bid, quantity, ask, price, ask. $100.00 $100.00 $500 $99.95 $1200 $800 $100.05 $1,500 $100.10. In this example, the best bid is $100.00 for 500 shares, and the best ask is $100.05 for 800 shares. The spread is $0.05. Order matching process. When a new order enters the market, the trading system attempts to match it with existing orders in the book. A buy order will seek to match with the lowest available ask price, and a sell order will seek to match with the highest available bid price. Examples of assets. Major stock exchanges: NYSE, NASDAQ, though with hybrid elements, London Stock Exchange. Futures markets: CME, ICE. Options exchanges: CBOE. Pros and cons. Pros: high transparency. The order book is visible. Potentially tighter spreads due to direct competition among participants. Greater control over execution price for limit orders. Cons: no guaranteed execution. Orders may not fill if a counterparty isn't found at the desired price. Potential for price impact if large market orders walk the book. Hybrid market structures. Many modern exchanges operate under a hybrid model, combining elements of both quote-driven and order-driven markets. This typically means there is a central order book where participants can place orders, but designated market makers or specialists also exist. These market makers have obligations to provide liquidity and ensure orderly markets, often by placing their own quotes on the order book, thereby supplementing the liquidity provided by other participants. Why hybrid? Major exchanges adopt hybrid models to leverage the best of both worlds: the transparency and efficiency of an order-driven system, the guaranteed liquidity and stability provided by market makers, especially during times of stress or low organic order flow. This ensures that even if organic order flow is thin, there's always a professional counterparty willing to trade, promoting continuous and orderly price discovery. Example: the NYSE historically relied heavily on specialists who functioned as market makers on the trading floor, managing the order book for their assigned stocks. While now largely electronic, the concept of designated market makers or lead market makers persists in various forms on many exchanges. Fundamental order types. Understanding the basic order types is crucial for any trader, as they dictate how your intention to buy or sell is communicated to the market and how your trade will be executed. Understanding bid and ask. Before diving into order types, let's reiterate the definitions of bid and ask from the perspective of an individual. Dual trader. Bid: the highest price a buyer is currently willing to pay for a security. If you want to sell immediately, you would typically sell at the current bid price. Ask, or offer the lowest price a seller is currently willing to accept for a security. If you want to buy immediately, you would typically buy at the current ask price. The bid-ask spread is the difference between these two prices. Code snippet. This spread represents the immediate cost of transacting in a market. Market orders. A market order is an instruction to buy or sell a security immediately at the best available current price. It prioritizes execution speed over price certainty. Definition: an order to buy or sell immediately at the best available price in the market. Pros: guaranteed execution. Your order will almost certainly be filled as long as there is liquidity. Speed: it's the fastest way to enter or exit a position. Cons: price uncertainty. Slippage: you do not control the price at which your order is filled. In fast-moving or illiquid markets, the actual execution price might be significantly worse than the last quoted price. This difference is known as slippage. Price impact. For large market orders, especially in illiquid markets, your order might consume multiple price levels in the order book, walking the book, and pushing the price against you as it fills. This can significantly increase your effective transaction cost. Real-world scenario. A trader receives urgent news about a company and needs to exit a position immediately to avoid further losses. They would use a market order, prioritizing getting out over the exact exit price. A high-frequency trading algorithm that identifies a fleeting arbitrage opportunity might use market orders to capture it before it disappears, accepting potential slippage for guaranteed execution. Limit orders. A limit order is an instruction to buy or sell a security at a specified price or better. It prioritizes price certainty over execution speed. Definition: a buy limit order will only execute at the specified limit price or lower. A sell limit order will only execute at the specified limit price or higher. If the market price does not reach your limit price, the order will not be filled and will remain in the order book until it is either filled, canceled, or expires. Pros: price control. You control the maximum price you'll pay for a buy or the minimum price you'll receive for a sell. This helps in managing transaction costs and avoiding adverse slippage. Potential for price improvement. If the market moves favorably after you place your limit order, you might get an even better price than your limit, e.g., a buy limit at $100 might fill at $99.95 if the market drops further. Liquidity provision. By placing a limit order, you're adding to the depth of the order book, thus providing liquidity to the market. Traders who frequently place limit orders are often called liquidity providers. Cons: no guaranteed execution. Your order may never be filled if the market never reaches your specified limit price. This is known as opportunity cost if the market moves significantly in your favor without your order being filled. Partial fills. A limit order might be filled only partially if there isn't enough opposing volume at or better than your limit price. The remaining quantity will stay on the order book. Waiting time. Limit orders can sit on the order book for extended periods, especially if they are far from the current market price. Real-world scenario. A long-term investor wants to buy shares of a company, but believes the current market price is slightly too high. They place a buy limit order below the current market price, hoping to get a better entry point if the stock dips. A quantitative trader implementing a mean reversion strategy might place limit orders around the estimated fair value of an asset, aiming to buy when prices are temporarily low and sell when they are temporarily high, while controlling their execution price. Simulating order book and order types. To better understand how market structures operate, particularly in order-driven markets, let's build a simplified simulation of an order book and how different order types interact with it. This will illustrate concepts like bids, asks, matching, and partial fills. Representing an order. First, we need a simple way to represent an individual order. Each order will have a unique ID, a price, a quantity, and a type, buy or sell. Download the code on one patch code Substack. This code snippet class is a fundamental building block. It encapsulates the key attributes of any order, making it easier to manage and process within our simulated market. The code snippet flag is crucial for distinguishing between bids, buy orders, and asks, sell orders. Building the order book foundation. Now, let's create the code snippet class. It will store separate lists for buy orders, bids, and sell orders, asks. We'll also need a way to display the current state of the book. For simplicity, we'll keep orders sorted by price. Bids will be sorted descending, highest price first, and asks ascending, lowest price first. Download the code on one patch code Substack. The code snippet initializes two dictionaries, code snippet and code snippet, to store orders grouped by price. Code snippet is used so we can easily append multiple orders at the same price level. The code snippet helper ensures that when we display the book, bids are shown from highest to lowest price and asks from lowest to highest, mimicking how a real order book would appear. The code snippet method provides a clear snapshot of the current market depth. Adding limit orders to the book. Limit orders are simply placed onto the order book. A buy limit order goes into the bids, and a sell limit order goes into the asks. Download the code on one patch code Substack. The code snippet method creates a new the snippet object with a unique ID and places it into the code snippet or code snippet dictionary based on code snippet. Importantly, it doesn't immediately execute anything. It simply makes the order available on the book for potential future matching. Let's see it in action. Download the code on one patch code Substack. This output shows how the limit orders populate the order book. The best bid is 100.00, and the best ask is 100.05, forming a 0.05 spread. These orders are now waiting to be matched. Download the code on one patch code Substack. Processing market orders. Market orders are designed for immediate execution. When a market order arrives, it will aggress the order book, meaning a buy market order will consume the lowest available sell orders, asks, and a sell market order will consume the highest available buy orders, bids. This process continues until the market order is fully filled or the relevant side of the book is exhausted. Download the code on one patch code Substack. The code snippet method is the core of the matching engine. It iterates through the appropriate side of the order book, asks for a buy market order, bids for a sell market order, starting from the best available price. It fills the market order by consuming quantities from limit orders at each price level. If a limit order is fully consumed, it's removed. If partially consumed, its quantity is updated. The code snippet and code snippet track the execution, allowing us to calculate the Avera fill price, which demonstrates the concept of slippage if the order fills across multiple price levels. Let's run some market orders against our simulated book. Download the code on one patch code Substack. Let's trace the execution. Initially, bids 100 at 100.0, ID 2. 150 at 99.95, ID 4. Asks 200 at 100.05, ID 1. 300 at 100.1, ID 3. Example 1 output. Download the code on one patch code Substack. Here, a buy market order for 100 shares consumed 100 shares from the best ask at $100.05. The remaining quantity for order ID 1 is now 100. Example 2 output. Download the code on one patch code Substack. A sell market order for 200 shares first consumed the 100 shares at the best bid of $100.00, order ID 2, which is now gone. Then it consumed 100 shares from the next best bid at $99.95, order ID 4, which now has 50 shares left. The average price is 100,100.00 plus 10,099.95 / 200 equals $99.975, rounded to $99.98. This demonstrates how market order can walk the book and get an average price that is different from the initial best bid. Example 3 output. Download the code on one patch code Substack. In this final example, a buy market order for 300 shares is placed. It consumes 100 shares at $100.05, order ID 1, now gone. 50 shares at $100.08, order ID 5, now gone. 150 shares from the 300 shares at $100.10, order ID 3, now has 150 shares left. The average price is 100,100.05 plus 50,100.08 plus 150,100.10 / 300 equals $100.08. This clearly demonstrates slippage and how a large market order can push the price higher for a buy or lower for a sell than the initial best available price. This is a crucial concept for quantitative traders designing execution algorithms. Historical evolution of markets and impact on quant trading. The evolution of financial markets from physical trading floors, open outcry, to fully electronic systems has profoundly impacted market structures and, consequently, quantitative trading. Open outcry, pre-electronic. Mechanism. Traders physically met in a pit or on a floor to shout out bids and offers. Hand signals were used to convey intentions. Characteristics, slower execution, human interpretation of orders, limited transparency. Only participants in the pit had real-time information. Reliance on human market makers for liquidity. Impact. Quantitative trading was limited to slower, end-of-day analysis or strategies that didn't require microsecond execution. Data was less granular and harder to collect. Electronic trading, modern era. Mechanism. Orders are submitted digitally through computer networks, matched by algorithms, and executed within milliseconds. Characteristics. Speed. Orders are matched incredibly fast, enabling high-frequency trading, HFT. Transparency. Order books are often visible, though not always fully deep, to all participants, providing real-time market depth information. Data availability. Every order, quote, and trade generates a timestamp data point, creating vast datasets that are crucial for quantitative analysis. Reduced human error. Automated systems reduce the potential for manual mistakes. Global access. Markets are accessible from anywhere with an internet connection. Impact on quantitative trading. Rise of HFT and algorithmic trading. The speed and data availability made HFT strategies feasible, where algorithms exploit tiny price discrepancies or provide liquidity at ultra-high speeds. Sophisticated execution algorithms. Quants now design algorithms not just for what to trade, but how to trade, optimizing for factors like slippage, market impact, and latency. Data-driven strategies. The abundance of granular market data, tick data, order book snapshots, allows for backtesting and developing complex statistical and machine learning models. Focus on latency. Minimizing the time it takes for an order to reach the exchange and get executed became a critical competitive advantage. New market microstructure research. The detailed data allows for deep analysis of how orders interact, how prices form, and the impact of different trading behaviors. Understanding this historical shift is vital because the capabilities and limitations of quantitative trading strategies are inextricably linked to the technological and structural underpinnings of the markets they interact with. Major types of buy-side stock investors. In the financial markets, participants are broadly categorized into two main groups, the buy side and the sell side. The buy side refers to the institutions and individuals who purchase investment products and services for their own accounts or on behalf of their clients. Their primary objective is to manage assets, generate returns, or meet specific financial obligations. This contrasts with the sell side, which typically includes investment banks, brokerage firms, and market makers who facilitate transactions, provide research, and offer financial products to the buy side. Understanding the various types of buy-side investors is crucial for a quantitative trader, as their differing motivations, investment horizons, and capital scales significantly influence market dynamics, liquidity, and price action. Defining buy-side investors. A buy-side investor is any entity that seeks to deploy capital into financial assets with the goal of achieving a return or fulfilling a specific financial mandate. These entities are the ultimate consumers of financial products and services, making investment decisions based on their research, strategies, and risk tolerance. Their activities drive demand for securities and contribute significantly to overall market volume and liquidity. Institutional versus retail buy-side investors. Buy-side investors are primarily categorized into two broad groups based on their scale, sophistication, and regulatory environment. Institutional investors and retail investors. Institutional buy-side investors. Institutional investors are large organizations that pool money from various sources, e.g., individuals, corporations, governments, and invest it on a large scale. They are typically professional money managers, subject to extensive regulation, and have access to sophisticated trading infrastructure and information. Their sheer size and frequent trading activities mean they account for the vast majority of trading volume and market impact in public markets. The dominance of institutional investors in modern financial markets stems from several factors. Capital aggregation. They aggregate vast amounts of capital from numerous individuals or entities, allowing them to make large-scale investments that would be impossible for individual investors. Professional management. They employ teams of highly skilled portfolio managers, analysts, and traders who conduct extensive research, develop complex strategies, and execute trades with professional precision. Economies of scale. Their large asset bases allow them to achieve lower transaction costs, access exclusive research, and invest in illiquid or complex assets not available to retail investors. Regulatory frameworks. While subject to stringent regulations, e.g., ERISA for pension funds, UCITS for mutual funds, these frameworks often provide a degree of trust and oversight that encourages capital inflow. Access to resources. They lever age-advanced trading technologies, proprietary data feeds, and direct access to market makers and dark pools, giving them an informational and execution advantage. This dominance implies that institutional order flow is a primary driver of price movements. Quantitative traders often focus on identifying and anticipating institutional activity, using techniques like volume profile analysis, large block trade detection, and order book analysis to infer their intentions. Common types of institutional buy-side investors include mutual funds. Purpose/goal. To pool money from many investors to invest in a diversified portfolio of securities, stocks, bonds, money market instruments, according to a stated investment objective. Investors buy shares in the fund, and the value of these shares, net asset value or NAV, fluctuates with the underlying portfolio. Strategies, typically long only, following a specific investment style, e.g., growth, value, index tracking. They often have a long-term investment horizon, aiming for capital appreciation or income generation. Investment horizon, medium to long-term, years. Scale, can range from hundreds of millions to hundreds of billions of dollars in assets under management, AUM. Practical example, a large-cap growth mutual fund might invest in established technology companies like Apple or Microsoft, holding them for several years, seeking consistent earnings growth. Thereby, orders will be spread out over time to minimize mark. Impact. Hedge funds. Purpose/goal. To generate high absolute returns, alpha, for sophisticated investors, e.g., high net worth individuals, endowments, pension funds, regardless of market direction. They charge both management fees and performance fees. Strategies. Employ a wide array of complex and often aggressive strategies, including long/short equity, global macro, event-driven, relative value, and quantitative strategies. They can use leverage, derivatives, and short selling. Investment horizon, highly variable, from very short-term, high-frequency trading to medium-term, event-driven. Scale, can range from tens of millions to tens of billions of dollars in AUM. Practical example, a quantitative hedge fund might identify a statistical arbitrage opportunity between two highly correlated stocks, simultaneously buying one and shorting the other, holding the position for minutes or hours to capture small price discrepancies. Their rapid, high-volume trades can temporarily impact liquidity. Pension funds. Purpose/goal. To manage retirement savings for employees, ensuring sufficient funds are available to pay out future pension benefits. These are typically long-term liabilities. Strategies primarily focus on long-term capital preservation and steady growth to meet future liabilities. They invest in a diversified mix of assets, including stocks, bonds, real estate, and alternative investments. Risk management and liability matching are paramount. Investment horizon, very long-term, decades. Scale, often among the largest institutional investors, with AUM ranging from billions to trillions of dollars. Practical example, a pension fund might allocate a significant portion of its equity portfolio to broad market index funds or large-cap dividend-paying stocks, holding them for decades to generate consistent returns needed to cover future retiree payments. Their large, patient-buy orders are often executed via algorithms over extended periods. Insurance companies. Purpose/goal. To invest premiums collected from policyholders to ensure they can pay out future claims. Their investment strategies are heavily influenced by the nature and duration of their liabilities. Strategies emphasize capital preservation and income generation. They often invest heavily in fixed income securities, but also allocate to equities for growth. Liability-driven investing is a key consideration. Investment horizon, long-term, matching the duration of their policy liabilities. Scale, billions to hundreds of billions of dollars in AUM. Practical example, an insurance company might invest in a portfolio of high-quality, stable dividend stocks to generate predictable income that helps cover recurring policy payouts, while also holding a portion in growth equities to enhance overall portfolio returns over the long run. Endowments and foundations. Purpose/goal. To manage and grow perpetual funds for educational institutions, endowments, or charitable organizations, foundations, providing a stable stream of income for their operations. Strategies often employ a diversified strategy, including significant allocations to alternative investments, private equity, venture capital, hedge funds, alongside public equities and fixed income, aiming for long-term growth. Investment horizon. Perpetual/very long-term. Scale can range from millions to tens of billions of dollars. Practical example, a university endowment might invest in a mix of early-stage venture capital funds, private equity, and publicly traded growth stocks, seeking aggressive long-term appreciation to support the university's operations for generations. Sovereign wealth funds, SWFs. Purpose/goal. State-owned investment funds that manage national savings, often derived from commodity surpluses, e.g., oil, gas, or foreign exchange reserves. Their goals can include stabilizing the economy, generating long-term returns, or diversifying national assets. Strategies, highly diversified across asset classes globally, with very long investment horizons. They often take large, strategic stakes in companies. Investment horizon, very long-term, decades. Scale, among the largest pools of capital globally, often hundreds of billions to trillions of dollars. Corporate nominee. Purpose/goal. This refers to shares held by a corporation, typically not for general investment purposes like a fund, but for strategic reasons. This could be a treasury stock buyback program, an investment in a strategic partner, or holding shares of a subsidiary. The nominee aspect implies these shares might be held through an intermediary or for a specific corporate purpose rather than as part of a diversified investment portfolio managed for external clients. Strategies, driven by corporate strategy, e.g., M&A, capital allocation, control, not typically market timing or alpha generation. Investment horizon, variable, depending on the corporate objective. Scale, highly variable, from small strategic stakes to multi-billion-dollar buybacks. Retail buy-side investors. Retail investors are individual investors who trade securities for their own personal accounts, typically with smaller amounts of capital compared to institutions. They access markets through brokerage firms and often rely on publicly available information, personal research, or advice from financial advisors. While individual retail trades are small, their collective activity can sometimes influence market trends, especially in highly liquid, widely held stocks or during speculative bubbles. Common types of retail buy-side investors include household/individual investors. Purpose/goal, to manage personal wealth, save for retirement, education, or other financial goals. Decisions are often driven by personal financial planning and risk tolerance. Strategies, can range from passive long-term investing, e.g., index funds, ETFs, to active trading, swing trading, day trading, based on individual skill and risk appetite. Investment horizon, highly variable, from minutes, day trading, to decades, retirement investing. Scale, typically thousands to millions of dollars. Practical example, an individual opening a brokerage account to buy shares of a diversified S&P 500 ETF for their retirement portfolio, holding it for 30 years. Another individual might use a portion of their savings to actively day trade popular tech stocks, aiming for quick profits. Family businesses. Purpose/goal. A family business might invest its surplus capital in the stock market to grow its reserves, diversify its assets beyond the core business, or manage its operating cash. This differs from a household investor in that the investment decisions might be more formally structured, considering the business's financial health and future plans. Strategies, often more conservative than individual active traders, focusing on stable, liquid investments, but can also make strategic investments related to their industry. Investment horizon, medium to long term, driven by business needs. Scale, typically tens of thousands to millions of dollars. Startup investors, angel investors/venture capitalists often blur the line. Purpose/goal. While often associated with private equity, some startup investors, particularly angel investors, may operate on a scale closer to high-net-worth individuals or small family offices, directly investing in public markets or holding public shares as part of their broader portfolio. A startup investor, in this context, refers to individuals or small groups investing their personal capital, potentially even through a personal brokerage account, rather than a formally structured fund. This differs from a household/individual by having a specific focus on early-stage, high-growth potential investments, which might include public companies they believe are undervalued or have disruptive potential. Strategies, high-risk, high-reward, often concentrated investments in companies they believe in, potentially with a long-term growth focus. Investment horizon, long-term, patience for growth. Scale, tens of thousands to millions of dollars per investment, with a portfolio of such investments. Market impact and implications for quant trading. The presence and activity of different buy-side investor types have profound implications for market behavior, liquidity, and volatility. Liquidity. Institutional investors, with their large order sizes, are major contributors to market liquidity. However, their strategic execution, e.g., using iceberg orders or dark pools to hide their true intentions, can also create temporary illiquidity or impact price discovery. Retail investors, while individually smaller, contribute to the aggregate liquidity of widely traded stocks. Volatility. Large, sudden trades by institutional investors can cause significant short-term price movements. Conversely, their long-term, patient capital can also stabilize markets. Retail sentiment, especially when highly correlated, e.g., during meme stock phenomena, can also generate significant, albeit sometimes transient, volatility. Price discovery. Institutional research and sophisticated models contribute significantly to efficient price discovery. However, information asymmetry between institutional and retail investors can lead to opportunities or pitfalls. Order flow. Understanding the typical order flow patterns of different investor types, e.g., institutions using volume-weighted average price, VWAP, algorithms, retail investors placing market orders, is crucial for designing effective execution algorithms and predicting short-term price movements. Practical example. Influence on market scenario. Consider a scenario where a major pension fund decides to rebalance its portfolio by acquiring a large block of shares in a particular blue-chip company. Their investment horizon is decades, and their primary goal is long-term capital preservation and steady growth. To minimize market impact, they would likely use an advanced execution algorithm, e.g., a VWAP or TWAP algorithm, to spread their buy orders over several days or even weeks, potentially using dark pools to avoid signaling their intentions. This slow, steady demand would provide consistent, albeit perhaps subtle, upward pressure on the stock price. In contrast, if a group of retail day traders, perhaps influenced by social media, decide to aggressively buy highly speculative, low-float stock, they might flood the market with immediate buy orders. This surge of demand, even if individually small, can lead to a rapid and dramatic price spike, increasing volatility and potentially creating a short squeeze if many short sellers are caught off guard. However, such movements are often less sustainable than those driven by institutional flows due to the less fundamental basis of the demand and the higher likelihood of quick profit-taking. For a quantitative trader, differentiating these scenarios is key. Identifying the footprint of institutional accumulation, e.g., large block trades, consistent buying on dips, algorithmic order patterns, versus retail-driven speculation, e.g., sudden spikes in volume with less underlying fundamental news, high relative strength index, RSI, readings, allows for more informed strategy development and risk management. Market making. Market making is a fundamental activity in financial markets, crucial for ensuring liquidity and efficient price discovery. At its core, a market maker is a professional who stands ready to buy or sell a particular financial instrument, providing quotes on both sides of the market, a bid price at which they are willing to buy and an ask price at which they are willing to sell. This constant willingness to transact facilitates smooth trading for other market participants. The core function, providing liquidity and immediacy. A market maker's primary role is to provide liquidity and immediacy. Liquidity refers to the ease with which an asset can be converted into cash without affecting its market price. A liquid market allows participants to execute trades quickly and efficiently, without causing significant price dislocations. Market makers contribute to this by always offering to buy and sell, absorbing imbalances in supply and demand. Immediacy means that a counterparty is always available for a trade. In many markets, particularly code snippet markets, like the Nasdaq historically or over-the-counter markets, market makers are the primary source of this immediacy. They are the ones you trade with directly, rather than waiting for another individual buyer or seller to emerge. Consider a scenario where an investor urgently needs to sell 1,000 shares of a stock. Without a market maker, this investor would have to place a sell order and wait for a buy, or to match it, which could take time and potentially result in a lower execution price if demand is scarce. A market maker, however, will immediately offer a bid price, ensuring the investor can sell their shares without delay. Similarly, if an investor wants to buy quickly, the market maker provides an ask price. By continuously quoting two-sided prices, market makers act as intermediaries, bridging the gap between buyers and sellers. The mechanics of profit, capturing the bid-ask spread. The primary way market makers generate profit is by capturing the bid-ask spread. The bid price is the highest price a market maker is willing to pay for an asset, and the ask price, also known as the offer price, is the lowest price they are willing to accept to sell that asset. The difference between these two prices is the bid-ask spread. A market maker aims to buy at their bid price and sell at their ask price. Since their ask price is always higher than their bid price, each round trip, buying at the bid and then selling at the ask, or vice versa, yields a small profit. Numerical example of spread capture. Let's illustrate with a simple example. Suppose a market maker is quoting a stock with the following prices. Bid price $10.00. Ask price $10.01. The bid-ask spread is $0.01, $10.01, $10.00. 1. Scenario 1. Market maker buys first. A trader wants to sell 100 shares. The market maker buys these 100 shares at their bid price of $10.00 per share. Cash outflow for market maker, code snippet. The market maker now holds 100 shares in their inventory. Later, another trader wants to buy 100 shares. The market maker sells their 100 shares at their ask price of $10.01 per share. Cash inflow for market maker, code snippet. Profit, code snippet. 2. Scenario 2. Market maker sells first, shorting. A trader wants to buy 100 shares. The market maker sells these 100 shares at their ask price of $10.01 per share. They might borrow the shares to do this, creating a short position. Cash inflow from market maker, code snippet. The market maker now has a short position of 100 shares. Later, another trader wants to sell 100 shares. The market maker buys these 100 shares at their bid price of $10.00 per share to cover their short position. Cash outflow from market maker, code snippet. Profit, code snippet. In both scenarios, the market maker profits from the 1-cent spread. While the profit per share is small, market makers transact in enormous volumes, often executing thousands or millions of trades per day, accumulating substantial profits from these tiny margins. Types of market makers. Market making has evolved significantly, and different types of entities perform this function. Designated market makers, DMMs/specialists. Historically, on exchanges like the New York Stock Exchange, NYSE, a code snippet, now called a code snippet or code snippet, was a specific firm responsible for maintaining an orderly market in a particular set of STO. CKs. They had obligations to quote prices, manage the order book, and provide liquidity, especially during volatile periods. They often had a monopoly on trading in their assigned stocks. Proprietary trading firms. These firms trade for their own account, using their own capital. Many modern code snippet firms fall into this category. They leverage advanced technology, complex algorithms, and ultra-low latency connections to exchanges to execute a massive number of trades and capture tiny spreads. Unlike DMMs, they typically don't have explicit regulatory obligations to make markets in specific securities, but their profit motive drives them to provide liquidity. Broker-dealers. Many large financial institutions that act as brokers for clients also engage in market making. They might quote prices for their clients in certain securities, especially in code snippet markets where there isn't a central exchange. Electronic market makers. With the rise of electronic exchanges, the role of human specialists has diminished. Code snippet are typically algorithmic trading systems that automatically quote bids and offers across various exchanges and asset classes. Key risks in market making. While profitable, market making is not without significant risks. Market makers constantly manage a delicate balance between capturing spreads and minimizing exposure to adverse price movements. 1. Inventory risk. Inventory risk is the most significant risk for a market maker. It refers to the risk that the value of the assets a market maker holds, their code snippet, will decline before they can complete a profitable round trip. Long inventory risk. If a market maker buys shares at their bid price and the market price subsequently drops significantly before they can sell those shares at a profit or even at a loss to manage risk, the value of their inventory declines. For example, if they buy at $10.00 and the price suddenly drops to $9.80, they face an immediate loss on their held shares. Short inventory risk. Conversely, if a market maker sells shares short, sells borrowed shares at their ask price and the market price subsequently rises sharply, they face a loss when they have to buy back those shares to cover their short position. For example, if they sell at $10.01 and the price jumps to $10.20, they will incur a loss when buying back. Market makers must constantly adjust their quotes and manage their inventory to minimize this risk. Holding a large, unbalanced inventory, either too many long positions or too many short positions, exposes them to significant potential losses if the market moves against their position. 2. Adverse selection risk. Adverse selection risk, also known as code snippet, arises when a market maker trades with a counterparty who possesses superior information about the true value or future direction of an asset. Scenario: a market maker quotes a bid and asks for stock. An institutional investor, having just received a CONF, initial earnings pre-announcement, knows the company's stock is about to drop significantly. This investor immediately sells a large block of shares to the market maker at their bid price. The market maker, unaware of the impending news, now holds a large long inventory that is about to lose value. Impact. The market maker is picked off or run over by informed traders. They effectively lose money by providing liquidity to someone with an informational advantage. This risk forces market makers to adjust their spreads wider or pull their quotes entirely in times of high uncertainty or when they suspect informed trading. 3. Capital requirements. Market making requires substantial capital. Market makers need sufficient funds to hold inventory. They must be able to finance the assets they hold, long positions, or have collateral for borrowed shares, short positions. Absorb losses. Despite sophisticated risk management, losses can occur, especially during volatile periods or flash crashes. Adequate capital ensures they can withstand these downturns without defaulting. Support trading volume. To profit from small spreads, market makers need to trade high volumes, which in turn demands significant capital to facilitate those transactions. Regulatory environment and obligations. In many markets, market makers, especially designated ones, operate under specific regulatory obligations. These often include continuous quoting, maintaining continuous two-sided quotes for the IR-assigned securities during trading hours, minimum quote size and depth, ensuring their quotes are for a minimum number of shares and that there is sufficient depth, volume available at various price levels around their quotes, maintaining an orderly market, stepping in to provide liquidity during periods of high volatility or market stress to prevent extreme price swings. Fair and orderly trading. Adhering to rules that prevent manipulative practices and ensure fair access to their quotes. These obligations aim to ensure market stability and protect investors, even though they can sometimes conflict with a market maker's pure profit motive. Historical evolution and modern market making. The concept of market making has a long history. In traditional code snippet trading floors, human code snippet or code snippet manually quoted prices and managed order books. They relied on their experience, intuition, and communication with other traders to manage risk and profit from spreads. With the advent of electronic trading in the late 20th and early 21st centuries, market making transformed dramatically. Code snippet firms, leveraging powerful computers, sophisticated algorithms, and direct access to exchange matching engines, now dominate many market-making activities. These firms can process market data, make trading decisions, and send orders in microseconds, allowing them to quote tighter spreads and react faster to market changes than human traders ever could. Market making is prevalent across various asset classes, including equities, stocks traded on major exchanges, options and futures. Derivatives markets heavily rely on market makers to provide liquidity. Foreign exchange, Forex, the largest and most liquid market in the world, dominated by interbank market makers. Fixed income, bonds, and other debt instruments. Cryptocurrencies, a rapidly evolving market where automated market makers, AMMs, and traditional market makers play a crucial role. Illustrative simulation, market maker P&L. To solidify the understanding of bid-ask spread capture and inventory management, let's create a very simplified Python simulation of a market maker. This simulation will track inventory, cash, and calculate profit/loss based on hypothetical trades. Initializing the market maker. We begin by setting up a basic code snippet class. This class will hold the market maker's current cash, inventory of the asset, and define the spread they aim to capture. Download the code on one PageCode Substack. This initial code sets up our code snippet object. We give it some starting cash and a small inventory of the asset. The code snippet defines how wide the market maker's quotes will be. A basis point, BPS, is 0.01%. So 1 BPS means a 0.01% spread relative to the asset's price. Quoting prices. Next, we add a method to the code snippet class that generates the bid and ask prices based on the current market price and the defined spread. Download the code on PageCode Substack. The code snippet method takes the code snippet, the theoretical fair value, and calculates the bid and ask by subtracting/adding half of the desired spread. For a 1 BPS spread on a $100 stock, the half spread is $0.005, leading to a bid of $99.995 and an ask of $100.005. Executing trades and updating state. Now, we'll add a method to simulate trades. When a counterparty wants a buy, the market maker sells at their ask. When a counterparty wants to sell, the market maker buys at their bid. This method will update the market maker's cash and inventory and track the realized P&L from these transactions. Download the code on OnePageCode Substack. The code snippet method takes the code snippet from the perspective of the counterparty, the code snippet, and the code snippet. It then uses code snippet to determine the market maker's transaction price, bid, or ask, and updates the code snippet and code snippet accordingly. Calculating total P&L, realized and unrealized. Finally, we need a way to calculate the market maker's total profit or loss, which consists of code snippet from completed spread captures and code snippet from the current value of the inventory. Download the code on OnePageCode Substack. To calculate P&L accurately, we need to know the market maker's initial capital and the initial value of their inventory. We'll refine the code snippet class to store these initial values. Complete market maker simulation. Here's the full refine. Decode snippet class and a simulation demonstrating a sequence of trades, showing how cash, inventory, and P&L evolve. Download the code on OnePageCode Substack. In Scenario 1, Stable Market, we observe a market maker accumulating small profits by consistently buying at the bid and selling at the ask. Their inventory might fluctuate, but because the price is stable, their code snippet on inventory remains close to zero, and the code snippet from spread capture dominates. In Scenario 2, Market Price Drops, we explicitly demonstrate code snippet. The market maker accumulates a long inventory. When a market price significantly declines, the value of their held inventory drops, leading to an immediate unrealized loss, which impacts their code snippet negatively, even if they continue to capture spreads on subsequent trades of the new lower price. This highlights why managing inventory and reacting quickly to price changes is paramount for market makers. This simple simulation provides a tangible understanding of how market makers profit from the spread and how their inventory management directly impacts their overall profitability, especially in volatile markets. Scalping. Scalping is a highly specialized, short-term trading strategy focused on capturing small price movements many times throughout the trading day. Unlike longer-term strategies that seek to capitalize on major trends or fundamental shifts, scalpers aim to profit from the bid-ask spread or minor fluctuations, often holding positions for only a few seconds to a few minutes. The core principle is the accumulation of numerous small gains, rather than relying on a few large, less frequent profits. Key characteristics of a scalper. A successful scalper exhibits distinct characteristics and operates under specific conditions. High frequency. Scalpers execute a large number of trades daily, sometimes hundreds or even thousands. Short duration. Positions are held for very brief periods, typically minutes or even seconds. This minimizes exposure to significant market reversals. Small profit targets. Each trade aims for a minimal profit, often just a few ticks or basis points. Strict risk management. Due to the high volume of trades and small profit margins, a single large loss can quickly erode many successful trades. Therefore, rigorous stop-loss discipline is paramount. Real-time data dependent. Access to a fast, live feed of market quotes and level 2 data is crucial for identifying fleeting opportunities. High concentration and discipline. The strategy demands continuous focus, rapid decision-making, and strict adherence to a predefined trading plan, often under SIG. Significant psychological pressure. Instruments and market conditions for scalping. Scalpers gravitate towards financial instruments that offer high liquidity and sufficient volatility to generate frequent, small price movements. Highly liquid stocks. Large cap stocks with high daily trading volumes are ideal. High liquidity ensures that orders can be executed quickly at or near the desired price, minimizing slippage. Forex pairs. Major currency pairs, e.g., euro to US dollar, pound sterling to Japanese yen, are popular due to their immense liquidity, 24/5 trading hours, and often tight spreads. Futures contracts. Highly liquid futures contracts, e.g. S&P 500 E-mini, crude oil, are also favored, offering centralized exchanges and clear tick increments. Market volatility. Scalping thrives in moderately volatile markets, where there are enough price swings to capture profits, but not so much as to make risk management impossible. Extremely quiet markets offer few opportunities, while excessively volatile markets increase the risk of large, sudden losses. Data requirements for scalping. The speed and depth of market data are critical for scalping. A live feed of quotes is not merely a delayed price chart. It refers to granular, real-time data streams. Tick data. Tick data represents every single price change, or tick, that occurs in a market. It includes the timestamp, price, and volume of each trade or quote update. This is the most granular level of data available and is essential for high-frequent strategies. Let's illustrate how tick data might be structured and processed conceptually. Download the code on OnePageCode Substack. This code snippet demonstrates the fundamental structure of tick data, showing how each granular price and volume change is recorded with a high-resolution timestamp. Scalpers constantly monitor this stream to identify immediate buying or selling pressure. Level 2 data, order book data. Level 2 data provides a view of the market's depth by displaying the best bid and ask prices from various market participants, along with the corresponding volumes available at those prices. It shows the order book, a list of buy and sell orders at different price levels. Bid side shows the highest prices buyers are willing to pay and the quantity available at each price. Ask side shows the lowest prices sellers are willing to accept and the quantity available at each price. Scalpers use Level 2 data to gauge immediate supply and demand dynamics, identify potential support/resistance levels, and spot large orders that might move the market. For instance, a large block of buy orders accumulating at a specific price level might indicate a temporary floor. Download the code on OnePageCode Substack. This conceptual code illustrates how Level 2 data presents the depth of bids and asks. A scalper would look at the volumes at various price levels to infer market sentiment and potential immediate price movements. For example, if there's significantly more volume on the bid side at a given price compared to the ask side, it might suggest buying pressure. Profit targets and risk management in scalping. Scalping success hinges on disciplined execution of a strict exit strategy. The goal is to capture small profits and cut losses even smaller. Small profit targets. Profit targets are typically measured in ticks or basis points, BPS. A tick is the smallest price increment an instrument can move. For stock, this might be 1 cent. For futures, it could be $12.50 per contract for a 0.25-point move. A scalper might aim for 1 to 5 ticks per trade. Strict exit strategy. This is non-negotiable for scalpers. Common methods include percentage-based stop loss. Exit if the price moves against the position by a certain small percentage, e.g., 0.05% to 0.1%. Fixed point/tick stop loss. Exit if the price moves against the position by a predefined number of ticks, e.g., 2 to 3 ticks. Time-based exit. Automatically close the position after a very short duration, e.g., 30 seconds to 2 minutes, regardless of profit or loss, if the desired movement hasn't occurred. This prevents stale positions from turning into larger losses. Let's simulate a simple trade with a fixed tick stop loss and take profit. Download the code on OnePageCode Substack. This code demonstrates a fundamental aspect of automated scalping logic, continuously monitoring the current price against predefined take profit and stop loss levels. The code snippet function encapsulates the decision-making process for exiting a position based on these critical thresholds. The impact of transaction costs. One of the most significant challenges for scalpers is the impact of transaction costs. Because positions are opened and closed so frequently, Commissions, exchange fees, and slippage can quickly erode small profits. Commissions, fees paid to the broker for executing trades. These can be per share, per contract, or a flat fee. ECN fees, fees charged by electronic communication networks. ECNs, for adding or removing liquidity. Some ECNs offer rebates for adding liquidity, placing limit orders that are filled, while charging for removing liquidity, hitting existing orders with market orders. Slippage, the difference between the expected price of a trade and the price at which the trade is actually executed. In fast-moving markets, even a tiny delay can lead to slippage, which can be detrimental to a strategy aiming for only a few ticks of profit. Let's calculate the net profit/loss considering transaction costs. Download the code on OnePatchCode Substack. This code highlights how even a small profit can be significantly reduced or even turned into a loss once transaction costs are factored in. For scalpers, minimizing these costs is paramount, which often leads them to seek brokers with very low commission structures or to employ strategies that add liquidity to earn rebates. Leverage in scalping. Leverage is commonly used in scalping, particularly in Forex and futures markets, where it is more readily available. Leverage allows traders to control a larger position size with a relatively small amount of capital. Amplified gains. If a trade moves in the scalper's favor, leverage magnifies the profit percentage on the initial capital. Amplified losses. Conversely, if a trade moves against the scalper, leverage also magnifies losses, potentially leading to rapid capital depletion or margin calls. While leverage can enhance potential returns on successful trades, it also dramatically increases the risk. A small price swing against a highly leveraged position can lead to a substantial loss, reinforcing the need for extremely tight stop losses. Accumulation of small gains versus impact of large loss. The core philosophy of scalping is to make many small gains. However, this strategy is highly vulnerable to a single large loss, which can wipe out the profits from dozens or even hundreds of successful trades. This underscores the absolute necessity of strict risk management. Let's illustrate this with a numerical example. Download the code on OnePatchCode Substack. This simulation demonstrates how even with a high win rate, 70% in this example, and small, controlled losses, a single larger-than-expected loss event can severely impact or entirely erase accumulated profits. The code snippet highlights the danger of a stop-loss being skipped due to extreme volatility or technical issues, which is a constant THRE. F for scalpers. Technological infrastructure for scalping. Effective scalping, especially automated or algorithmic scalping, demands a sophisticated technological setup. Low-latency data feeds. Direct connections to exchange data feeds, often called direct feeds or co-located feeds, are preferred over aggregated broker feeds. Every millisecond counts. Direct market access, DMA, enables traders to place orders directly into the exchange's matching engine, bypassing intermediate steps and reducing latency. High-speed execution systems, optimized trading platforms, or custom-built algorithms designed for rapid order entry, modification, and cancellation. Colocation, placing trading servers physically within or very close to the exchange's data center. This minimizes the physical distance data has to travel, reducing network latency to microseconds. Dedicated hardware, high-performance computers, fast network cards, and specialized operating system tuning are often employed. Algorithmic implementation challenges. While the concept of scalping is straightforward, implementing it algorithmically presents significant challenges beyond just coding the entry/exit logic. Minimizing latency. This is the primary technical hurdle. Every component of the system, data reception, strategy calculation, order routing, and execution confirmation, must be optimized for speed. This often involves low-level programming, e.g., C++, specialized network protocols, and hardware Excel. Iteration. Handling market microstructure effects. Algorithms must be robust enough to handle nuances like order book dynamics, rapid changes in level 2 data, identifying spoofing, placing large orders with no intention of execution, and understanding order flow. Price discovery, accurately determining the true market price amidst constant fluctuations and bid-ask spread changes. Liquidity management, ensuring orders are filled at the desired price and avoiding getting stuck in a position due to lack of liquidity. Robustness and error handling. Given the high volume and speed, the system must be incredibly resilient to data glitches, network disconnects, exchange outages, and unexpected market events. Automated fail-safes are crucial. Backtesting and simulation. Accurately backtesting scalping strategies requires extremely high-fidelity historical tick and level 2 data, which is often difficult and expensive to obtain and process. Simulating slippage and latency accurately is also a complex task. Psychological demands of scalping. Even for automated systems, human oversight and emotional resilience are critical. For manual scalpers, the psychological toll is immense. Continuous market monitoring requires intense focus for hours. Rapid decision-making. Opportunities appear and disappear in seconds. Hesitation means missed profit or increased loss. Emotional control. The constant barrage of small wins and losses, coupled with the potential for a large, sudden loss, can be emotionally draining. Discipline is required to stick to the strategy and not chase losses or overtrade. Burnout. The high-stress environment can lead to mental fatigue and burnout. Portfolio rebalancing. Portfolio rebalancing is the process of realigning the weights of assets in a portfolio back to their original target allocations. Over time, the market value of different assets within a portfolio will fluctuate at different rates. These fluctuations cause the portfolio's actual asset allocation to deviate or drift from its intended target. Rebalancing ensures that the portfolio's risk and return characteristics remain consistent with the investor's objectives. The necessity of rebalancing, portfolio drift. The primary reason for portfolio rebalancing is to counteract portfolio drift. Drift occurs when the market values of assets change, causing their proportional representation within the portfolio to shift. Several factors contribute to portfolio drift. 1. Market fluctuations. This is the most common cause. If stocks perform exceptionally well, their value in the portfolio will increase, making the stock allocation larger than its target. Conversely, if bonds underperform, their allocation will shrink. 2. Cash flows. Adding new capital to a portfolio or withdrawing funds can also alter asset weights if not strategically allocated or withdrawn. 3. Changes in risk tolerance or investment goals. An investor's risk tolerance may decrease as they approach retirement, necessitating a shift towards more conservative assets. While this is a deliberate change in target allocation, it still requires rebalancing to achieve the new target. Numerical EXA. EMPL, illustrating portfolio drift. Let's consider a simple portfolio with two assets, stocks, represented by an ETF, code snippet, and bonds, represented by a bond ETF, code snippet. Initial target allocation. Stocks, code snippet 60%. Bonds, code snippet 40%. Initial portfolio value, $100,000. This means we initially allocate. Stocks, $100,000, 0.60 equals $60,000. Bonds, $100,000, 0.40 equals $40,000. Assume initial prices. Code snippet at $400 per share and code snippet at $80 per share. Number of code snippet shares, $60,000/$400 equals 150 shares. Number of code snippet shares, $40,000/$80 equals 500 shares. Scenario: market performance over one period. Suppose over the next quarter, code snippet increases in value by 10%, from $400 to $440. Code snippet decreases in value by 2%, from $80 to $78.40. Let's calculate the new values and the resulting portfolio drift. New value of stocks, 150 shares, $440 per share equals $66,000. New value of bonds, 500 shares, $78.40 per share equals $39,200. New total portfolio value, $66,000 plus $39,200 equals $105,200. Now, let's calculate the new actual asset allocations. Actual stock allocation, $66,000 slash $105,200. 100% equals 62.74%. Actual bond allocation, $39,200 slash $105,200. 100% equals 37.26%. As you can see, the stock allocation has drifted from its target of 60% to 62.74%, and the bond allocation has drifted from 40% to 37.26%. This drift means the portfolio is now slightly more exposed to stock market risk than initially intended, maintaining the risk and reward profile. The core purpose of rebalancing is to maintain the portfolio's intended risk and reward profile. An investor chooses a specific asset allocation, e.g., 60% stocks slash 40% bonds, because it aligns with their risk tolerance and financial goals. Risk management. Without rebalancing, assets that perform well, typically riskier ones like stocks, will grow to represent a larger portion of the portfolio. This increases the overall portfolio risk beyond the investor's comfort level. Conversely, if conservative assets disproportionately grow, the portfolio might become too conservative, potentially missing out on growth opportunities. Rebalancing systematically reduces exposure to assets that have performed well by selling them, and increases exposure to assets that have underperformed by buying them, thereby trimming the winners and buying the dips. This disciplined approach helps prevent the portfolio from becoming excessively risky or too conservative. Potential for return optimization. Nuance. While rebalancing is primarily a risk management tool, it can indirectly contribute to return optimization. By selling assets that have appreciated and buying those that have depreciated, rebalancing forces a buy low, sell high discipline. In volatile markets, this contrarian approach can sometimes lead to improved long-term returns compared to a set-it-and-forget-it strategy, especially when asset classes revert to their mean performance. However, it's crucial to understand that rebalancing does not guarantee higher returns. Its main benefit is risk control. Hedging. Specific scenarios. In some sophisticated strategies, rebalancing might be used in conjunction with other financial instruments for hedging. For example, if a portfolio is designed to hedge against inflation and an inflation-sensitive asset class has performed very well, indicating rising inflation, rebalancing might involve selling some of that asset to lock in gains and maintain the overall hedge ratio, rather than letting it over-dominate the portfolio's exposure. For most retail investors, the hedging aspect is less about direct instrument hedging and more about maintaining a desired diversification and risk exposure. Methods of portfolio rebalancing. There are two primary methods for rebalancing a portfolio: time-based and threshold-based. 1. Time-based rebalancing. This method involves rebalancing the portfolio back to its target weights at predetermined intervals, regardless of how much the allocation has drifted. Mechanism. An investor sets a schedule, e.g., annually, semi-annually, quarterly, monthly. On the chosen rebalancing date, the portfolio's current asset weights are calculated. If they deviate from the target, trades are executed to restore the original proportions. Pros. Simplicity and discipline. Easy to implement and automates the decision-making process. Predictability. Investors know exactly when rebalancing will occur, which can help with plan. Nink. Avoids emotional decisions. Removes the temptation to react to short-term market movements. Cons. Missed opportunities. May not rebalance when significant drift occurs between scheduled dates. Unnecessary trades. Could lead to trades when drift is minimal, incurring unnecessary transaction costs and potential tax implications. Market timing risk. Rebalancing on a fixed date might coincide with an unfavorable market moment, e.g., selling low or buying high. Common schedules. Annually, most common for long-term investors. Quarterly, or semi-annually. 2. Threshold-based rebalancing. This method triggers a rebalance only when an asset's allocation drifts beyond a predefined percentage threshold from its target. Mechanism. An investor sets a tolerance band around each asset's target weight, e.g., plus or minus 5%. If an asset's actual weight moves outside this band, a rebalance is triggered for that asset and potentially the entire portfolio to bring all allocations back to target. Pros. Efficiency. Trades are only executed when necessary, potentially reducing transaction costs and taxes compared to time-based rebalancing. Responsiveness. Reacts to significant market movements and prevents substantial drift. Risk control. Directly addresses the issue of portfolio risk deviating from the target. Cons. Complexity. Requires continuous monitoring of asset weights, which can be more complex than simply marking a calendar. Inactivity. In calm markets, rebalancing might occur very infrequently, potentially allowing minor drifts to accumulate. Whipsaw risk. In highly volatile markets, an asset might breach its threshold, trigger a rebalance, and then quickly revert, potentially leading to multiple trades in a short period. Typical thresholds. Common thresholds range from 5% to 10% deviation from target, e.g., if target is 60%, rebalance if it goes below 55% or above 65%. 3. Hybrid approaches. Many investors and institutions use a hybrid approach, combining elements of both time-based and threshold-based methods. For example, they might check thresholds daily but only execute trades on a weekly or monthly basis if a threshold is breached. Alternatively, they might have a primary annual rebalance but also conduct an interim rebalance if a significant threshold is exceeded. This offers a balance between disciplined scheduling and responsiveness to market dynamics. Practical implementation with Python. While this section is conceptual, the power of quantitative trading lies in its practical application. Let's build a simple Python simulation to demonstrate portfolio drift and a basic time-based rebalancing strategy. We'll start by defining our initial portfolio and then simulate price changes to observe drift. 1. Initial portfolio setup. First, we define our target allocations, initial investment, and asset prices. Download the code on one patch code Substack. This initial code segment sets up the fundamental parameters of our hypothetical portfolio. We define code snippet as a dictionary, making it easy to manage multiple assets and their desired proportions. Code snippet represents the total capital invested, and code snippet tracks the starting price per share for each asset. Printing these values helps confirm our setup. 2. Calculate initial holdings. Based on the initial setup, we can calculate the initial dollar value allocated to each asset and the number of shares purchased. Download the code on one patch code Substack. Here, we compute the exact dollar amount assigned to each asset, code snippet, by multiplying its target percentage by the total portfolio value. Then, by dividing this dollar amount by the code snippet, we determine the code snippet of each asset held in the portfolio. This establishes the baseline for our portfolio. 3. Simulating portfolio drift. Now, let's simulate market performance over a period and observe how the portfolio's actual allocation drifts from target. We'll use the price changes from our earlier numerical example. Download the code on one patch code Substack. This segment simulates the market's impact. We define code snippet based on percentage changes, then calculate the code snippet of each asset using the initial share counts and the new prices. Summing these gives us the code snippet of the portfolio. Finally, code snippet shows the actual weights of each asset, clearly demonstrating the drift from the code snippet. The drift summary quantifies this deviation. 4. Implementing time-based rebalancing. Now, let's implement a time-based rebalancing logic. At the rebalancing point, we determine the desired dollar value for each asset based on the current total portfolio value and the target allocation. Then, we calculate the necessary trades, buy or sell, to achieve these new target values. Download the code on one patch code Substack. This final code block simulates the rebalancing process. We first determine the code snippet for each asset based on the current total portfolio value, ensuring we rebalance to the correct proportions for the current portfolio size. We then calculate the code snippet required, specifying the dollar amount and the number of shares to buy or sell for each asset. Finally, we update the code snippet and verify that the code snippet closely matches the code snippet, demonstrating that the portfolio has been successfully restored to its intended risk profile. Considerations and best practices for rebalancing. While conceptually simple, practical rebalancing involves several important considerations. 1. Transaction costs. Every buy or sell order incurs transaction costs, commissions, bid-ask spread. Frequent rebalancing, especially for small deviations, can erode returns. The chosen rebalancing method and thresholds should balance risk control with cost efficiency. 2. Tax implications. Selling appreciated assets triggers capital gains taxes. Investors in taxable accounts must consider the tax efficiency of their rebalancing strategy. For example, selling assets that have declined in value, tax loss harvesting, can offset gains, or using new contributions to buy underweight assets rather than selling overweight ones. Tax-efficient rebalancing can reduce tax liabilities. 3. Market volatility. In highly volatile markets, threshold-based rebalancing might lead to excessive trades. Time-based rebalancing might miss significant drift. Adapting the strategy to market conditions or using hybrid approaches can be beneficial. 4. Liquidity. For less liquid assets, executing large rebalancing trades might be difficult or impact market prices. This is less of a concern for highly liquid ETFs or major stocks, but critical for smaller cap securities or liquid alternative investments. 5. Asset class correlation. Understanding how different asset classes move together or don't is crucial. Rebalancing effectively capitalizes on mean reversion, where assets that have outperformed are expected to revert to their long-term average, and vice versa. 6. Behavioral aspect. Rebalancing requires a disciplined, contrarian mindset, selling what's performed well and buying what's performed poorly. This can be emotionally challenging, but it's key to maintaining the long-term investment strategy. By systematically rebalancing, investors can ensure their portfolio remains aligned with their strategic asset allocation and, critically, their intended risk-return profile, regardless of short-term market fluctuations. Getting started with financial data analysis. Financial data analysis is the process of examining historical and real-time financial information to gain insights, identify patterns, make predictions, and inform decision-making. Its primary purpose in quantitative trading is to develop, test, and execute systematic strategies that can generate profits and manage risk. This field integrates concepts from statistics, econometrics, computer science, and finance to uncover actionable intelligence from complex datasets. Applications of financial data analysis. The insights derived from financial data analysis are crucial across various domains. Investing strategies. Long-term investors use financial data to evaluate company fundamentals, assess industry trends, and determine fair valuations for stocks, bonds, and other assets. This often involves analyzing quarterly and annual financial statements, economic indicators, and historical price performance over years or even decades. Trading strategies. Short to medium-term traders rely heavily on technical analysis, which involves studying price charts and volume data to identify patterns and predict future price movements. This can range from high-frequency trading, HFD, operating on millisecond data, to swing trading analyzing daily or weekly price action. Risk management. Financial institutions and individual investors utilize data analysis to quantify and mitigate various financial risks, including market risk, e.g., volatility, drawdowns, credit risk, and operational risk. This involves statistical modeling of portfolio returns, stress testing, and value at risk, VAR, calculations. Corporate finance decision-making. Beyond market participants, corporations use financial data analysis for internal decision-making, such as capital budgeting, mergers and acquisitions, M&A analysis, working capital management, and performance evaluation. The challenge of continuous financial data. Financial markets generate a continuous stream of data. Every trade, every quote update, every order placed or canceled contributes to this flow. This raw, unaggregated data is often referred to as tick data because it captures every single tick or change in the market. While tick data provides the most granular view, analyzing it directly for trends or patterns over longer periods can be overwhelmingly complex due to its sheer volume and irregular timing. Consider a stock that trades thousands of times per second. Trying to discern a daily trend from millions of individual trades is akin to trying to understand a novel by reading every single letter in isolation. To make this continuous stream of information manageable and meaningful for analysis, it needs to be summarized into discrete, fixed-interval chunks. Summarizing financial data, OHLC bars. One of the most popular and fundamental ways to summarize continuous stock data over specific time intervals is by constructing OHLC, open, high, low, close bars. An OHLC bar encapsulates the key price movements within a defined period, such as a minute, hour, or day. Each component of an OHLC bar represents a critical price point during its interval. Open, the price of the first trade that occurred at the beginning of the interval. High, the highest price reached by the asset during the interval. Low, the lowest price reached by the asset during the interval. Close, the price of the last trade that occurred at the end of the interval. These four values provide a concise yet comprehensive summary of price action, allowing analysts and traders to visualize trends and patterns on a chart. Different time intervals for OHLC bars are relevant for different types of analysis or trading. Minute/hourly bars, often used by day traders and high-frequency traders who need to react quickly to short-term price fluctuations. Daily bars, the most common interval for swing traders and short-term investors, providing a good balance between detail and clarity for analyzing daily trends. Weekly/monthly bars, preferred by long-term investors and strategists to identify macro trends and long-term support/resistance levels, filtering out short-term noise. Practical example, creating OHLC bars with Python. Let's demonstrate how to take a hypothetical stream of price data and aggregate it into daily OHLC bars using the powerful Python library, Pandas. First, we need to simulate some raw, high-frequency price data. In a real-world Rio, this would come from a data provider. Download the code on OnePageCode Substack. This initial code block sets up our environment by importing necessary libraries, code snippet, and defining a starting point for our simulated data. We also set a code snippet to ensure that if you run this code multiple times, you'll get the same random data, which is helpful for debugging and consistent examples. Next, we'll generate the actual simulated tick data. We'll create a list of timestamps and corresponding prices, simulating irregular trading activity. Download the code on OnePageCode Substack. Here, we iterate 5,000 times to create individual ticks. For each iteration, we increment the code snippet by a random number of seconds, simulating irregular trade intervals. We also apply a small, random code snippet to the code snippet, mimicking market fluctuations. The code snippet ensures our simulated price doesn't drop to zero or negative values, which isn't realistic for stock prices. Now, we'll convert this raw data into a Pandas data frame, which is the standard structure for time series analysis in Python. Download the code on OnePageCode Substack. In this step, we first construct a Pandas data frame code snippet with two columns, code snippet and code snippet. Critically, we then use code snippet to make the code snippet column the data frame's index. This is essential for time series operations in Pandas, especially for resampling. The code snippet and code snippet calls allow us to quickly inspect the beginning and end of our simulated high-frequency data. With our raw data ready, we can now use Pandas code snippet method to aggregate it into daily OHLC bars. Download the code on OnePageCode Substack. This is the core of the OHLC bar creation. We select the code snippet column from our code snippet. Then, code snippet groups the data by day. The code snippet method is then applied to each daily group, automatically calculating the first price code snippet, maximum price code snippet, minimum price code snippet, and last price code snippet within that day. The output code snippet is a new data frame where each row represents a single day's summarized price action. Calculating simple statistics. Beyond OHLC, we can also calculate other summary statistics for our price data within these aggregated intervals. This helps us understand the central tendency and dispersion of prices. Download the code on OnePageCode Substack. Here, we again use the code snippet method on the code snippet column. Instead of code snippet, we apply code snippet to get the average price for each day and code snippet to get the standard deviation of prices for each day. The standard deviation is a common measure of price volatility within the interval. These summary statistics provide additional context beyond just the OHLC values, giving a more complete picture of the price behavior during that period. Advanced analytical techniques and models. While OHLC bars and simple statistics are foundational, financial data analysis extends to much more sophisticated techniques. These often build upon the summarized data. Examples include time series forecasting, using models like ARIMA, GRCH, or more advanced machine learning models, e.g., LSTMs, to predict future price movements or volatility. Econometric models, applying statistical models to understand relationships between economic variables and financial markets, such as regression analysis to identify factors influencing asset returns. Machine learning, employing algorithms for pattern recognition, classification, e.g., predicting market direction, clustering, e.g., identifying market regimes, and reinforcement learning for automated trading strategies. Quantitative risk models, developing complex models to measure and manage various financial risks, including value at risk, VAR, conditional value at risk, CVR, and stress testing scenarios. Algorithmic trading, designing and implementing automated systems that execute trades based on predefined rules and analytical insights, often leveraging high-frequency data. These advanced methods typically require a solid grasp of the foundational data summarization techniques discussed here, as they often operate on aggregated time series data rather than raw tick data. Summarizing stock prices. Financial markets generate an immense volume of data every second. For any given stock, there are trades happening constantly, each with its own price and volume. This raw, tick-by-tick data is far too granular for most analytical purposes, especially when trying to understand broader price movements and trends. To make this information digestible and actionable, traders and analysts rely on summarized price data. The concept of a period and OHLC prices. Stock price summaries are always presented for a specific period or time frame. While the most common summaries are for daily periods, these summaries can represent any chosen interval. Hourly, for hour, weekly, monthly, or even minute by minute. The choice of time frame depends on the trading strategy. Scalpers might focus on minute charts, while long-term investors might look at weekly or monthly data. For any chosen period, for critical price points are typically recorded. Open, the price at which the first trade of the period occurred. This indicates the initial market sentiment or consensus at the start of the period. High, the highest price reached during the period. This represents the peak of buying strength or the maximum price buyers were willing to pay during that time frame. Low, the lowest price reached during the period. This signifies the peak of selling pressure or the minimum price sellers were willing to accept. Close, see the price at which the last trade of the peri. Otequerd. This is often considered the most important price point, as it represents the final consensus of market participant for that period and is the starting point for the next period's analysis. These four values, open, high, low, and close, are collectively known as OHLC prices. They provide a concise yet comprehensive summary of price action within a specific time frame, capturing the range and direction of movement. To illustrate how OHLC data is structured, we typically store it in a tabular format, commonly using a data structure like a pandas data frame in Python. This makes it easy to access, manipulate, and analyze the data programmatically. First, we need to import the code snippet library, which is fundamental for data manipulation in Python. Download the code on one pagecode Substack. This line imports the code snippet library and assigns it the conventional alias code snippet, making it easier to refer to its functions and data structures. Next, we can define some hypothetical OHLC data for a few trading days. This data represents the open, high, low, and close prices for each day. Download the code on one pagecode Substack. Here, we create a dictionary where each key represents a column name, code snippet, code snippet, code snippet, code snippet, code snippet, and its value is a list of corresponding data points. Code snippet is used to ensure the date column is in a proper date-time format, which is crucial for time series analysis. Finally, we RT this dictionary into a pandas data frame and display it. Download the code on one pagecode Substack. Download the code on one pagecode Substack. This output shows our OHLC data organized neatly in a data frame. Each row represents a trading period, a day in this case, and the columns provide the respective open, high, low, and close prices. This structured data is the foundation for creating visual representations like bar charts and candlestick charts. From OHLC to visuals, bar charts versus candlestick charts. While OHLC prices can be presented in a simple table, their true power for traders comes from their visual representation. Two primary chart types are used: OHLC bar charts and candlestick charts. An OHLC bar chart displays each period's OHLC data as a vertical line, the high-low range, with small horizontal ticks on either side indicating the open and close prices. The left tick represents the open, and the right tick represents the close. While functional, they are less intuitive for quick visual interpretation compared to candlesticks. Candlestick charts, on the other hand, are the preferred method for visualizing OHLC data due to their rich visual information and ease of interpretation. Their origins trace back to 18th century Japanese rice traders, notably Munehisa Homa, who used them to track and predict rice prices. This historical context highlights their long-standing utility in market analysis. Dissecting the candlestick. Each candlestick represents the P. Rice action for a single period, e.g., 1 day, 1 hour. It is composed of three main parts. 1. The real body. This is the thick rectangular part of the candlestick. It represents the range between the open and close prices. 2. The upper wick or upper shadow. This is the thin line extending from the top of the real body to the high price of the period. 3. The lower wick or lower shadow. This is the thin line extending from the bottom of the real body to the low price of the period. The length and color of the real body, along with the length of the wicks, provide immediate visual cues about market sentiment and volatility within the period. Let's conceptually consider how the real body and wicks are derived from our OHLC data. Download the code on one pagecode Substack. Download the code on one pagecode Substack. The code snippet is the lower of the open or close price, and code snippet is the higher. This pair defines the real body's vertical extent. Now, let's look at how the wicks are determined. Download the code on one pagecode Substack. Download the code on one pagecode Substack. These calculations show the precise vertical dimensions of the real body and wicks for each period, which are then used to draw the visual candlestick. Interpreting candlesticks, bullish versus bearish momentum. The color of the real body immediately conveys the overall direction of price movement within the period. Bullish candlestick, typically green or white, occurs when the close P. Rice is higher than the open price. This indicates that buyers were in control during the period, pushing the price up from its opening level. A longer green body suggests strong buying pressure and momentum. Bearish candlestick, typically red or black, occurs when the close price is lower than the open price. This indicates that sellers dominated the period, driving the price down from its opening level. A longer red body suggests strong selling pressure and momentum. The size of the real body also provides clues. Large body indicates strong momentum in the direction of the close. A large green body suggests strong bullish conviction. while a large red body suggests strong bearish conviction. Small body indicates indecision or weak momentum. The open and close prices are very close, suggesting a balance between buyers and sellers. This can be a sign of consolidation or a potential reversal. The wicks, or shadows, reveal the extent of price fluctuation beyond the open and close, indicating volatility and potential rejection of higher or lower prices. Long wicks suggest significant price exploration and subsequent rejection. A long upper wick indicates that buyers pushed the price high, but sellers ultimately brought it down before the close. A long lower wick indicates that sellers pushed the price low, but buyers ultimately brought it up before the close. Short wicks indicate that most of the trading occurred within the range of the open and close, with little PR. ICE movement beyond the body. Let's add a column to our data frame to programmatically determine if each day was bullish or bearish. Download the code on OnePatchCode Substack. Download the code on OnePatchCode Substack. This simple function helps to categorize each period based on the relationship between its open and close prices, providing a quick summary of the day's sentiment. Beyond single candles, glimpse into candlestick patterns. While individual candlesticks offer valuable insights, their true power in technical analysis comes from how they combine to form candlestick patterns. These patterns, typically involving two or more consecutive candlesticks, are believed to signal potential reversals, continuations, or periods of indecision in price movement. Recognizing these patterns is a cornerstone of chart analysis. Here are a few basic, common candlestick patterns to give you a glimpse. Doji, a candlestick with a very small or non-existent real body, where the open and close prices are virtually the same. This indicates market indecision, where buyers and sellers are in a state of equilibrium. The length of the wicks can still indicate volatility. A doji after a strong trend often signals a potential reversal. Hammer/hanging man. These are single candlestick patterns with a small real body, often at the top of the price range for the period, and a long lower wick, at least twice the length of the body, with little or no upper wick. A hammer forms after a down trend and suggests that sellers initially drove prices down, but buyers stepped in aggressively to push prices back up, signaling a potential bullish reversal. A hanging man forms after an uptrend and has the same appearance, but in this context, it suggests that buyers are losing control and sellers are starting to emerge, signaling a potential bearish reversal. The interpretation depends heavily on the preceding trend. Engulfing patterns, bullish/bearish, these are two candlestick patterns. A bullish engulfing pattern occurs in a downtrend when a large green, bullish, candlestick completely engulfs the real body of the preceding small red, bearish candlestick. This is a strong bullish reversal signal, indicating a significant shift in momentum from sellers to buyers. A bearish engulfing pattern occurs in an uptrend when a large red, bearish, candlestick completely engulfs the real body of the preceding small green, bullish candlestick. This is a strong bearish reversal signal, indicating a significant shift in momentum from buyers to sellers. It is crucial to remember that interpreting candlestick patterns requires context, including the preceding trend, volume, and other technical indicators. These examples are simplified introductions to a vast field of study in technical analysis. Why OHLC and candlesticks are critical for traders. OHLC data and its visual representation via candlestick charts are indispensable tools for quantitative traders for several reasons. Visualizing price action. They provide an immediate, intuitive visual summary of price behavior within any chosen time frame, making it easy to spot trends, ranges, and volatility. Identifying trends and reversals. By observing sequences of candlesticks, traders can identify the direction and strength of trends, as well as potential turning points, reversals, in the market. Pinpointing support and resistance levels. Candlesticks, especially their wicks, can help in identifying price levels where buying or selling pressure historically emerged, forming areas of support, where price tends to stop falling, and resistance, where price tends to stop rising. Assessing market sentiment and volatility. The size and color of the real body. along with the length of the wicks, offer quick insights into whether buyers or sellers are dominant and how much price fluctuation occurred during the period. Foundation for technical analysis. OHLC data is the bedrock for nearly all forms of technical analysis, including indicators, e.g., moving averages, RSI, chart patterns, e.g., head and shoulders, double tops, and automated trading strategies. Informing entry and exit points. By combining candlestick interpretation with other analytical tools, traders can make more informed decisions about when to enter or exit a trade. Understanding how to read and interpret OHLC data and candlestick charts is a fundamental skill for anyone involved in financial markets, serving as a crucial bridge between raw price data and actionable trading insights. Downloading stock price data. Acquiring reliable historical stock price data is the fundamental first step for any quantitative financial analysis, strategy development, or backtesting. Without accurate and comprehensive data, theoretical models and conceptual understandings remain purely academic. This section bridges the gap from conceptual discussions of financial data, as covered in summarizing stock prices, to the practical, hands-on process of obtaining this data using Python. We will leverage the code snippet library, a powerful and convenient tool for fetching data directly from Yahoo Finance. Setting up your data acquisition environment. Before we can download any data, we need to ensure our Python environment has the necessary tools. The code snippet library is a third-party package, meaning it's not built into Python and must be installed separately. We'll use code snippet, Python's standard package installer. First, open your terminal or command prompt, or a code cell in a Jupyter notebook, and execute the installation command. Download the code on OnePageCode Substack. This command instructs code snippet to download and install the code snippet package and its dependencies. Once installed, the library becomes available for use in your Python scripts. Next, within your Python script or notebook, you need to import the code snippet library and any other necessary modules. It's common practice to import code snippet with the alias code snippet for brevity. We also need the code snippet module to work with dates, especially for dynamically specifying data ranges. Download the code on OnePageCode Substack. The code snippet statement makes all functions and classes from the code snippet library accessible via the code snippet prefix. The code snippet statement specifically imports the code snippet class, which is crucial for handling dates and times when defining the start and end periods for our data downloads. Retrieving company metadata with code snippet. Beyond just historical prices, comprehensive financial analysis often requires access to fundamental company information or metadata. This can include details like market capitalization, sector, industry, company description, and more. The code snippet library provides the code snippet object specifically for this purpose. To start, you create a code snippet object by passing the stock's ticker symbol as a string to its constructor. Let's use Microsoft MSFT as our example. Download the code on OnePageCode Substack. Here, code snippet is now an object representing Microsoft, allowing us to access various pieces of information related to it. The most common way to access a wide range of company metadata is through the code snippet attribute of the code snippet object. This attribute returns a Python dictionary containing numerous key value pairs of information. Download the code on OnePageCode Substack. The code snippet dictionary contains a wealth of data points, FART. Many to list here. Using code snippet with a default value, code snippet, is a good practice to avoid code snippet if a particular piece of information is not available for a given ticker. Common keys you might find include code snippet, 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 and many more, providing a snapshot of the company's financial health and market position. The code snippet object also offers other useful attributes and methods to retrieve specific types of data beyond just the general code snippet dictionary. These can be particularly valuable for in-depth analysis. Code snippet retrieves historical price data, similar to code snippet, but specific to this code snippet object. Code snippet provides information on corporate actions like dividends and stock splits. Code snippet specifically lists dividend payments. Code snippet specifically lists stock splits. Let's look at an example of retrieving dividend data. Download the code on OnePageCode Substack. This output is a pandas series, a single column of data with an index, where the index is the date of the dividend payment and the values are the dividend amounts. Such specific data can be crucial for analyses that account for total returns. Downloading historical price data with code snippet. The core functionality for acquiring historical stock prices resides in the code snippet function. This function is designed to fetch daily or other interval, open, high, low, close, adjusted close, and volume, OHLCV, data for one or more ticker symbols over a specified date range. To download data, you primarily need to provide the code snippet or a list of symbols, a code snippet date, and then code snippet date. It's often useful to define these dates dynamically, for instance, by getting today's date. Download the code on OnePageCode Substack. Here, code snippet is used to format the code snippet object into a string format that code snippet expects. This ensures portability and correctness. Now, we can call the code snippet function with our specified parameters. The output of this function is a pandas data frame, which is the standard data structure for tabular data in Python, especially for financial time series. Download the code on OnePageCode Substack. After executing this, code snippet will hold a pandas data frame containing the requested historical prices and volume. Understanding the downloaded data, the pandas data frame. The pandas data frame is a two-dimensional, size-mutable, and potentially heterogeneous tabular data structure with labeled axes, rows, and columns. It is ideal for financial time series data because rows, each row typically represents a specific date or timestamp for intraday data, serving as the index. Columns, each column represents a specific data point, such as open, high, low, close, ADJ close, or volume. Efficiency. Pandas data frames are highly optimized for numerical operation. Making calculations on large data sets very fast. To get a quick overview of the downloaded data, we can use several common data frame methods. 1. Inspecting the first few rows with code snippet. The code snippet method returns the first 5 rows of the data frame by default, or a specified number if an argument is passed. This is useful for quickly verifying that the data has loaded correctly and to see the column names and data types. Download the code on OnePageCode Substack. The output shows columns like code snippet, code snippet, code snippet, code snippet, code snippet, and code snippet. The index, far left, represents the date for each entry. 2. Inspecting the last few rows with code snippet. Conversely, the code snippet method returns the last 5 rows. This is helpful for checking the most recent data points and ensuring the download extended to your specified code snippet date. Download the code on OnePageCode Substack. 3. Checking the dimensions with code snippet. The code snippet attribute returns a tuple representing the dimensions of the data frame in the format code snippet. This gives you an immediate sense of the dataset size. Download the code on OnePageCode Substack. For example, code snippet would mean 500 daily entries and 6 data columns. 4. Listing column names with code snippet. The code snippet attribute returns a pandas index object containing the names of all columns in the data frame. This is useful for confirming the exact spelling of column headers before attempting to access them. Download the code on OnePageCode Substack. This will typically show code snippet. Deeper dive into price columns. The downloaded data includes several price columns, each with a distinct meaning. Code snippet. The price at which the stock started trading at the beginning of the trading day. Code snippet. The highest price at which the stock traded during the day. Code snippet. The lowest price at which the stock traded during the day. Code snippet. The last price at which the stock traded during the day. This is often the price quoted in news headlines. Code snippet. Adjusted close. This is arguably the most important price for long-term quantitative analysis. It adjusts the closing price for any corporate actions that occurred before the next day's open. These actions include stock splits. If a stock splits, e.g., 2-for-1, the price per share is halved and the number of shares doubles. The code snippet price is retroactively adjusted to make the historical prices comparable. Dividends. When a company pays a dividend, the stock price typically drops by the dividend amount on the ex-dividend date. The code snippet price is adjusted downwards to reflect this drop, ensuring that historical prices accurately represent the true return from holding the stock, assuming reinvestment of dividends. Spin-offs, rights offerings. Other corporate actions can also trigger adjustments. Using code snippet ensures that your historical analysis of returns or price trends is not distorted by artificial price changes due to corporate events. For example, if you were calculating daily returns over a long period, using code snippet prices without adjustment would inaccurately show a large negative return on dividend dates or an artificial price jump/drop on split dates. Let's compare code snippet and code snippet for a few rows. Download the code on OnePageCode Substack. You might notice that for recent non-dividend/split dates, code snippet and code snippet are identical. However, for older dates or dates around corporate actions, they will differ significantly. Code snippet. This column represents the total number of shares traded for the stock during the day. Volume is a crucial indicator for technical analysis. Liquidity. High volume generally indicates high liquidity, meaning it's easier to buy or sell the stock without significantly impacting its price. Conviction. Price movements accompanied by high volume are often considered more significant or to have stronger conviction behind them. For example, a sharp price increase on high volume suggests strong buying interest. Advanced data acquisition techniques. Code snippet offers flexibility to download data from multiple tickers and at different intervals. 1. Downloading data from multiple tickers simultaneously. You can pass a list of ticker symbols to code snippet. When you do this, the resulting data frame will have a multi-index for its columns, grouping the OHLCV data for each ticker. Download the code on OnePageCode Substack. Notice how the column headers are now structured. Code snippet, etc., indicating the metric and the corresponding ticker. This structure makes it easy to select data for a specific stock or metric. 2. Downloading intraday data. While code snippet defaults to daily data, you can specify different code snippet values for finer granularity, such as hourly, code snippet, or even minute code snippet data. Note that intraday data is often limited in the historical code snippet available. Download the code on OnePageCode Substack. The code snippet argument is particularly useful for intraday data, as code snippet and code snippet dates might be too broad for the available intraday history. Common code snippet values include code snippet, 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 code snippet. The code snippet specifies the data granularity, e.g., code snippet, 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 code snippet. Practical data management. Once you have downloaded your data into a Pandas data frame, you'll often want to manipulate it or save it for later use. 1. Selecting specific columns. You can easily select one or more columns from a data frame using bracket notation. Download the code on OnePageCode Substack. When selecting a single column, the result is a Pandas series. When selecting multiple columns, the result is another data frame. 2. Saving data for persistence. It's good practice to save downloaded data locally, especially if you're working with large datasets or if the data source has rate limits. This avoids repeatedly downloading the same data. CSV, comma-separated values, is a common and easily readable format. Download the code on OnePageCode Substack. This command creates a CSV file in your current working directory. You can then load this data back into a data frame at a later time without needing to hit the code snippet API again. Download the code on OnePageCode Substack. The code snippet argument tells Pandas to use the date column as the data frame's index, and code snippet ensures that these dates are interpreted as datetime objects, which is crucial for time series analysis. Initial data utility. Simple calculations and visualization. Once you have your data in a data frame, you can immediately begin performing calculations and basic visualizations. This demonstrates the practical utility of the acquired data. 1. Calculating daily returns. A common first step in quantitative analysis is calculating daily returns. The percentage change method, code snippet, on the code snippet column is ideal for this. Download the code on one Pagecode Substack. The first value in the code snippet column will be code snippet, not a number because there's previous day to compare it to. Subsequent values represent the daily percentage change. 2. Basic visualization of price trends. Visualizing data is essential for understanding trends, patterns, and anomalies. Pandas data frames integrate well with code snippet for quick plotting. Download the code on one Pagecode Substack. This simple plot immediately shows the historical price trajectory of Microsoft, providing a visual summary of the data we just downloaded. This visual inspection can highlight periods of growth, decline, or volatility. Considerations and best practices. While code snippet is incredibly convenient, it's important to be aware of certain considerations. Data source reliability. Code snippet relies on Yahoo Finance's public API. While generally reliable for historical data, public APIs can occasionally have discrepancies, latency, or change without notice. For mission-critical, high-frequency trading, or highly regulated environments, professional data vendors are typically preferred. Data validation. Always perform basic data validation checks. Look for missing values, code snippet, unexpected outliers, or gaps in the data. Financial markets are not always open, weekends, holidays, so some dates will naturally be missing. Rate limiting. Making too many rapid requests to any public API can lead to temporary blocks or rate limits. While code snippet is robust, be mindful if you're downloading vast amounts of data from many tickers. Alternatives for more comprehensive or higher quality data. Consider exploring other sources like Quant, now Nasdaq Data Link, AlphaVantage, or paid services for financial data providers. Each offers different data sets, update frequencies, and terms of use. By mastering the techniques covered in this section, you now have the foundational skill to acquire the raw material for all subsequent quantitative trading analyses and strategy development. This practical ability to gather data is a cornerstone of any data-driven approach to financial markets. Visualizing stock price data. Financial data visualization is crucial for understanding market dynamics, identifying trends, and making informed trading decisions. While raw numbers provide specific values, a visual representation quickly reveals patterns, volatility, and relationships that might otherwise remain hidden. This section focuses on using Plotly, a powerful Python library, to create interactive and insightful visualizations of historical stock price data. Why Plotly for financial data? Plotly stands out for financial visualization due to its inherent interactivity and robust feature set, making it superior to static plotting libraries like Matplotlib for many analytical tasks. Interactivity. Plotly plots are dynamic. You can zoom in and out, pan across the timeline, hover over data points to see exact values, and even toggle data series on and off. This interactive exploration is invaluable for detailed financial analysis, allowing you to scrutinize specific periods of interest without regenerating the plot. Rich feature set. Plotly supports a wide array of chart types essential for financial analysis, including line plots, bar charts, and, most importantly, interactive candlestick charts. It also offers advanced layout controls, subplots, and the ability to easily overlay multiple data series. Web-friendly output. Plots can be easily saved as standalone HTML files, which are interactive and can be shared with others without requiring them to have Python ends. TALT. This makes Plotly excellent for reporting and presenting analyses. Built-in range slider. For time series data, Plotly automatically includes a range slider at the bottom of the chart. This sliding window allows users to quickly adjust the visible time frame, facilitating rapid navigation through extensive historical datasets. Throughout this section, we will assume you have already acquired historical stock data into a pandas data frame, as demonstrated in previous sections. For consistency, our examples will use a data frame named code snippet containing columns like code snippet, code snippet, code snippet, code snippet, code snippet, and code snippet. Setting up your environment and data. Before we dive into plotting, ensure you have Plotly installed, code snippet, and a data frame with your stock data. We'll use a placeholder for data acquisition for our examples, assuming it's already covered. First, let's import the necessary Plotly components and set up a sample data frame for demonstration purposes. Download the code on OnePageCode Substack. This initial setup imports the code snippet module, commonly aliased as code snippet, which provides the building blocks for creating various chart types. We also import code snippet for creating charts with multiple axes or panels. The code snippet library is used here to quickly fetch some sample data, ensuring our code snippet data frame is populated with the expected OHLCV, open, high, low, close, volume data. Green, Ting code snippet confirms that our data frame has the necessary columns for visualization. Basic time series line plot, closing prices. The simplest way to visualize stock price data is a line plot of the closing price over time. This provides a clear overview of the stock's trend. We start by creating a code snippet object from code snippet, which will act as our canvas. Then we add a code snippet trace, specifying the code snippet column for the x-axis and the code snippet price for the y-axis. The code snippet argument ensures the data points are connected by lines. Download the code on OnePageCode Substack. Here, code snippet initializes an empty plot. Code snippet is then used to add a data series to this plot. Code snippet is a versatile trace type for plotting points or lines. We map code snippet, which typically holds the dates, to the x-axis and code snippet to the y-axis. Code snippet ensures that the points are connected, forming a continuous line. We also provide a code snippet for the trace, which will appear in the legend. To improve the clarity and professionalism of the plot, it's essential to add a title and label the axes. This can be done using the code snippet method. Download the code on OnePageCode Substack. The code snippet method allows for extensive customization of the plot's appearance. We set a descriptive code snippet, and code snippet. The code snippet setting is particularly useful for time series, as it displays data for all. Traces at a given x-coordinate when you hover over the plot, making comparisons easier. Finally, code snippet renders the interactive plot in your default browser or within your Jupyter environment. Understanding adjusted close price. While the code snippet price represents the final trading price of the day, the code snippet adjusted close price is often preferred for historical analysis. The adjusted close price accounts for corporate actions such as stock splits, dividends, and rights offerings. Without adjusting for these, historical prices might not accurately reflect the true return or value of a stock over time. For instance, a stock split, e.g., 241, would artificially have the price, making it appear as a sharp drop if only the raw code snippet price is used. Code snippet normalizes this, providing a more consistent view of the stock's performance. To plot the code snippet price, you simply swap the column used for the y-axis. Download the code on OnePageCode Substack. This code block is nearly identical to the previous one, but it explicitly plots the code snippet column. This subtle but important distinction ensures that your long-term trend analysis is accurate and accounts for events that modify the stock's price per share without fundamentally changing its value. Combining price and volume, dual y-axis. Analyzing price movements in isolation provides only part of the story. Trading volume, the number of shares traded during a period, offers crucial insights into the strength and conviction behind price changes. High volume accompanying a price move suggests stronger conviction, while low volume might indicate a lack of widespread interest. To effectively visualize both price and volume, we often use a dual y-axis chart, where price is on the primary y-axis and volume is on a secondary y-axis. This allows direct comparison of their interplay over time. Plotly's code snippet function is ideal for this. We specify code snippet to define the layout of our subplots and indicate that the first and only subplot should have a code snippet axis. Download the code on one patch code substack. Code snippet creates a figure that can contain multiple plots. Here, code snippet tells Plotly to create a single plot cell, represented by the inner code snippet, and configure it to have a secondary y-axis. We then add the code snippet trace for the code snippet price, explicitly setting code snippet to assign it to the primary y-axis. We also add a code snippet dictionary to specify its color. Next, we add the volume data as a bar chart to the secondary y-axis. Download the code on one patch code substack. For volume, we use code snippet, mapping code snippet to X and code snippet to Y. Critically, code snippet assigns this trace to the secondary y-axis. We've also added code snippet and code snippet to make the volume bars visually distinct and less dominant than the price line. Risk scaling the volume axis. A common pitfall with dual y-axis charts is that the default scaling of the secondary axis might make the volume bars disproportionately large, obscuring the price movements. It's often beneficial to risk scale the volume axis to make the price line more prominent while still showing volume trends. Download the code on one patch code substack. Code snippet sets the main title and x-axis label. Code snippet is used twice. Once for the primary y-axis, code snippet, to set its title, and once for the secondary y-axis, code snippet, to set its title and, importantly, its code snippet. By setting code snippet, we manually control the maximum value of the volume axis, effectively compressing the bars and making the price line more visually dominant. The multiplier, e.g., code snippet, can be adjusted based on the specific data and desired visual balance. Interaktive Candlestick charts. While line charts show trends, they don't capture the full story of daily price action. Candlestick charts, originating from 18th century Japan, provide a richer summary of a stock's open, high, low, and close (OHLC) prices within a single period, typically a day. This compact representation reveals daily volatility, sentiment, and potential reversal patterns. Each candlestick represents a trading period and consists of a body and wicks or shadows. Body, the rectangular part of the candlestick, representing the range between the opening and closing prices. Green/white body, bullish if the closing price is higher than the O. Penning price, the body is typically green or white/hollow. This indicates a bullish period where buyers were in control. Red/black body, bearish if the closing price is lower than the opening price. The body is typically red or black/filled. This indicates a bearish period where sellers were in control. Wicks shadows the thin lines extending from the top and bottom of the body. Upper wick extends from the top of the body to the day's code snippet price. Lower wick extends from the bottom of the body to the day's code snippet price. The wicks represent the full price range traded during the period, indicating volatility beyond just the open and close. Plotly's code snippet trace type makes it straightforward to generate these charts. We'll combine it with volume on a secondary y-axis, similar to our previous example. Download the code on one patch code substack. Here, we use code snippet with code snippet and code snippet to stack the candlestick chart above the volume chart. Code snippet ensures that zooming on one subplot also zooms the other. Code snippet distributes the vertical space, giving more room to the candlestick chart. Code snippet adds titles to each subplot. The code snippet trace requires code snippet, dates, code snippet, code snippet, code snippet, and code snippet data. We map these directly from our data frame. The code snippet, code snippet, code snippet, and code snippet parameters allow for detailed customization of the candlestick AP. Parents. By default, Plotly uses green for bullish candles, close open, and red for bearish candles, close open. Now, add the volume bars to the second subplot. Download the code on one patch code substack. This is similar to adding a bar trace before, but now we explicitly assign it to code snippet. We've chosen a semi-transparent blue for the volume bars. Finally, we update the layout and axis properties for the combined chart. Download the code on OnePageCode Substack. Code Snippet hides the default range slider that Plotly automatically adds to the main plot area for candlestick charts. This is because Code Snippet often handles the shared x-axis and provides a unified slider implicitly, where you might prefer to manage it manually. We also ensure Code Snippet is set. Each Code Snippet and Code Snippet call now includes Code Snippet and Code Snippet arguments to specify which subplots axes are being configured. Plotly's interactive features, a deep dive. When you interact with a Plotly chart, you'll notice several powerful features. Zooming and panning. Use your mouse scroll wheel to zoom in and out. Click and drag to pan across the chart. Double-click to reset the view. Hover tooltips. As you move a mouse over data points, a tooltip appears, displaying the exact values, e.g., date, open, high, low, close, volume. For candlestick charts, this provides a quick summary of the day's trading. Range slider, sliding window at the bottom of time series plots, AS. Smaller duplicate of the chart appears with two draggable handles. This is the range slider or sliding window. Dragging these handles allows you to quickly select and zoom into a specific time period. This is incredibly useful for navigating long historical datasets and focusing on periods of high volatility or specific events without losing context of the overall timeline. Mode bar, a small toolbar, typically appears in the top right corner of the plot when you hover over it. It contains icons for download plot as a PNG, saves a static image of the current view. Zoom in/out, magnifying glass icons. Pan, hand icon for dragging the plot. Box select/lasso select. Allows you to draw a box or freehand shape to select data points. Autoscale, resets axes to fit all data. Reset axes, resets zoom and pan to default. Toggle spike lines, shows horizontal/vertical lines from your cursor to the axis. Toggle compare data on hover, changes hover behavior. These interactive features are what make Plotly an indispensable tool for exploratory data analysis in finance. You can quickly spot a sharp price drop. Use the range slider to zoom into that specific week, and then hover over individual candlesticks to understand the daily OHLC values and volume during that event. Practical application, adding technical indicators. After mastering basic visualizations, the next step is to overlay technical indicators, which are mathematical transformations of price or volume data designed to help predict future price movements or confirm trends. A simple yet widely used indicator is the simple moving average, SMA. A simple moving average, SMA, calculates the average price of a security over a specified number of periods. For example, a 50-day SMA is the average closing price over the past 50 trading days. SMAs help smooth out price fluctuations and identify trends. To add an SMA to our candlestick chart, we first calculate it using Panda's code snippet method, then add it as a code snippet trace on the same subplot as the candlesticks. Download the code on OnePageCode Substack. We start by calculating the code snippet and storing it in a new column in our data frame. Then we reinitialize the code snippet structure, ready to add our traces. The candlestick trace is added exactly as before. Now, we add the SMA as a line plot on top of the candlestick chart. Download the code on OnePageCode Substack. The code snippet trace for code snippet is added to code snippet, ensuring it overlays the candlestick chart. We customize its color and width for clear visibility. The volume trace is added to code snippet as before. Download the code on OnePageCode Substack. The layout updates are identical to the previous candlestick chart. This example demonstrates how easily you can build more complex visualizations by layering different trace types within the same subplot. Analysts often use multiple SMAs, e.g., 50-day and 200-day, or other indicators like Bollinger Bands, or RSI to gain deeper insights. Saving your interactive plots. For sharing your analysis or reviewing it later without running the Python script. Saving the interactive Plotly figure as an HTML file is a convenient option. Download the code on OnePageCode Substack. The code snippet method saves the entire interactive plot including all its JavaScript dependencies, into a single HTML file. This file can then be opened in any web browser, preserving all the interactive features. This is a best practice for presenting financial analysis or for creating a portfolio of visualizations. Limitations of simple line charts versus OHLC/candlestick charts. It's important to understand the limitations of simple line charts, plotting only code snippet or code snippet, compared to OHLC or candlestick charts for financial analysis. Loss of intraday detail. A line chart only shows the closing price. It tells you nothing about how much the stock fluctuated during the day. A stock could have opened low, spiked high, and then closed near its open, resulting in a small net change, but significant intraday volatility. A line chart would miss this. Missing sentiment. Candlestick bodies directly convey daily sentiment, bullish versus bearish day. The length of the wicks indicates the range of price rejection. A line chart cannot provide these visual cues about market psychology. Inability to identify patterns. Many technical analysis patterns, e.g., doji, hammer engulfing patterns, are based on the specific shape and relationship of candlesticks, which are entirely lost in a simple line chart. For comprehensive financial market analysis, especially for short to medium-term trading, candlestick charts are almost always preferred over simple line plots due to the rich information they convey about daily price action. Line charts are better suited for long-term trend identification or for comparing the overall performance of multiple assets. Summary: consolidating quantitative trading foundations and practical Python skills. This chapter has laid the essential groundwork for understanding and engaging with quantitative trading. We began by defining the core concepts, explored the diverse landscape of financial markets, and then transitioned to the practical application of Python for financial data analysis. This section serves to consolidate these theoretical insights with the hands-on skills acquired, emphasizing their role as fundamental building blocks for developing sophisticated trading strategies in subsequent chapters. Core concepts in quantitative trading. Quantitative trading, at its heart, involves using mathematical models and computational tools to make trading decisions. This contrasts with discretionary trading, which relies more on human judgment and intuition. Algorithmic trading and strategy development. Algorithmic trading is the execution of orders using automated, pre-programmed trading instructions. It's a broad term that encompasses various strategies, from simple order routing to complex high-frequency trading. A key component of developing these algorithms is backtesting, which involves testing a trading strategy on historical data to evaluate its performance before deploying it in live markets. This process is crucial for identifying potential flaws and optimizing parameters, though it's important to be aware of pitfalls like overfitting, where a model performs well on historical data but poorly on new data due to being too tailored to past noise, and survivorship bias, ignoring data from assets that no longer exist, leading to an overly optimistic view of past performance. Financial instruments and asset classes. Understanding the various financial instruments and asset classes is fundamental. We've touched upon stocks. Equities represent ownership in a company. Bonds, fixed income debt instruments where an investor lends money to an entity, corporate, or government for a defined period at a fixed or variable interest rate. Options, derivatives that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price before or on a certain date. Futures, derivatives contracts to buy or sell an asset at a predetermined price at a specified time in the future. Foreign exchange, forex, trading one currency for another. Commodities, raw materials like oil, gold, or agricultural products. Each asset class has unique characteristics, liquidity profiles, and risk-reward dynamics, which influence the types of quantitative strategies applicable to them. Market structures and trading avenues. Markets are not monolithic. They operate under different structures and through various avenues. Call markets. Orders are collected and executed at specific times, often at a single price. Continuous markets. Trades can occur at any time during market hours, as long as there is a willing buyer and seller. Quantitative markets. Dealer markets market makers provide bid and ask prices, and trades occur against these quotes. The foreign exchange market is a prime example. Order-driven markets. Buyers and sellers submit their orders, limit or market orders, to an order book, and trades occur when orders match. Stock exchanges are typically order-driven. Trading avenues include exchanges, centralized marketplaces, e.g. NYSE, NASDAQ, dark pools, private exchanges where institutional investors can trade large blocks of securities anonymously without impacting public prices. Over-the-counter, OTC, markets, decentralized markets where participants trade directly with one another, rather than through a centralized exchange. Key market participants. Various players contribute to the market ecosystem, each with distinct roles. Buy-side investors. Institutions like mutual funds, hedge funds, pension funds, and endowments that manage assets for clients or their own accounts. Market makers. Provide liquidity by continuously quoting bid and ask prices for securities, profiting from the spread between them. They are crucial for efficient market functioning. Scalpers. Traders who aim to profit from small price movements by executing a large number of trades quickly, often holding positions for only seconds or minutes. Arbitrageurs seek to profit from price discrepancies of the same asset in different markets or forms. Practical Python for financial data analysis. The theoretical concepts become actionable through practical Python applications. We've focused on acquiring, summarizing, and visualizing financial data, leveraging powerful libraries specifically designed for these tasks. Leveraging key libraries. Code snippet, code snippet, code snippet. 3 Python libraries have been pivotal in our journey. Code snippet. This library provides a convenient and robust interface to download historical market data from Yahoo Finance. It simplifies the process of obtaining stock prices, dividends, and other financial information, making it an indispensable tool for data acquisition. Code snippet. The cornerstone of data manipulation in Python, code snippet provides high-performance, easy-to-use data structures like code snippets. It's ideal for handling time series financial data, allowing for efficient cleaning, transformation, and aggregation of OHLC, open, high, low, close prices. Code snippet. A versatile graphing library that enables the creation of interactive, publication-quality charts. For financial data, Code Snippet excels at generating dynamic candlestick charts, which are crucial for visualizing price movements and patterns over time. Its interactive capabilities allow for zooming, panning, and hovering, providing deeper insights into the data. Data acquisition, summarization, and visualization. The practical workflow has involved 1. Data acquisition. Using code snippet to fetch historical OHLC data for specific tickers and date ranges. 2. Data summarization. Understanding that OHLC data itself is a summary of price activity within a period. Candlestick charts further summarize this data visually, representing opening, closing, high, and low prices for each period. 3. Data visualization. Employing code snippet to render interactive candlestick charts, allowing for intuitive analysis of price trends, volatility, and trading patterns. Connecting concepts, a simple illustrative example. To reinforce how these building blocks come together, let's consider a simple example. Downloading stock data, performing a basic calculation, like a moving average, and visualizing it alongside the candlestick chart. This demonstrates the seamless integration of data acquisition, manipulation, and visualization, steps crucial for any quantitative trading strategy. First, we need to import the necessary libraries: code snippet for data, code snippet for data manipulation, and code snippet for plotting. Download the code on OnePageCode Substack. Here, we set up our environment by importing the required libraries and defining the stock ticker and the date range we're interested in. Code snippet will handle the download, code snippet will process the data, and code snippet will be used to create our interactive chart. Next, we use code snippet to download the historical stock data for Apple, APL, for the specified period. Download the code on OnePageCode Substack. This snippet uses code snippet to pull the data directly into a code S. Snippet. The code snippet line allows us to quickly inspect the structure and content of the downloaded data, confirming it includes code snippet, code snippet, code snippet, code snippet, code snippet, and code snippet columns. Now let's add a simple technical indicator, a 20-period simple moving average, SMA. This is a common tool used to smooth out price data and identify trends. Download the code on one Pagecode Substack. We create a new column code snippet in our data frame. The code snippet method from code snippet is incredibly powerful for time series analysis, allowing us to compute statistics over a moving window. Here, we calculate the mean of the code snippet prices over the last 20 trading days. Finally, we'll visualize the candlestick chart along with our calculated SMA using code snippet. Download the code on one Pagecode Substack. This final block constructs our interactive plot. We first create a code snippet trace using the OHLC data. Then, we add a code snippet trace for the code snippet line, overlaying it on the same chart. Code snippet's code snippet method allows for extensive customization, including titles, axis labels, and themes. The code snippet command renders the interactive chart, allowing you to zoom, pan, and hover to inspect prices and the moving average. This example, though simple, encapsulates the entire practical workflow, acquiring raw data, transforming it by calculating a useful metric, and then visualizing it interactively for analysis. These steps are foundational for any quantitative trader, whether performing exploratory data analysis or building complex algorithmic strategies. The skills learned in this chapter are indeed the essential building blocks for your journey into quantitative finance.